Introduction. In 1999, when we began to write the first edition of this book, value investing as conceived by Benjamin Graham and David Dodd and developed by their successors was in eclipse as a method of stock selection. Academic finance had for 30 years embraced the efficient markets theory, EMT, which rejected the possibility of consistently successful active investing. The stock market boom, produced by the first internet bubble, appeared to invalidate all the analytical principles on which value investing was based. Value practitioners, with the notable exception of Warren Buffett, were dismissed as old-fashioned and out of touch with contemporary economic reality. Fortunately, the collapse of tech and telecom stocks between 2000 and 2002, coupled with the superior performance by value investors, revived interest in the Graham and Dodd approach. At the same time, a mass of published academic evidence powerfully contradicted EMT. Statistically constructed value portfolios generally outperformed the stock market as a whole over almost all extended periods, in almost all the national markets for which sufficient historical data were available. Increasingly accepted academic studies in psychology, pioneered by Daniel Kahneman and Amos Tversky, spawned the field of behavioral finance and provided an explanation for the historical outperformance of these value portfolios, grounding it in deeply embedded human behavioral biases. As a result, a value premium in returns appeared likely to be a persistent feature of future financial markets. These studies and continuing innovation by value practitioners led to a more thorough understanding of Graham and Dodd principles and marked improvements in value investing practices, especially with respect to identifying and evaluating what are designated as franchise businesses. The long bull market since the depths of the 2008-2009 financial crisis has once again raised questions about the validity of a Graham and Dodd approach. During the years since 2009, many notable value investors have significantly underperformed national and global market indices. Carefully constructed statistical value portfolios have seen the gap between value and overall market performance narrow significantly, if not entirely disappear. A new generation of technology stocks have provided sustained returns that again appear to contradict established value principles, and value investors are once again being dismissed as old-fashioned and out of touch with current economic reality. In part, a decline in the relative performance of value portfolios is a predictable result of the valuation excesses of the later phases of any long bull market. Value investors have historically performed relatively poorly in these periods, as they did in the late 1990s. However, other important factors appear to be at work. First, the renewed success of Graham and Dodd investing in the years from 2000 through 2007 increased the popularity of a value approach. Especially in the United States, the proportion of value-oriented investors rose significantly. An increased demand for value stocks may have compressed the spread between glamour and value stock valuation multiples, although the evidence is mixed. Second, economic developments have complicated the task of applying Graham and Dodd principles. The shift in economic activity from industry/manufacturing to services has increased the importance of intangible capital, customers, trained employees, product portfolios, and brand images relative to tangible capital inventories, accounts receivable, property, plant, and equipment that accountants have traditionally included on a business's balance sheet. Moreover, since investments in intangibles, advertising, hiring, training, and product development, are often counted as current expenses for accounting purposes, defining and measuring current earnings power has become more difficult. Technological developments have had a similar impact. Modern computer and internet-based firms like Amazon, Google, Oracle, Facebook, Microsoft, and Netflix have relatively little physical capital. Much of their growth-related investments are, for accounting purposes, buried in expenses, where they depress, perhaps excessively, reported earnings and raise some valuation multiples. A further complicating factor is the increasing extent to which service and modern technology companies operate in local geographic markets or niche product markets. These local/niche markets are characterized by potential economies of scale and, through continuous customer interactions, high degrees of customer captivity. The result is an increased incidence of dominant local/niche market competitors who benefit from significant barriers to entry. In the language of value investing, franchise businesses with wide moats constitute an increasingly large fraction of overall economic activity. For franchise businesses, net assets play a diminished role in determining profits, and growth contributes significantly to overall value. The consequence is that equity valuations depend heavily on future cash flows, and often far distant future cash flows, whose values are difficult to measure using Graham and Dodd asset value/earnings power value methods. Also, for franchise businesses, management performance, especially with respect to capital allocation, has an enhanced impact on firm valuations. Not surprisingly, in this environment, many traditional balance sheet-focused value investors have not done well. A final newly important factor that plays a role in the valuation of franchise businesses is the heightened potential for disruptive change that may undermine a firm's franchise position. For competitive businesses without significant economies of scale, any decline in profitability should be roughly offset by fixed and working capital recoveries as the business contracts. For franchise businesses, where earnings power value exceeds asset value, disruptive decline has much more serious consequences. Loss of economies of scale undermines earnings without any compensating return of capital. High returns on capital mean that lost earnings are only slightly offset by any realized capital recoveries. Dying franchise businesses are far less valuable relative to their pre-disruption positions than dying cigar butt businesses. Any attempt to invest in undervalued franchise businesses requires a careful assessment of the consequences of disruption. These changes mean that we have to revisit all aspects of the approach to value investing laid out in the first edition of this book. We have rethought the imperatives of searching for and then valuing potentially attractive opportunities once they have been identified. We have also carefully examined active research processes once a preliminary valuation has been made, and have looked at the issue of risk management far more extensively than we did in the first edition. In this revision, we have benefited from observing practicing value investors and noting the adaptations they have made to changing economic circumstances. In all these areas, we have explicitly measured the advantages of a modern Graham and Dodd approach against what is ultimately the fundamental challenge facing any active investor. While there is now overwhelming evidence that financial markets are not efficient in the academic sense, there is a fundamental and inescapable way in which markets are efficient. The average return to all investors in any asset class must be equal to the average return to all the assets in that asset class, i.e., the market return for that asset class. All the assets are owned by somebody, and derivative arrangements, e.g., uncovered short sales, net out since for every seller there is an offsetting buyer. Therefore, If one investor outperforms the market for a particular asset class, another investor must underperform by a compensating amount, weighted by the assets under management. Since this constraint applies to all asset classes, it applies to investments as a whole. Graham and Dodd were fully aware of this efficiency constraint, although they described it in slightly different terms. They understood that every time someone bought a security, thinking it was likely to do well relative to alternative opportunities, someone else was selling that security because they thought it would underperform the relevant alternative opportunities. Depending on the outcome, one of these investors always had to be wrong. The essential characteristic of a well-conceived investment process is that at every step, search, valuation, research process, risk management, it should place an investor on the right side of the trade. The process must be superior to that of the investor on the other side of the trade. This criterion is what we have used to explicitly measure the modern value investing practices described in this second edition. The search process involves not only a value orientation, a preference for non-glamorous, ugly, out-of-favor, and obscure stocks, but also some degree of specialization. If I, as a generalist, trade with an equally capable and highly disciplined specialist, the specialist will usually have superior understanding and information. He or she will therefore more often than not be on the right side of the trade. In this edition, we have extended the search chapter to include a discussion of effective specialization strategies. Recent experience supports this point. Highly focused value investors tend to be unusually successful, even compared to the value community as a whole. Successful but more broadly oriented value investors tend to perform better in industries and geographies where they have concentrated than in other areas. We have, therefore, added a number of specialized investors to our profile section. The Graham and Dodd concept of circle of competence applies not just to staying away from unfamiliar areas, but actively defining focused fields of expertise. We have, over the years since the first edition, learned a similar lesson with respect to valuation. Different assets with different return horizons present different valuation challenges. For liquidating assets or other short-term investments with catalysts, discounted cash flow, DCF, valuations are appropriate. The relevant cash flows are likely to be accurately estimated. Assets whose values are determined in competitive markets, real estate, natural resources, non-franchise businesses, are generally ones for which growth does not create significant value. This limits the importance of far future cash flows. For those investments, the Graham and Dodd asset value/earnings power value formula, which ignores growth, is better than a DCF or ratio valuation for reasons we discussed in the first edition of this book. It is the approach of choice for most value investors. However, it is not suitable for evaluating businesses for which growth creates significant value. In these cases, growth means that far distant cash flows are both difficult to estimate because small differences in growth rates compound into large differences in far future cash flows and constitute an important fraction of value. As a result, current intrinsic values for such businesses cannot be estimated with usual degrees of precision. Investment decisions are more usefully based on estimated future returns than estimated values. The major innovation in this edition of our book is the description through 3 extended chapters of a return-based approach to evaluating franchises businesses. The process we lay out may not turn out to be the last word in franchise business evaluation. However, we can say with confidence that a one-size-fits-all valuation approach is not likely to place investors consistently on the right side of the trade. Close observations over the years since 1999 of the practices of successful value investors has led us to add a chapter on active research practices to the second edition. The rise of the importance of intangible investments and franchise earnings as global economies have evolved has meant the traditional financial statement analysis is no longer adequate to evaluate many businesses. The increasing importance of the quality of management stewardship of these assets to returns has also forced investors to look well beyond published financials in evaluating investments. These imperatives have created unprecedented demands on the investment analyst's time. Properly and efficiently focused active research processes are increasingly important to investment success. A better research process will put an investor more frequently on the right side of the trade. In this added chapter, we describe what good active research processes look like. Finally, the increasing importance of specialization and active research has created significant problems in risk management. Historically, individual investment managers have tended to build portfolios as if they managed most, if not all, of their clients' assets. They selected levels of diversification, without reference to the fact that the wealth owners typically spread their holdings among many investment managers. For wealth owners, it is the risks of their overall portfolios that matter. And these overall portfolios often include large, illiquid positions or businesses. In principle, wealth holders concerned with the risks of the complete portfolio should manage risks centrally. Decentralized risk management potentially leads individual investment managers to take offsetting positions. Manager A embraces risks that Manager B hedges, or positions whose returns are highly correlated with large, illiquid wealth holdings. The result may be an expensive risk management process that does little to reduce overall portfolio exposures. With specialized investment managers, the benefits of diversification must be achieved at the wealth holder level. Increasingly, therefore, risk management will be divorced from individual security selection. Centralized risk managers must receive sufficient information from their individual investment managers in order to do their jobs effectively. In light of these developments, we have included an extended discussion of risk management in the second edition. We carefully define risk from a Graham and Dodd perspective and describe effective practices for managing that risk. The continuing vitality of the Graham and Dodd tradition has always depended on successful adaptation to changing economic and financial conditions by practicing value investors. We have revised the profile section of this book with this in mind. If investors we covered in the first edition have since passed away, we have included the original profiles without change to preserve the valuable insights they had to offer. The others we profiled have continued to innovate and improve their processes. Fortunately, most of them have spoken annually for many years in the MBA Value Investing course at Columbia. For them, and other class speakers, we provide brief descriptions of where they stand in the broad spectrum of value investing practice and how their approaches have evolved over time. Taking advantage of the advances in technology, these summaries are supplemented with access to edited online videos of investors' classroom appearances. Most of the new investors we have added to the second edition, Tom Russo, Paul Hilal, and Andrew Weiss, all specialists to some degree, have spoken in the class many times and will be treated in the same way. Two other important investors, one seasoned, Warren Buffett, and one new, Jan Hummel, have not spoken in the class. For Hummel, we have presentations that we have edited for online access and which we have supplemented with a brief description of his specialized investment approach. As before, Warren Buffett will receive his own written chapter based on extracts from his extensive public commentary. When we began working on the first edition of this book in 1999, Bruce had taught the Value Investing MBA course about 5 times, with some additional run-throughs in Executive MBA and 2-day Executive Ed versions. 20 years later, even with a sabbatical now and then, he has taught it more or less continuously for around 25 years. In 2005, we published Competition Demystified, a detailed study of the factors that constitute sustainable competitive advantages, and what distinguishes franchise businesses, firms protected by barrier to entry, from companies subject to competitive pressures. And during those years, both of us have had direct investment experience, working in a large global mutual fund and 3 smaller hedge funds. There is no doubt that all the additional teaching, thanks to the students and the guest investors who generously contributed their time and expertise to developing the Grahn and Dodd tradition, has expanded our own understanding. At least as important has been our time in the field, so to speak. As the historian Edward Gibbon wrote in his memoirs about his service in the 7 Years' War, the discipline and evolutions of a modern battalion gave me a clearer notion of the phalanx and the legion, and the captain of the Hampshire Grenadiers, the listener may smile, has not been useless to the historian of the Roman Empire. Bruce Greenwald and JUDD KAHN, New York, 2020. 1. Value investing. Definitions, distinctions, results, risks, principles. What value investing is. Value investing is an approach to investing originally identified in the 1920s and 1930s by Benjamin Graham and David Dodd. Since then, the approach has developed and flourished in the hands of a notable but relatively small group of investors, the most famous of whom is Warren Buffett, who was their student in the early 1950s. As initially defined by Graham and Dodd, value investing rests on 3 key characteristics of financial markets. 1. The prices of financial securities are subject to significant and capricious movements. Mr. Market, Graham's famous personification of the impersonal forces that determine the price of securities at any moment, shows up every day to buy or sell any financial asset. He is a strange fellow, subject to all sorts of unpredictable mood swings that affect the price at which he is willing to do business. 2. Despite these gyrations in the market prices of financial assets, many of these assets do have underlying or fundamental economic values that are relatively stable and that can be measured with reasonable accuracy by a diligent and disciplined investor. In other words, the intrinsic value of the security is one thing, the current price at which it is trading is something else. Though value and price may on any given day be identical, they often diverge. 3. A strategy of buying securities only when their market prices are significantly below the calculated intrinsic value will produce superior returns in the long run. Graham referred to this gap between value and price as the margin of safety. Ideally, the gap should amount to about 1/2 and not be less than 1/3 of the fundamental value. He wanted to buy $1 for 50 cents. The eventual gain would be large and, more important, secure. Starting with these 3 assumptions, the central process of value investing is disarmingly simple. A value investor estimates the fundamental value of a financial security and compares that value to the current price at which Mr. Market is offering it. If price is lower than value by a sufficient margin of safety, the value investor buys the security. We can think of this formula as the master recipe of Graham and Dodd value investing. Where their legitimate descendants differ from one another, where each may add his or her unique flavor, is in the precise way they handle some of the steps involved in the process. Selecting securities for valuation, estimating their fundamental values, calculating the appropriate margin of safety required for each security, deciding how much of each security to buy, which encompasses the construction of a portfolio and includes a choice about the amount of diversification the investor desires, deciding when to sell securities. These are not trivial decisions. To search for securities selling below their intrinsic value is one thing, to find them, quite another. It is because the Graham and Dodd descendants have devised a variety of approaches to these tasks that value investing has remained a vital discipline through all market conditions in the more than 8 decades since Graham and Dodd first published securities analysis. What value investing isn't. A common and brief summary of value investing is that value investors search for and buy only bargains, securities selling for less than their true or intrinsic values. There is a problem with this simple definition. No rational investor admits to searching for securities selling for more than their underlying value. Everyone is looking to buy low and sell high. We need to be clear about what differentiates real value investors from all the others who trade in the securities markets. One large class of investors who obviously do not qualify are technical analysts or technicians. Technicians avoid fundamental analysis of any kind. They pay no attention to a company's line of business, its balance sheet or income statement, the nature of its product markets, or anything else that might concern a fundamental investor of any stripe. They care nothing for economic value. Instead, they focus on trading data, that is, the price movements and volume figures for any security. They believe that the history of these movements, reflecting the supply and demand for that security over time, traces patterns that they can analyze to infer future price movement. They construct charts to represent this information, and they scrutinize them for signs that will predict how prices will move next, and thus allow them to make a profitable trade. For example, momentum investors extrapolate the current price trend, buying securities whose prices are rising in the expectation that they will continue to go up. Sometimes they compare the day's price for the security to a trend line made up of a moving average of the last 30, 90, 200, or some other number of days' prices. Crossing that trend line, up or down, can indicate a change in direction. Surely they intend to buy low and sell high, but low and high here refer to the previous and future prices of the security, unconnected to its fundamental value. For technical investors, Mr. Market is the only game in town. It is also a game that lends itself to trading, buying and selling over a short term. Very few traders ignore technical information. Today's chartists are much more likely to use sophisticated computerized algorithms to detect patterns and to search for those patterns among different security prices rather than focus on the price history of a single security. But like most technicians, they are at best marginally interested in the fundamental economic value of the businesses underlying the securities. Even when we turn back to people who legitimately see themselves as fundamental investors, concerned with the real economics of the companies whose securities they buy, Graham and Dodd value investors are distinct. We can divide the class of fundamental investors into those who focus on macroeconomic issues and those who concentrate on the microeconomics of specific securities. Macro fundamentalists are concerned with broad economic factors that affect the universe of securities as a whole, or at least in large groups: inflation rates, interest rates, exchange rates, unemployment rates, and the rate of economic growth at the national or even international level. They closely monitor the actions of policymakers, like the Federal Reserve Board, and aggregate investor and consumer sentiment. They use their information to forecast broad economic trends. And they then use the forecasts to decide which groups of securities, or even individual issues, are likely to be most affected by the changes they predict. Their approach is often referred to as top-down, starting with the overall economy and working down to specific industries and securities. Like every other investor, they intend to buy low and sell high, using what they hope as their superior predictions to trade before the market as a whole recognizes what is happening. They do not, as a rule, do direct calculations of the value of individual securities or particular classes of securities, though such calculations could be consistent with a macro fundamentalist's approach. Although there are some famous and successful macro value investors in the Graham and Dodd tradition are basically micro fundamentalists. Within the Society of Micro-Fundamentalists, those who analyze the economic fundamentals of companies and look at securities one by one, value investors in the Graham and Dodd tradition are still a minority. A more common approach to micro-fundamentalist investing takes the current price of a stock or other security as the point of departure. These investors study the history of this security, noting how the price has moved in response to changes in those economic factors that are thought to influence it: earnings, industry conditions, new product introductions, improvements in production technology, management shakeups, growth in demand, shifts in financial leverage, new plant and equipment investments, acquisitions of other companies, and divestitures of lines of business, and so on. There's more than enough to examine. They then try to anticipate how the critical variables on this list are likely to change, relying in large measure on company and industry sources, as well as their more general knowledge. Most forecasts focus on company earnings. Security prices incorporate the market's aggregate prediction about future earnings. If these investors find that their estimates of future earnings and other important variables exceed the market's expectations, then they purchase the securities. They assume that when new information about earnings and other matters are released, their predictions will be validated, and the market will drive up the price of the securities. They have bought low based on a superior estimate of the future, and they intend to sell high. Though this approach shares with value investing a concentration on economic fundamentals and specific securities, there are major differences. First, it focuses on prior and anticipated changes in prices, not on the level of prices relative to underlying values. One could apply this analysis equally well to a stock trading at 10, 20, or 50 times forecast earnings. A value investor would not regard these situations as equivalent. Second, this approach does not incorporate an identifiable margin of safety to safeguard the investment from Mr. Market's capricious behavior, which, after all, has been known to sink the price of shares in response to good news. So while Graham and Dodd value investing is most frequently a micro-fundamentalist approach, not all or even most micro-fundamentalists are value investors. Each of these alternatives to value investing can lead to a successful investment record, provided it is carefully and diligently pursued. Statistical studies increasingly suggest that security prices and volumes do trace consistent and recognizable patterns. There are positive serial correlations in the short run and reversion to the mean over the longer term. There are successful technical investors. Macroeconomic variables can be forecast with some accuracy and will affect securities markets in systematic and identifiable ways. There are successful macro-fundamentalist investors, analysts who energetically pursue information from company and industry sources, ferreting out trends ahead of the pack, should in theory, and sometimes do in practice, obtain above-average investment returns. Another approach to investing outside the value tradition rejects all these possibilities. It arose from modern portfolio theory and its sibling, the efficient market hypothesis, which were developed in academic finance departments beginning in the 1960s. The underlying premise of the theory is that current prices for securities, which are set by the collective perceptions of all market participants, accurately incorporate all the legally accessible information about future prices and values. Misperceptions and non-rational decisions are assumed to be essentially random. Excessive optimism, for example, on the part of some investors, would be offset by excessive pessimism on the part of others. Correct perception, by contrast, being shared by many energetic and intelligent investors, would determine market prices. These prices would reflect the best forecasts of future developments affecting the company's value. As a result, future price movements would depend either on random investor behavior or relevant new information that could not have been anticipated. Given these assumptions, future price changes would be unpredictable, and current prices would be the best predictor of average future prices. All attempts by individual investors to outperform a portfolio based on current prices would be futile, since all changes would be random. Now, given this view of security markets, the wise investor should focus on minimizing transaction costs and managing risk. The first task of risk management is to fully diversify away the idiosyncratic risks of individual investments, much as a risk-averse oil wildcatter drills a lot of holes to minimize the prospects of coming up dry by drilling only the few that look the most promising. For securities, this approach means buying a proportionate share of all the available risky securities to obtain the market return. Second, the remaining risk, the systematic risk, which cannot be diversified away because it is the risk of the entire market, can be managed by combining market portfolios with investments in a risk-free asset, normally short-term government debt. By adjusting the proportion of overall wealth allocated to the risk-free asset, investors can obtain the exposure from all-in risk-free to all-in-the-market portfolios that suits their appetite for risk. Should some individual investments offer a better risk-return trade-off than the market portfolios, well-informed investors would crowd into those opportunities. By driving up their prices and thereby lowering future returns, this activity would bring all prices back into the risk-return alignment that the efficient market theory posits as the normal condition. In the end, for investors who believe in market efficiency, the investment process consists of decisions about asset allocation, the right combination of risk-free and market, and minimizing transaction costs with index mutual funds and exchange-traded funds, ETFs. Extensive empirical evidence has largely discredited the strong form of the efficient market hypothesis, as some individual managers and firms have outperformed market portfolios over long periods of time. In addition, portfolios selected by simple statistical rules, such as those with lowest book-to-market value, have significantly outperformed market portfolios with no apparent increase in risk over extended subperiods, 15 years or so, going back to the 1920s in the United States. The same results hold true, with a few exceptions, for overseas markets throughout the periods for which adequate stock market return data has been available. Nevertheless, there is one important sense in which markets are inescapably efficient. The average return earned by all investors, weighted by assets owned in any asset category, must equal the average return on the assets that make up that category. For example, the total of the returns that investors in the U.S. stocks earn in any given period must be equal to the total return produced by U.S. stocks in that period. All these stocks are owned by somebody, and any related derivatives net out, e.g., for each short seller who does not own the shares in the question, there is a corresponding buyer of those non-existent shares. Since the total value of stocks at any moment must also equal the total value of investors' stock holdings, the average percentage return earned by investors in U.S. stocks must equal the average percentage returns produced by the U.S. stock market as a whole, the market return. This means that if some investors outperform the market in question, other investors must underperform by an equal amount. Before transaction costs, security trading is a zero-sum game. With transaction costs included, it becomes negative-sum. A way to think about this constraint, one that should focus attention on its implications, is to recognize that every time you buy a security because you expect an above-average return, someone is selling it to you because they think the return will be below average. at least one of you will always be wrong. If the security does nothing, you will both lose the transaction costs, and one of you the foregone return on the risk-free asset. It should not come as a surprise, therefore, that when we take the effort and expenses into account, 80 to 90% of active fund managers have done worse than the efficient market strategy of buying low-fee index instruments. This inescapable reality is the most important feature of active investing, one that an active investor should never forget. An active investor must be able to identify convincing reasons why he or she will be on the right side of the trade more often than not. Why, in other words, you will earn above average returns. If you can't make that case, then investments in appropriate index funds make sense. We can acknowledge the effectiveness of index funds, known as passive instruments, because they seek only to mimic the market, not beat it, and make no investment decisions other than to be invested or not, without subscribing either to the idea that the price Mr. Market offers for a security is always the best measure of its fundamental value, or that no investment approaches will outperform a passive approach over time. Does value investing work? The case for value investing must confront this zero-sum constraint. The argument has both theoretical and empirical dimensions. We develop the theory in our detailed discussion of the procedures of modern value investing. Empirically, the historical record confirms that value investing strategies have worked. Over extended periods, they have produced better returns than both the leading alternatives and the market as a whole. Three distinct sources provide evidence of this superiority in practice. The first comes from a battery of mechanical selection tests. A researcher typically sorts all the stocks in the universe they have defined on a measure of value, such as a market price to the book value of the equity or market price to earnings. They group the sorted stocks into buckets, frequently deciles, from the cheapest value to the most expensive, glamour. They record the total returns for each bucket over a defined period, usually 1 year. Then they repeat the process for a number of years. At the end, they have the returns over a long period of time. Some go back 90 years, and can see how a mechanical value strategy has done relative both to the glamour stocks and to the market as a whole. Many studies have been conducted employing different versions of this approach. The results demonstrate almost invariably that the value portfolios produce better than average returns. Average here meaning returns on the entire market in almost all periods and all kinds of markets. Using Kenneth French's market-to-book data, the return of a portfolio that was long the cheapest 30% of stocks and short the most expensive 30%, a zero-cost portfolio before transaction fees, had a compound annual return of 3.35% from 1927 through 2018 on the gross amount invested in each bucket for an overall portfolio requiring no net investment. The outperformance has diminished since the publication of the article. Low price-to-earnings portfolios have had a similar success. Portfolios constructed of highly priced stocks, measured by market-to-book and price-to-earnings ratios, have done poorly. They are highly priced mainly because the companies have experienced rapid sales and earnings growth in the recent past, hence the label glamour. Unfortunately, all of that success and expectations that it will continue have already been incorporated into the stock price by the time the portfolios are constructed. These mechanical selections of stocks produce portfolios that look very much like those that a diligent value investor, analyzing stocks one by one, would construct, especially as value investing was practiced in its early period. But value investing is not the same thing as a mechanical approach, a computer program that selects stocks on the basis of a statistical measure that indicates which ones are cheap. Calculations of intrinsic value are usually more intricate and require more detailed knowledge of company and industry economics than are disclosed by simple financial ratios. Nevertheless, the striking historical success of these value portfolios produced by mechanical selection should remind us of the high standards that an active value investing strategy must meet. According to Standard & Poor's, more than 80% of active fund managers underperformed their market benchmark over a 5, 10, or 15-year period ending in June 2018. In that 15-year period, the S&P 500 returned 9.3% a year. The cheapest quintile of stocks sorted by earnings to price returned 11.8%. It is reassuring, therefore, that investment management institutions that have adopted systematic value strategies in the Graham and Dodd fashion have returned records that outperform the market as a whole. The performance of these institutions is our second source of support for the argument that value investing produces superior returns. Unlike the mechanical studies, which are back tests of selection rules applied to historical data, these institutions have generated real returns for real clients. Value investing works in the world as well as the lab. Finally, among those notable investors who have earned returns well above market indices over long periods of time, value investors who trace their intellectual origins back to Graham and Dodd are heavily overrepresented. The most famous of these is Warren Buffett. The list also includes many of the investors profiled in this book, those identified by Buffett himself in his 1984 article, The Super Investors of Graham and Doddsville, and others who have pursued value strategies without necessarily publicly embracing the Graham and Dodd tradition. The theoretical case for value investing starts with the zero-sum nature of investing. A consistently superior approach must succeed at the expense of investors who underperform the overall market. This success should rest on advantages at every stage of an active investment process, whether value-oriented or not. The process consists of 4 basic steps. The first step is to craft a search strategy. No investor can look carefully at all of the thousands of investments available in the world today. They must identify an intelligently selected subset of the entire group to examine. Ideally, this subset will contain a disproportionate number of opportunities that will more often than not put our investor on the right side of the trade. Some search strategies are determined by the nature of the investment firm. For example, a firm or fund that invests only in U.S.-listed convertible bonds has the origins of a search strategy built into its investment mandate. An investor who seeks out U.S. equities with attractive growth prospects, either with statistical screens or less formally by reading the appropriate literature, going to conferences, or talking with like-minded colleagues, has a search strategy. At a minimum, a good search strategy should answer the questions of why you are looking at a particular investment and why, given the opportunities identified by the search, you are likely to be on the right side of the trade it identifies. After the search strategy identifies a security for detailed investigation, the second step of the process is to decide what it is actually worth. This step is valuation. Whether valuation is done explicitly or implicitly, for example by picking stocks whose values are expected to increase, any investment decision must be based on the judgment that the future value of the security exceeds the price at which it can be purchased today. The various methods of valuation, like the alternative ways of conducting search strategies, define the investor's underlying approach. And technical investors assess future values based on prior price movements and trading patterns. Short-term fundamentalists adjust today's price for their estimate of near-term future developments at either the macroeconomic or individual security level. Efficient market investors default to today's price as the best measure of value. The point here is that everyone has a valuation rule. They are not all equally successful. The test of quality is the returns the investor earns by taking one side of the trade against someone whose valuation measure produces different, less accurate estimates. Most useful valuation methods will identify important uncertainties related to the value of the security under examination. Professional investors will employ a systematic process of active research to resolve these uncertainties. The first characteristic of a well-conceived research process is that it is focused on those uncertain variables that most importantly affect valuation. Meeting this criterion requires a sound valuation approach that identifies these key uncertainties. The research efforts that are mechanically focused on a predetermined list of variables, unrelated to their relevance to the particular investment in question, will not be as efficient as those driven by a superior valuation methodology. Second, there is always significant indirect information available that may either confirm or challenge the initial valuation estimate. For example, has the chief financial officer recently sold all of his or her shares? Are other well-informed and disciplined investors buying or dumping the shares? What are the commonly held beliefs that underlie the current price of the shares, and why do you think your valuation is better than the consensus? Know yourself. How have you acted in similar situations in the past? Have you made decisions that look like this one? And how have they worked out? Are you, in other words, a sucker for certain kinds of stories? An effective research process will collect and analyze this relevant indirect evidence to an extent that is at least as comprehensive and efficient within the law as that of the people on the other side of the trade. Finally, having searched, evaluated, examined additional evidence to check the initial valuation, and made a decision, every investor needs a process for managing the risk that this investment adds to or reduces in the portfolio. What is the appropriate size of the position within the portfolio? Does it move in tandem with other holdings, or does it have a low or even negative correlation with them? Will it provide insurance in a crisis as gold, cash, and derivatives may do? Unlike the trading of securities, risk management is not a zero-sum game, especially when different investors face different risks. But even at this stage of the work, it is useful to think in competitive terms. Are your definitions of risks and the processes you use to manage it at least as good as widely employed and available alternatives? Our contention is that the approaches developed by Graham, Dodd, and their talented successors are at each stage of the process generally superior to the methods commonly employed by those outside the value tradition. We aim to convince the listener that not only does historical evidence, statistical studies, firm performance, and the success of individuals support a value approach to investing, but that until others develop alternative processes at least as effective as those of the Graham and Dodd community, value investing will continue to prevail in the future. The rest of the book. Part 2 discusses valuation in depth, with chapters on valuing assets, earnings power, and growth. 2 detailed analyses are incorporated: Hudson General as an example of an asset value approach, and Magna International for an earnings power valuation. Part 3 focuses on franchise businesses and a new approach to valuing growth in these firms. Again, there are 2 detailed examples, this time for franchise stocks, WD-40 and Intel. Part 4 discusses research strategies and risk management. In addition to the text between the covers of this book, we have been able to make available online some of the presentations delivered over the years in the Value Investing course at Columbia Business School, taught for a quarter century by Bruce Greenwald and now by Tano Santos. Some of the most extraordinary value investors have devoted time and effort to make these presentations, in some cases virtually annually. We are grateful beyond measure to them and the contributions they have made to the evolving discipline of value investing. Appendix. Is extra return the reward for extra risk? One final issue regarding the factual evidence in favor of a value approach must be addressed. It is certainly possible that the higher returns achieved by value investing from each of these three sources, mechanically selected portfolios, value-oriented institutions, and individual Graham and Dodd investors, arise only because these portfolios are riskier than the market as a whole. If that were so, then their superior returns would be nothing more than an appropriate reward for bearing this increased risk. Many academic financial experts have been emphatic in arguing not only that higher return is the reward for higher risk, but also that there is no way to beat the market's average return other than by assuming additional risk, and that the best way to add risk is to leverage the market portfolio, since no stock selection process will outperform the market. The problem with this argument is that when standard academic measures of risk, either annual return variability or betas as defined by market finance theory, have been calculated for value portfolios, they have generally been no higher than the same risk measures applied to the market as a whole. In addition, value portfolios have proven to be less risky than the market as a whole when tested by other measures of risk, such as how much a stock drops in reaction to bad news about the company, the extent of price declines during bear markets, or simply the level of maximum loss experienced. These measures are closer to our common sense understanding of risk and more appropriate for value investors who regard price fluctuations as opportunities to buy or sell, not as accurate estimates of the intrinsic worth of the security. For our mechanically selected value portfolios, which have been subjected to the most thorough statistical scrutiny, their average one-year returns have been higher, their average 3-year holding period returns have been higher, their average 5-year holding period returns have been higher, they have provided superior returns during recessions, and they have outperformed glamour portfolios during the worst months for the stock market as whole. The value approach, even in its mechanical application, is no fair weather friend. Looking at maximum losses, drawdowns, in the 30 years from 1989 to 2018, the S&P 500 had two major bear markets. August 30th, 2000 through September 30th, 2002, 45%. October 21st, 2007 through February 28th, 2009, 51%. As a comparison, using Kenneth French's cheapest quintile as measured by earnings to price ratio, the two largest were June 30th, 2001 through September 30th, 2002, 19%, March 31st, 2007 through February 28th, 2009, 51%. In one case, the value portfolio lost considerably less money. In the other, they were equivalent. The compound annual returns for the entire 30-year period were 9.2% for the S&P and 12.9% for the cheapest quintile. Using drawdowns as a measure, it is impossible to say that the value portfolio outperformed by assuming more risk. As another alternative approach to risk, we refer to Warren Buffett's classic account of how he came to buy a large chunk of the shares of the Washington Post Company. The date was late 1973. It was a miserable time for the economy, the stock market, the national temperament, and naturally, a great moment for value investors. The market capitalization of the Washington Post Company had dropped to $80 million. At that moment, the whole company could have been sold to any of 10 buyers for at least $400 million. Well, clearly, Mr. Market was in a dreadful mood. Now, Buffett asked, had the market value of the stock declined again from $80 million down to $40 million, would that have made a purchase of the shares more risky? According to modern investment theory, yes, because it would have increased the volatility of the prices. According to Buffett, not at all, because it would have increased an already ample margin of safety and lowered whatever risk, he thinks there was none to begin with, existed in the purchase. As a calculation of risk, the margin of safety has nothing in common with the volatility of a security's price. In order to use it, you have to acknowledge the existence of an intrinsic value and feel confident about your ability to estimate it. 2. Searching for value. Finding the right side of the trade. The investment world offers so many choices that any serious investor needs to carve out a limited part of that world before beginning his or her analysis. Either by design or by practice, investors must specialize. Specialization is the first, most important yet frequently overlooked factor in an effective search strategy. As an extreme case, consider a situation in which one investor has spent 20 years studying and investing only in South Texas Gulf Coast onshore oil leases. A second investor flies in from Europe and, based solely on the belief that in politically stable areas such as the United States, oil is a good investment, buys an oil lease from our local expert. Well, sometimes that investment will work out. Oil prices may rise more than expected, or the leased property may have output capacity higher than anticipated. But there should be little doubt that most of the time, the local expert will come out ahead on a trade with a counterparty whose focus is on the price of a global commodity. Specialization, particularly in markets that are not intensely followed by a large number of other investors, is an obvious way to improve the odds of being on the right side of the trade. We will take our own advice in the discussion here and specialize on only a portion of the larger investment universe. We will not address areas like government debt, exchange rates, broad market-level instruments like index mutual funds and ETFs, or commodities like oil, wheat, or copper, in which many investors are making decisions based on macroeconomic factors. In avoiding these markets, we mirror the practices of most Graham and Dodd investors. We will also ignore the very simple investment choices, such as bank savings accounts and certificates of deposit, where there is limited scope for a professional investor to add value. Finally, we will not discuss areas like collectibles or intricate derivatives, where specialization is essential, but the knowledge required is very narrow, specific, and outside the interests of most investors, whether value or otherwise. We will concentrate on corporate securities, primarily equities, where the central value questions are related to the fundamentals of the underlying business. Benjamin Graham and David Dodd started here, and most value investors have followed their lead. Specialization. A well-established principle of Graham and Dodd investing is to remain within one's circle of competence. No investor is capable of understanding every business in every industry. Warren Buffett has often stated that he has no understanding of technology firms. When he invested in Apple, it was an extremely successful consumer goods company. Since they are outside his circle of competence, investments he might make in those industries are unlikely to land him on the right side of the trade. A circle of competence delineates one's areas of specialization. Investors should always stay within the circle and regard the regions beyond as unprofitable territory. The key difference between establishing a specialization and identifying a circle of competence is that specialization works from the inside out, starting from a particular industry or geography or other narrow area of interest. Once that area has been mastered, an investor may move on to adjacent areas of interest, mastering them one at a time. A circle of competence is generally described from the outside in, beginning with a full set of investment opportunities and eliminating those beyond one's current understanding. Formally, the two may ultimately be equivalent, especially for experienced investors, but particularly for beginning investors, a process of specialization is likely to be a more efficient way to define and develop fields of investing advantage. Thus, in what follows, we will focus our search discussion on specialization rather than more traditional circles of competence. This description actually understates the power of intense specialization. High productivity through the division of labor that Adam Smith described in A Pin Factory has been a cornerstone of economic prosperity for more than 2 centuries. Individuals specialize in professions such as law, medicine, accounting, journalism, education, and almost invariably on a relatively narrow segment area within the profession, like patent law, labor law, family law, and white-collar criminal law. Surgeons don't treat infectious diseases, and heart surgeons do not replace hips. Managers usually spend the greater part of their careers in one industry. Professional athletes who excel in one sport, even Michael Jordan in basketball, are generally out of their league when they try another, like baseball. Firms that succeed in particular industries, and sometimes in specific geographies, have historically outperformed firms that try to do many things, conglomerates, or operate on a global basis. Walmart could not replicate its success when it expanded beyond North America. Even within a well-defined circle of competence, investors have generally performed better starting from a very narrow focus and working outward. Warren Buffett has been more successful investing in insurance, banking, old media, and consumer non-durables than in other industries. Within the investment profession, the most common form of specialization is by industry. Analysts on both the buy and sell side of the market are almost always industry specialists. They commonly cover industries like autos, banks, retailers, or software companies on an increasingly global basis. The challenge for both investors and analysts is that there may be long periods during which there are no attractive opportunities within any particular industry. Fortunately, a viable circle of competence can extend beyond a single industry. An experienced investor or analyst should be able to master several, but those who attempt to become experts in many industries are likely to be masters of none, which puts them at a disadvantage when they trade against investors more focused in each area. This view of specialization is considerably more restrictive than what is traditionally considered a circle of competence. Geographical specialization is another useful constraint. Focusing on firms within a particular region is an advantage, particularly for those who invest in small to medium-sized companies. First, for service businesses that operate locally, a regional focus allows the investor to monitor customers, suppliers, competitors, and local business communities at a level of detail that cannot be matched by investors who attempt to cover the industry everywhere around the globe. Second, a local presence eases continuous access to management. Visits can be more frequent within a restricted territory, and the investor can see more of the business's operations. Compared to those who rely on annual fly-ins for meetings at company headquarters, the locally focused investor is much better informed about the current state of affairs and better able to assess where the business is headed. Third, many regional economies have an industry specialization. Medical devices in Minnesota, pharmaceuticals in New Jersey, information technology in Silicon Valley, biotechnology in Greater Boston, so that regional and industry specializations may overlap. For smaller companies with less analyst coverage, these advantages may be particularly potent. When Warren Buffett was running the Buffett Partnership in the 1950s and 1960s, many of his most successful investments were in companies based in and around Omaha, often in insurance or related areas, not otherwise known as a hub of innovation or profitable investment opportunities. Specialization at the level of security selection need not conflict with the value of diversification at the portfolio level. The portfolio manager of a diversified fund can combine the choices of a group of analysts to run a product that has the benefits of both detailed industry or geographic knowledge and risk control features that come with diversification. At a higher level, the overall holdings of an institution or household can be more diversified across asset classes and yet be composed of securities selected by specialists operating within narrowly circumscribed circles of competence. Although reaching this goal by choosing the right investment managers is not an easy task, it is possible. We will address the challenge directly when we discuss risk management in Chapter 10. Most investment managers have resisted specialization in the manner we have described here, even though specialization represents the element of a search strategy that is most likely to put the investor on the right side of the trade. The value advantage. In the first chapter, we mentioned a number of studies that employ a mechanical approach to stock selection to test various investment styles. These studies use one or several variables to rank the universe of stocks at a given moment. Group these ranked lists into equally sized buckets and compare the investment returns of these groups, now considered portfolios, over future periods. And overall, these studies demonstrate convincingly that portfolios of stocks ranked high on value outperformed the market as a whole, and trounced portfolios ranked high on glamour, meaning they were expensive by the measure chosen. A few noteworthy examples will illustrate the nature of this research. As we noted in Chapter 1, in 1992, Eugene Fama and Kenneth French published a seminal paper intended to reinforce the efficient market hypothesis. Using data on U.S. common equities from 1963 to 1990, they sorted stocks into 10 groups based on book-to-market values from the lowest, glamour stocks, to the highest, value stocks, at the end of each year. They also sorted the same stocks based on size as measured by market capitalization. They then measured the monthly performance of each basket of stocks for the period July 1963 through December 1990. The average monthly return for the highest book-to-market decile was 1.63%. For the lowest book-to-market, it was 0.64%. The value decile outperformed the glamour decile by around 12% a year over the entire period. A similar, if slightly smaller, return difference emerged between small and large stocks. The smallest basket averaged 1.77% per month compared to 0.95% for the largest. Combining the two sorts to create 100 buckets, ranking from largest and most expensive to smallest and cheapest, added little to the picture. The smallest and cheapest averaged monthly returns of 1.92%. The largest and most expensive, 0.89%. Two findings of their work stand out. First, it is difficult to improve on a simple value strategy by adding additional variables. The cheapest decile outperformed the most expensive by 0.99% per month. Adding size, the smallest and cheapest yielded a premium of 1.03% per month, an economically insignificant gain of 0.04%, and one difficult to capture in practice because of the liquidity constraints imposed by small company shares. Second, most of the premium for value lies at the extremes. Going from the third cheapest decile to the first added far more to the return than moving from the eighth to the sixth. And the same pattern held at the glamour end. Moving from the third most expensive decile to the top detracted far more than moving from the middle to the third. In searching for value and avoiding glamour, it is the cheapest of the cheap you want to embrace and the most expensive you want to avoid. A second notable paper published in 1994 by Joseph Lakonishok, André Schleifer, and Robert Vishny replicated the Fama and French study over a slightly different period. It used earnings to price and cash flow to price as alternative measures of value. If findings are similar, the most extreme value portfolios outperformed the most extreme glamour portfolios by around 9% annually, regardless of the value metric employed. Adding a second dimension to the analysis, the authors sorted their universe of stocks into 3 groups based on price to cash flow and 3 based on sales growth over the prior 5 years. They found that the value stocks with the slowest rate of sales growth returned 21% a year on average, whereas the glamour stocks with the highest sales growth returned 11%. A third key study published in 1989 by Werner de Bont and Richard Thaler examined the impact of past stock market performance on returns going forward. At the beginning of each year, they sorted the universe by total market return over the previous 12 months. They focused on 2 buckets, one containing the stocks in the lowest decile of returns, worst performers, and the other were the stocks in the highest decile, best. They then tracked the difference between the returns of the 2 portfolios over the subsequent 30 months. Over that entire period, the 2 portfolio returns were approximately equal. Although in the first 12 months, the best prior performers continued to outperform, this is a well-established momentum effect, about which more later. They then repeated the process using the previous 24 months of returns to sort for the worst and the best performers. The most disappointing stocks over the prior 2-year period outperformed the high-return stocks by about 12% over the next 30 months. Finally, they formed portfolios from the stocks that had done the worst and the best over the prior 36 months. These long-term worst stocks earned returns on average of 18% above those of the best stocks over the subsequent 30 months. Again, the more extreme, in this case the most extended the period of underperformance, the greater the outperformance going forward. An extensive group of studies examining equity returns in the United States and overseas over longer time periods confirm these general results. Portfolios of ugly, disappointing, obscure, small, and boring, e.g. low-growth stocks, repeatedly generated higher returns than both the market as a whole and, more strikingly, portfolios of attractive, highly profitable, well-known, big, and glamorous, e.g. fast-growth stocks. Their low prices more than compensated for their unappealing characteristics. Moreover, as these studies demonstrate, especially that by de Bont and Thaler, it is the extremely unappealing portfolios, 3 years of disappointing returns, that produce the best results. The future returns of portfolios organized by market-to-book ratios increase steadily with the degree of cheapness. The cheapest decile bucket of stocks often see 2/3 of the companies go bankrupt. But the ones that do survive do so well relative to their very low starting prices that the ugliest portfolios are the best performing among all the buckets. In addition to these basic value/glamour measures, other variables have been studied to assess their impact on portfolio performance. They come in 3 varieties. 1, purely fundamental. 2, purely technical. 3, a combination that relates market price to a fundamental factor like price to book value or price to earnings. Those that use only fundamental variables refer only to a company's business performance, not the relationship between the performance and its share price. Studies have sorted stocks using returns on equity, or on total capital invested, growth in earnings per share, growth in assets as opposed to sales growth, and various measures of profit margins. Companies with high marks on these variables are successful firms whose shares are inherently attractive to investors. However, consistent with the studies we discussed before, it is often the firms that ranked lowest on these measures, low returns on capital or narrow profit margins, that have tended to generate the highest future market returns. At worst, these studies demonstrated little or no positive relationship between future returns and the quality of current firm performance. Michelle Clayman's telling phrase, "in search of disaster," has been a better investment guide than "in search of excellence." A supportive example of this phenomenon emerged from the widely read and much admired book, Good to Great, by Jim Collins. Collins selected 11 companies that transformed themselves from good to great. His selection was based on hefty stock market outperformance over the prior 15 years. He and his researchers identified the common characteristics that distinguished the greats from peers who did not make the transformation. The book was published in 2001. In the next few years, two of the great firms, Circuit City and Fannie Mae, managed to go bankrupt, in the case of Fannie Mae, in a spectacular fashion. For these two, good to great became good to great to gone. A second type of study examines stock market returns and trading volumes without reference to any fundamental data and looks for patterns like those in the DuBont and Thaler paper. This is technical investing, most commonly focused on price momentum. A frequently used metric is relative strength, which is simply the price performance of the stock relative to all other stocks in the pool. Choosing a portfolio of last year's best performing stocks is a bet that winners will continue to excel, and the bet has paid off. For the 40 years from 1979 to 2018, a portfolio that was long the prior year's best 30% performers and short its worst 30%, returned 4.2% annually. In the period since the recovery in 2009, when bull market returns belied traditional value measures, this momentum approach returned 2.8% per year. But momentum plays out fairly quickly. The French portfolios are rebalanced every month, and as DuBont and Thaler discovered, when stocks are selected on the basis of price change over 3 prior years rather than last year alone, the results are reversed. The worst do better. The high flyers fall back to earth. The downtrodden arise. We witness a phenomenon found so frequently in nature and culture, reversion to the mean. The children of tall parents do not on average exceed their parents in height. If they did, centers in the NBA would not command the salaries they do. And if prior winners in the stock market continued to outperform over sustained periods, their market capitalizations would rise to the sky, leaving behind any fundamental value that might support the share price. There are manias in the history of investment. They always collapse. The third type uses both financial and price variables to relate the price of the shares to some fundamental company information. Share price to earnings, share price to cash flow, share price to book value, share price to sales, share price to dividends, and more. The Fama French paper is in this camp, as is that by Laconishak and co-authors discussed before. In all of these studies, the value stocks, those with low share prices relative to each of these other variables, outperform the glamour stocks. These ratios offer slightly different snapshots of the same underlying picture. How many investors are willing to pay for the future success of the company, whether measured by earnings, cash flow, sales, net assets, or dividends? The less investors want to pay, the better the prospects of the shares, if not the company itself. Overall, the statistical evidence both for the United States and overseas markets paints a remarkably consistent picture. Embracing stocks that are ugly, boring, obscure, disappointing, and therefore cheap has historically been the best way to buy stocks, in which you are likely to be on the right side of the trade. These are the stocks that have outperformed the market as a whole. The uglier, more boring, more obscure, more disappointing, and therefore usually the cheaper the stock, the better the returns have been. That, at any rate, is the historical record. And that history, thanks in large part to studies we have cited and more we have not, is now widely recognized. The next and obvious question is whether this situation will persist. The argument in favor of persistence is the fact that the value premium, the return advantage of value relative to glamour stocks, which was first identified by Benjamin Graham in the 1930s and systematically quantified since the 1970s, appears not to have diminished significantly over time. Nevertheless, it is crucial to understand why value search strategies worked so well in the past and whether the forces responsible will continue to operate in the future. The anomaly of value and the nature of human behavior. Superior investment returns from value stocks over time constitute an anomaly. Once investors know that cheap stocks outperform expensive stocks, they should bid up the price of the cheap stocks and eliminate the superior performance. Yet the value premium has endured. There have been two distinct responses to the evidence that cheap stocks provide superior performance. One seeks to explain it, the other to explain it away. The explanation for why the value anomaly exists in the first place has been durable over time and is likely to persist into the future, lies in certain deeply embedded features of human behavior. These behaviors lead people to make decisions that violate rational economic calculations. They are apparent in activities like the ubiquitous popularity of lotteries that produce negative returns, a fact that virtually everyone knows, even as they buy their tickets. They have also been identified and investigated in the field of cognitive psychology, most notably by Daniel Kahneman and Amos Tversky. The field of behavioral finance is a direct outgrowth of this work. Three of these behaviors are particularly important for understanding the existence of the value premium. First, human beings have always been prone to overpay for the dream of getting rich quickly. Lotteries, as we mentioned, have been successful ventures in almost every society and in every period of human history for which we have a record. Yet lotteries are, and have always been, astonishingly poor investments. Lottery operators, whether governments or criminal associations, have taken between 30 and 70% of the cash paid in before distributing the rest to the winners. People who buy lottery tickets know that the odds are seriously stacked against them, but that knowledge has not made lottery tickets harder to sell. They have persisted, even when they have been made illegal. A broad cross-section of the population buys tickets. The appeal of instant riches is not confined to the poor or less educated. In the more sober world of equity investing, glamour stocks are the lottery tickets that hold out the promise of spectacularly high returns. Because of this appeal, some investors are willing to pay irrationally high prices relative to their fundamental values. This pattern came into sharp focus, at least after the fact, during the technology boom of the late 1990s. Established companies such as Intel, Microsoft, AOL, and Cisco, plus a large group of immature startups, commanded what were, in retrospect, absurd prices. But even during less frothy times, Glamour valuations are a regular component of equity markets. Sometimes it is national markets, such as Japan in the late 1980s or the BRICS in the 2000s. Sometimes it is specific industries, such as telecommunications or biotechnology. Sometimes specific companies, such as Apple or Cisco, that trade at prices inflated by their lottery ticket appeal. Investors who succumb to this widely shared attraction will, as a group, underperform the market as a whole. Given the zero-sum nature of investing, value investors who take the other side of these trades will outperform. As long as lotteries and their stock market equivalents retain their attraction, this source of the value anomaly is not likely to disappear. The second major behavioral feature contributing to the value anomaly is an inverse of the preference for lottery tickets. In investing as in life, humans avoid situations that look ugly, troublesome, and appear to offer a high probability of loss, and lack the perverse highs associated with more exotic forms of risk-taking, such as skydiving. In the field of behavioral finance, this trait of investors is referred to as loss aversion. For most people, the pain of an anticipated loss outweighs the pleasure of an equivalent gain. As a consequence, people will embrace highly risky choices to avoid certain losses that they would never countenance in exchange for foregoing certain gains. As a consequence, if offered a portfolio of stocks, 2/3 of which may go bankrupt, most investors will recoil in horror before considering the potentially enormous gains from the 1/3 that do survive, gains large enough to make the whole investment highly profitable. It should come as no surprise that these investors avoid ugly and disappointing stocks in the first instance, and for stocks that do turn sour when already owned, dump them reflexively on the market without careful analysis of the events that have given rise to the ugliness and disappointment. The natural consequence is that these stocks will be chronically undervalued. Being on the other side from this behavior should be comparably rewarding. Again, this kind of loss and/or ugliness aversion has been a part of human behavior for millennia and is unlikely to change anytime soon. The third psychological factor underlying the value anomaly is so deeply embedded in human behavior that it dominates discourse without widespread awareness of its impact. Humans have an innate tendency toward overconfidence. We embrace certainty and ignore alternative possibilities. In discussions of public policy issues, such as the presence of weapons of mass destruction in Iraq in 2002 to 2003, few talked of probabilities. The discussion was couched in the language of competing certainties. One side insisted that the weapons were there for sure. The other side insisted with equal certainty that they were not. Virtually no one ever addressed the issue in terms of probabilities, such as probability of 1/4 or 1/3 or 1/2 or 2/3. Framing the issue as a set of alternative probabilities was simply not part of the debate. After the fact, of course, they were either there or not there. But beforehand, no one knew for certain whether the weapons were there or not. Rational opinions should have taken the form of these kinds of probability statements. Both rhetorically and in their own minds, each side of the debate was radically overconfident in the likely accuracy of their judgments. Such overconfidence is a systematic human tendency. Overconfidence dominates investment thinking and discussion in the same way. When talking about good stocks with great prospects, advocates never say that they are likely to outperform average market returns 2/3 of the time. An investor who achieved that degree of accuracy over any significant period of time would be in the top 10th of 1% of all investors. They tout the stocks with absolute assurance, and are very surprised when they subsequently underperform the market. Those who recommend avoiding other stocks do so with the same degree of certainty. They talk of poor investments as dogs, not as stocks with at least some possibility of substantial gains. The effect of this overconfidence is to intensify the overvaluation of the glamour stocks, since the possibility of an unanticipated adverse consequence is implicitly minimized. At the same time, overconfidence amplifies the undervaluation of ugly and disappointing stocks, since their potential recoveries are similarly minimized or ignored. Overall, overconfidence works to magnify the return distortions between glamour and value stocks. Until evolution works to eliminate it as a human characteristic, the value anomaly is likely to persist. Overconfidence also adds an important temporal dimension to the value anomaly. In good times, overconfidence tends to lead investors as a whole to minimize potential negative future developments, much more than a rational calculation of probabilities would suggest. Investors extrapolate present favorable conditions into the indefinite future. Evidence of this practice appears in those recurring radical overvaluations in market prices that Robert Shiller has labeled irrational exuberance. In these periods, estimates of market volatility, which are implicit in the prices of derivative instruments, typically fall to historic and unrealistically low levels. In good times, option prices tell us that investors typically expect smooth sailing, when the historical record shows that on average, subsequent market movements have been exactly the opposite. In bad times, when prices have fallen and the economic outlook is gloomy, investors are doubtful that good times will ever return. They are overconfident in their pessimism. Then demand for option protection is correspondingly high, and options are expensive. In a very real sense, the neurotic extremes of Benjamin Graham's Mr. Market are a tribute to the power of overconfidence. Unless Mr. Market somehow settles down, either through finding the right bipolar medication or from a change in human behavior, intertemporal and thus cross-sectional value anomalies will continue to exist. Psychological experiments indicate how difficult it is to escape this overconfidence. In one well-known experiment, subjects looking through eye holes into a darkened room were asked to estimate the distance to a luminous square. Since they were not told the size of the square, squares of different sizes were selected at random and placed at random distances. They could not possibly give an accurate estimate of this distance. Yet subjects invariably gave a precise distance estimate in feet, and when asked to judge the likely accuracy of this estimate, gave error brackets that were small, e.g., plus or minus 1 foot. Faced with a situation of fundamental uncertainty, the subject reflexively embraced a high degree of certainty. In fact, their estimates of distance were completely unrelated to the actual positions of the squares, and their actual average errors far exceeded their error estimates. The experimenters then showed their subjects the squares of different sizes and explained that squares would be chosen at random. The experiment was rerun, and subjects continued to give precise estimates of the square locations. Their error estimates did increase, e.g., from 1 to 2 feet, but remained well below the actual errors. Overconfidence appears to be highly persistent, even in the face of contrary evidence that seems to be discounted via a mechanism known in the behavioral literature as hindsight bias, the "I knew that already" impulse. A large number of other experiments have been run with both experts and lay subjects who are asked to estimate present or future quantities. Both groups persistently overestimate the accuracy of their judgments, and if anything, the experts are worse than the lay subjects. A further issue regarding the past and future of the value anomaly concerns the organizational structure within which investment decisions are made. Individual investors may well continue to be subject to lottery preference, loss aversion, and persistent overconfidence. However, as most investment dollars are now in the hands of investment organizations, these organizations should, in theory, be able to put rules and structures in place that control aberrant or counterproductive individual behavior. Still, it is individuals working for organizations that make and implement these processes. These people have their own interests and agendas, some of which may not be in line with the interests of the organizations for which they work. They also have their own psychologies over which they may have little control. Organizational policy will always be in tension with the instinctual behaviors and incentives of both their own employees and their retail and institutional clients. Therefore, it makes sense to think about both organizational imperatives themselves and the behavior of managers within the organizations. When we do that, it will become clear that organizations are as likely to amplify individual behavioral biases as to reduce them. For organizations, investment biases are generally a consequence either of policy or size. We'll start with policy. Many investment organizations are prevented, whether by charter, by stated investment policy, or by legislative intervention, from owning certain kinds of stock. Shares of companies that engage in businesses deemed socially irresponsible, whether for environmental, health, or regime-related reasons, are off limits. If many funds adopt policies that compel them to avoid the same companies, the normal demand for these shares may be substantially reduced. Unless there are enough funds with socially irresponsible investment mandates, buy only stocks of tobacco companies, manufacturers of defective infant car seats, or polluters, shares of the dirty companies may be permanently undervalued as measured by current earnings or growth prospects. It will take a change in investment policy, a change in corporate social behavior, or a reorganization of the business to eliminate this prohibition and allow the shares to be revalued upward. So long as the prohibition is stable, the stocks may remain permanently depressed. The issue of size bias is more important and more interesting. Many funds cannot invest in small companies either because their mandates do not allow it, or more frequently, because they have too much money to manage, and small companies just can't absorb enough of it to make it worthwhile. If a diversified investment company, most mutual funds, with $10 billion to invest, wants to own stock in 100 companies, it needs on average to buy $100 million in each. Since the fund does not want, and is often not allowed, to own more than 10% of any company's stock, this limits the universe of investment choices to firms with market capitalization of $1 billion or more. The specific sizes of funds, the market capitalization of suitable firms, and the percentage of ownership will vary, but the impact of company size persists. Many funds simply cannot buy shares in small companies. For similar reasons, investment analysts within institutions will also concentrate on large capitalization opportunities. An insight into a $40 billion company that can absorb a $2 billion investment will be worth far more than an equivalent insight into a $400 million firm that can absorb only $20 million. The consequence is that coverage of and demand for small company shares will tend, all other things being equal, to be below that of large company shares, and small company stocks should be cheaper. Hence, the shares in small companies are cheaper, all other things being equal, than shares in large companies. Among the all other things that need to be held constant, growth prospects are the most important. Small companies typically have the opportunity to grow faster than large ones, which already control major segments of the markets in industries that are likely to be well developed. The only thing that small companies need do to qualify for large funds is grow. There are plenty of other investors out there to raise the value of the company's shares as its revenues and earnings increase. At some point, a small company with a market capitalization of $200 million has grown into a mid-cap firm with a capitalization of $1 billion. As it matures, it becomes an eligible purchase for more funds. Its shares are priced at less of a discount. It ceases to be an opportunity and emerges as a success. This cycle is one of perpetual renewal, and new small firms spring up to take its place in the shade. The shares of companies too small for big funds are always available on sale. A revealing example of the size bias, as it affects stock performance, concerns the record of corporate spin-offs. Sometimes a company rids itself of a division or other unwanted business unit by issuing stock in this new corporation and distributing them to existing shareholders. The shares in this spun-off company now trade on their own. In most cases, the new firm is small, especially when compared with the giant from which it has just been separated. Funds that owned stock in Giant now find themselves holding shares in new micro-enterprises with a market capitalization of $100 million. They may know little about the new business, but are certain of one thing: it isn't big enough for them to spend much time learning about it, since it is too small for them to buy. So they sell, dump the shares on the market, and pocket the money. Spin-offs are a wonderful opportunity for investors who are not constrained by questions of market capitalization. Since many of the shares are sold for reasons unrelated to the company's prospects, there are bound to be gems tossed away by the large funds for whom a small company's stock, though perhaps a potential star, is still a nuisance. Spin-offs intensify the small company bias. The ordinary small company has its shares ignored by the large funds. The spin-off has them actively sold off. This is only an extreme illustration of the organizational bias against the shares of small companies that has made them, over time, a fertile field for value investors. Client demands are a second influence on organizational behavior. Investment company managers, whose clients are individuals, must respond to the irrational biases of those individuals. Organizations who invest for institutions such as charitable endowments, pension funds, and family offices must answer to the non-investment professionals who often run those institutions, human beings with the usual individual behavioral biases. In marketing to clients, investment managers spend more time discussing their big winners, investing in Apple at $10 and seeing it subsequently go to $700, and devote less attention to their long-term average returns and to the investments that did not work out. The need for great stories to tell induces the organizational managers to over-invest in the same glamour stocks as individuals. When an organization discloses its portfolio holdings, clients are likely to judge them, at least partially, on the basis of their own loss aversion. Portfolios of troubled, disappointing stocks are a hard sell to clients. As a result, organizations are prone to window dressing by purchasing shares of respectable, high-growth, high-return stocks just before any disclosures are due. This behavior reinforces rather than offsets the tendency for such stocks to be overvalued and amplifies the undervaluation of the diseased and disappointing stocks that they avoid or sell before they disclose holdings. Finally, there is substantial evidence that institutional clients tend to remain with their existing investment managers unless these managers significantly underperform their relevant market benchmarks. The risk-minimizing path for organizations is to buy what everyone else is buying. This herding instinct reinforces the tendencies to buy stocks that are glamorous and have recently been successful and shun the value stocks that have disappointed. In the mid-1960s, these forces led organizational investors to focus largely on the Nifty 50 stocks. These were large, stable companies: IBM, AT&T, General Motors, Xerox, Morgan Guarantee, that both managers and clients saw as having high return potential with little risk. Between 1965 and the end of 1974, a Nifty 50 portfolio typically lost more than 80% of its value. But the lessons of investment history have a short half-life. The cast of managers and their clients changes rapidly. In 2015, all of the gains in the S&P 500 came from 4 stocks: Facebook, Amazon, Netflix, and Google. The Nifty 50 had become the FANG 4. Microsoft and Apple joined the select group in the next several years. Any management firm that did not join the chorus almost certainly suffered by comparison. Organizational imperatives, unless they change radically, appear unlikely to undermine the value anomaly in the future. The herding impulse is also felt by the individuals within investment companies who make the actual investment decisions. Money managers are employees hired to produce results by following prescribed investment policies. Though there may be rewards for original thinking that leads to extraordinary success, the safest path is to look pretty much like everyone else investing with the same mandate. The now antiquated adage of data processing managers that nobody was ever fired for buying computers from IBM applies as well to money managers. Nobody loses a job for average performance or for holding the same securities as the rest of the managers. If you stray and buy stock in a company that nobody else wants, the payoffs are skewed. Should the company recover and the stock rise, the praise is real but short-lived. If the company does poorly and the stock falls, everyone remembers that you chose that dog. The situation becomes most extreme toward the end of a reporting period, when managers, as we have noted, window dress their portfolios, dumping the stocks that have fallen in price and loading up on the past year's or quarter's successes. This pruning has the effect of driving up the price of currently successful stocks and depressing even further stocks that are already downtrodden. The pressures on individual managers within organizations largely mirror the pressures on the organizations themselves. They tend to reinforce rather than offset the value anomaly. Taken as a whole, these elements of human psychology and organizational behavior provide an explanation for the empirical data that has demonstrated the superiority of a value-oriented search strategy. Look for opportunities among ugly, disappointing, boring, obscure, small companies. As long as they continue to play their historical role going forward, the value strategy will continue to outperform, even after evidence about its exceptional performance has been widely disseminated. Thus, in a world where there are colossal rewards for uncovering discrepancies between the current price of a stock and its true, intrinsic, or ultimate worth, some discrepancies persist. These discrepancies outline the types of opportunities in which a searcher for fundamental value is more likely to be on the right side of the trade. Explaining away the value anomaly. The behavioral and organizational features that we have described are at the center of our efforts to explain the existence and persistence of the value anomaly. A second approach, to which we alluded earlier, is to try to explain it away. This approach assumes that the value portfolios are riskier than the market as a whole, which in turn is riskier than glamour portfolios. In a rational market, greater risk should be associated with greater reward. It is higher risks that explain the anomaly of above-market returns for value portfolios and lower risks that explain the below-market returns of glamour portfolios. Essentially, this explanation is defense of the efficient market hypothesis. But if the pattern of relative risk explains return variations, the risks at issue should be observable and measurable. Otherwise, how would investors know which stocks should command higher returns? By risk, here we are referring to volatility, accepting for the moment the meaning of the term as defined in the efficient market hypothesis. Unfortunately, for the efficient market theory, historical statistical evidence suggests that value portfolios have been no riskier than the market as a whole, and that glamour portfolios have, if anything, been riskier than the market. These results persist whether we use variance as the volatility measure or beta, comparing the responsiveness of the portfolio to changes in the market as a whole. To repeat, if volatility is our definition of risk, value portfolios have not been riskier, and glamour portfolios have been less risky than the overall market. A disciplined value investor, employing sound value approaches to risk management, should not hesitate to look for opportunities to produce higher than average returns in exchange for taking on theoretical, albeit undetectable and perhaps non-existent, higher risks. Search strategies in practice. In principle, specialization and value-based search strategies are complements and not alternatives. In practice, their relative weights depend on the particular mandate under which an investment manager operates. Managers with broad mandates, large cap global equity, United States fixed income, or responsibility for the greater part of the wealth of their investors, will necessarily have well-diversified, value-based search strategies. Even under these conditions, however, the benefits of specialization apply. Developing industry or geographic expertise will still enhance the chances of being on the right side of particular transactions. For investors with more restricted mandates, expected to hold portfolios with fewer and larger positions, specialization will be a necessary point of departure. But whether in industries or geographies, value principles still apply. Looking initially at small, boring, ugly, and disappointing firms within the parameters of a specialization will have all the advantages that we described before. Indeed, the advantage of specialized knowledge is likely to be even more significant with respect to value stocks when one is considering wounded companies. And the critical and difficult challenge is to distinguish those that are terminally ill from those that are only temporarily impaired. Specialized knowledge develops slowly over time. Older, more experienced investors will be capable of managing a greater range of specializations than newly minted ones. The experience of successful specialists suggests that at a minimum, it takes a concerted effort of 1,000 hours or more to develop a decent working knowledge of an industry. Given the other demands on an investor's or analyst's time, that translates into at least a full year to achieve an adequate level of mastery. The knowledge and experience that constitutes specialized expertise must be constantly nurtured and extended, especially in times of transition and uncertainty. For example, retailing has historically rewarded superior merchandising talent, such as the ability to create positive store experiences and select the right products. Successful retailers have generally been outstanding merchants. The rise of Walmart was built on the increasing importance of efficiency in local store operations, and especially logistics. Local market share, thanks to the density of stores, with the associated benefit of scale in local storage management, distribution, and advertising, all of which allowed for lower prices, became far more important than innovative merchandising, which is much easier for competitors to copy. The increasing importance of web retailing diminished the importance of store operations and elevated distribution logistics and order management into significant sources of retail success. Understanding the nature and pace of these transformations is essential for evaluating both the strengths of competitive positions and the competencies of individual retail managers, upon which successful retail investments depend. Only by continuously deepening one's retail specialization will an investor be able to keep abreast of such developments. A second benefit of continuous industry or geographic engagement is the cultivation of an improved network of industry contacts. Attempting to do everything oneself is not usually an efficient approach to investing or, indeed, any undertaking. Being industry-focused means following and repeatedly interacting with operating managers in a particular industry, which can produce a sharper understanding of their strengths and weaknesses and a better calibrated judgment of their opinions regarding industry developments. Maintaining productive relationships with other capable industry experts also has value, especially when these other experts have geographic focus different from one's own. Value-based search strategies come in two varieties, quantitative and qualitative. At one extreme, quantitative strategies seek to reproduce or improve on the laboratory portfolios whose outperformance constitutes an important part of the case for a value approach. These strategies use statistical measures of cheapness, size, price momentum, and industry/company level accounting information to build portfolios from the stocks within the value buckets that these variables have defined. Often these portfolios are modified to limit or overweight concentration in particular industries or geographies in order to control overall portfolio risk. Some quantitative managers adjust the underlying models generating these portfolios to respond to putative evolution in market conditions. These adjustments are not always successful. Some managers run portfolios for which these search strategies are not just the beginning, but also the end of the investment process. These quant value managers may have been successful, but the ubiquity of computing power and statistical expertise have allowed others to quickly detect the specific strategies, and by crowding in, curtail if not eliminate any quant advantages beyond a simple value approach. Other managers begin by using software and financial databases to generate lists of potentially desirable investments, from which they select certain companies for further detailed investigation. Basic measures of size, cheapness, and disappointment are used to screen for potential investment. This practice has limitations. On the one hand, given the large number of potential securities, even screens that employ three variables, e.g., small size, low market to book, low prior returns over the previous 2 years to limit the list, will produce a long, highly varied set of companies across many industries and geographies. Such a list may be dauntingly large. Also, it changes relatively slowly so that repeating the process at regular intervals does not add much. In practice, therefore, more useful screens are things like the new lows list on various markets that can be quickly and conveniently reviewed, since opportunities to buy at value prices usually arise from price declines. On the other hand, if screening is limited, say by industry or to large capitalization stocks, in order to produce a more manageable set of potential opportunities, experienced investors often find that they are already familiar with most of the names. Quantitative screening tends to be valuable more for novice investors than for veteran ones. Beyond specialization, Most value search strategies are commonly implemented informally. Start with industries in trouble, ones that appear disappointing, dispiriting, downtrodden. These are likely to trade at low multiples of value. Within industries, look for the same characteristics in firms, especially among smaller firms that are inaccessible to large investment funds and hence lack coverage by security analysts who need to get paid for their work. The company that has been doing the same thing for years, growing slowly and profiting modestly, is not going to spend its funds courting attention from analysts. A change in the fortunes of this kind of firm is more likely to go unnoticed than if it were doing something with a lot more flash. Undesirability has other signs. Companies in bankruptcy or suffering from severe financial distress are clearly undesirable, except to the knowledgeable investor who sees the real value of the assets and the business that may emerge after reorganization. And companies in industries that are suffering from overcapacity, a sudden increase in imports, general decline, or the threat of legislative or regulatory impairment may also be undesirable. Lawsuits, both current and potential, may make companies unattractive, and few things are more depressing than protracted underperformance. We're not referring here to a stock whose price drops by 50% in a week or even a day, but to one that has substantially lagged the market for 2 or 3 years. These indicators of undesirability identify potential areas of opportunity. As investors flee from bad news or poor performance, they discard stock at prices that may exaggerate the company's distress. Not always, of course. Sometimes things are worse than even the gloomiest analyst imagines, and the current low price of the stock is actually too high. But overreaction is frequent enough so that the informed and diligent investor may find bargains in the trash. There are securities that are mispriced because of institutional constraints or mandates and other temporary aberrations. When the Resolution Trust Company in the late 1980s and early 1990s disposed of assets it had acquired in taking over failed savings and loan companies, its aim was to get itself out of business and get these assets back onto the tax rolls. So investors who had the expertise and made the effort to value these assets, whether real estate, junk bonds, or the savings institutions themselves, were able to purchase them at sale prices. Though opportunities such as these are not everyday events, they happen with sufficient frequency to keep value investors attentive to the next opportunity. Finally, there are companies with divisions performing so poorly that the record of the whole company suffers. If the stock price reflects the earnings, often losses, of the whole company, then the only thing management need do to turn things around and boost the share price is kill the division. Most of these situations do not escape notice from the sharp eyes of Wall Street analysts, but there are always a few with situations that are novel or complicated enough to avoid detection. They await the value investor with the knowledge and time to disaggregate the company's results and spot the earnings potential. They require as well some catalyst to encourage the company's executives to rid themselves of the albatross and let the true value emerge. It doesn't always work out that way. We want to emphasize that all of this work is a starting point. The purpose of the search effort is to reduce the investment universe to a manageable size so that valuation analysis in depth can begin. The actual work of valuation and investment starts after the candidate opportunities have been selected, but a well-conceived search strategy plays an additional and essential role in the investment process. If, after careful analysis, an investment appears to be available at a large discount to intrinsic value, you always have to ask why. In a world of energetic, intelligent investors, this opportunity is being presented to you in particular. Why are you more likely to be on the right side of the trade? In the case of specialization, it is because you are particularly qualified to identify value. In the case of a broad value approach, it is because you have inoculated yourself against the behavioral and institutional biases that affect other investors. In both situations, the search strategy provides an important part of the case for any investment. 3. Valuation in principle, valuation in practice. Assets, earnings power, and growth, maybe. For a Graham and Dodd investor, valuation is naturally at the heart of the investment process. The same standard applies to a valuation process as to a search strategy. Is it better than the valuation practices being used by those on the other side of the trade? If Graham and Dodd valuations produce more accurate, better understood estimates of what you are getting for your money than widely used alternatives, then valuation is a second key step in the investment process in which value investors will have an advantage. Part of this advantage is rooted in the recognition that securities have intrinsic values determined by the fundamentals of the underlying businesses. In Graham and Dodd's time, much market activity was driven by speculation about how the trades of knowledgeable inside investors would influence future prices. Fundamental analysis of company operations was rare and applied largely to fixed income securities. Essentially, value was defined as tomorrow's security price, and market dynamics, technical analysis of a primitive type, were assumed to be the dominant factor in determining that price. As a prime mover behind the professionalization of security analysis, Benjamin Graham naturally assumed that his own attention to business fundamentals would give him a large advantage over the speculators on the other side of the trade. Even today, market-level technical and macro strategies, neither of which pays attention to specific company financials, still play a significant role in approaches to valuation and security selection. However, Graham's success has meant that attention to underlying business fundamentals is the rule rather than the exception. Yet there remain critical differences between fundamental analysis in the value tradition and much of what is being done today by people outside that tradition. One important difference is rooted in the time horizons of investors. Investors with short horizons, whether months, weeks, or even days, typically focus on changes in values, not on the level of those values. A large number of professional security analysts concentrate on forecasting changes in those business operating variables such as earnings, revenues, returns on investment, and product market shares, which are assumed to determine changes in the prices of securities. Because these are short-term forecasts, they generally take the existing levels of securities values as given by their market prices. If the analysts' forecasts are more optimistic than the market consensus, they anticipate that prices will rise in the short term and then buy the securities in question. If they are more pessimistic, they sell. From a Graham and Dodd perspective, this approach ignores vast amounts of pertinent information that would allow an assessment of the intrinsic value independent of the current market price, especially information related to a company's long-term prospects. If Mr. Market has temporarily inflated the price of a security, this will be neither recognized nor taken into account by short-term, forecast-driven valuations. For overvalued stocks, even optimistic forecasts that turn out to be accurate may produce disappointing returns if the starting price is too high. The opposite often holds true for undervalued stocks and pessimistic forecasts. Low purchase prices can produce positive returns, even if the company performance has not improved. Overlooking important information about the level of intrinsic value will put short-term investors at a significant disadvantage. Adherence to value investing as a discipline focus on measuring the intrinsic value of a security through careful analysis of business fundamentals from a long-term perspective. They believe opportunities for profitable investments are available when the current market price of a security deviates significantly from its intrinsic value. The essential task of the value analyst is to determine intrinsic value with enough accuracy to take advantage of the market's mispricing and to have the patience to wait for the market or some event, such as a takeover, to close the gap between price and value. This basic approach of comparing price to a fundamentally determined intrinsic value is far more widely practiced by investors than it was in Graham's time, including many who would not put themselves in the value camp. Competition for buying mispriced securities is significantly greater than in the past. But there are methods in abundance for estimating an asset's true value. We contend in this chapter that the Graham and Dodd approach, as it has been refined over the years by value practitioners such as Warren Buffett and others, remains superior to commonly used alternatives. The historical and likely future successes of a value approach arise from a superior valuation methodology, as well as a better search strategy. Common approaches to fundamental value measurement. Multiple valuations. The single most widely used approach to determining the value of a business's operation, and thereby the value of its securities, is a multiple valuation. A multiple valuation has two components. 1. Some measure of the distributable cash flow that is generated today by a business or security. 2. A ratio of value per dollar of this cash flow, the multiple, that an investor should pay to buy this cash flow from today forward. The product of the cash flow estimate and the multiple is a current estimate of the value of the business or security. The heart of a multiple approach is the selection of a measure of the distributable cash flow and the determination of the proper multiple to apply to that cash flow. In selecting a cash flow variable, analysts who have confidence in the accuracy of financial accounting take future net income to be an appropriate measure. Those concerned with the distorting impact of leverage and taxes use operating earnings, earnings before interest and taxes, or EBIT. Others who recognize that amortization of goodwill is often an accounting rather than a real cost add back amortization to produce EBITDA. Often analysts will apply the same logic, sometimes inappropriately, to depreciation and look at EBITDA, operating earnings plus depreciation and amortization. Analysts concerned that adding back depreciation ignores the investments required to maintain a business's capital assets and to support growth, money that is not available for distribution to owners, prefer free cash flow, usually defined as cash flows from operations minus investment spending. The multiple applied to any chosen measure of cash flow is generally determined by 1. Defining a set of comparison companies for whom the relationship of that cash flow to value should be comparable to the relationship for the target company being valued, and 2. Calculating an average ratio of market value to the cash flow variable in question for this set of comparables over an appropriately determined time period. The characteristics of the comparables will never exactly match those of the target company, so attempts are often made to adjust the multiple to account for any significant differences. Determination of an appropriate multiple will depend on the nature of a business's cash flows. Safe, stable, predictable cash flows should be more valuable than risky, unstable ones and should command higher multiples. Since stability and safety are impaired by high levels of debt, multiples should be lower for highly levered firms compared to those with little leverage. Better businesses with higher margins should have relatively higher multiples, both because they are likely to be safer and because they have better future business prospects. More generally, businesses whose cash flows are expected to improve in the future should have multiples above those of stagnant or declining businesses. This principle applies as well to businesses whose current cash flows are temporarily depressed by industry or economy-wide cycles. Their multiples may, in fact, appear elevated when they merely reflect investors' recognition that the cash flows will recover. Conversely, the cash flows of businesses operating at or near cyclical peaks should command lower multiples than they may currently exhibit. In all of these instances, the direction of changes in multiples are clear. Other business characteristics may have a more ambiguous impact on multiples. Good managements, for example, should enhance value per unit of cash flow. They will operate more carefully, lowering risk, and allocate retained earnings more effectively, enhancing future returns. Still, overall future business performance will depend on the quality of management in the future and how that compares to the people presently in charge. Here, careful reasoning produces counterintuitive conclusions. Firms with good management see that quality embedded in current cash flow measures. They are unlikely to get better. Firms with poor management, by contrast, have substantial room for improvement. Given these future prospects, it is bad managements that should command higher multiples, however obtuse that may initially seem. Making qualitative judgments about appropriate multiples in situations like those described before is only the initial step. Value estimates are necessarily quantitative, and multiples also must be quantitatively determined. A crucial part of this quantitative determination is the selection of the time period over which the average levels of market value to cash flow are calculated, especially when market multiples are inflated by excess optimism or lowered by excess pessimism. Current market multiples may be highly inaccurate. An alternative is to estimate average multiples using extended historical periods, e.g., periods encompassing 2 complete business cycles. But in changing business environments, these long-term averages may no longer be appropriate, and the resulting value estimates may be just as inaccurate as those based on current multiples. In practice, uncertainties in cash flow estimates and valuation multiples mean that plausibly computed multiple valuations may differ by as much as 100%. The net present value of current and future cash flows. Given the shortcomings of multiple valuations, the most common alternative is to use a net present value / discounted cash flow approach. In theory, the intrinsic value of any asset, whether an office building, a gold mine, a company selling groceries at the corner or over the internet, a government bond, or a share of Amazon stock, is determined by the present value of the disposable cash flows that the asset supplies to its owner. Net present value is properly calculated as the sum of present and future cash flows, both outlays and receipts, with each dollar of future cash flow appropriately discounted to take into account the time value of money. The term discounted cash flow, DCF, is used to describe the calculation. Graham and Dodd disciples accept the concept and the calculation of net present value, as do all other fundamental investors. The techniques are taught at every undergraduate and graduate school of business. Investment bankers and corporate financial officers use them. Governments depend on them to evaluate the returns from potential capital projects and other investments. Calculators are programmed to produce NPV figures, and electronic spreadsheets have financial functions that will do the work. NPV analysis is inescapable, but what is true in theory need not provide an appropriate model for measuring intrinsic value in actual practice. We can say, only partially in jest, that the practical value of NPV analysis should be discounted. The standard way of calculating NPVs, and hence intrinsic value, is to begin by estimating the relevant cash flows for the current and future years out to a reasonable date, perhaps 10 years in the future. Then one estimates, a rate for the cost of capital that is appropriate to the riskiness of the asset in question. The cost of capital determines the separate value per dollar of each future period's cash flow. Multiplying the estimated cash flows in each future year by these discount factors produces the values today, the present value of those future cash flows. The sum of the individual present values for the next 10 years is the present value of our foreseeable cash flows. The customary practice for dealing with the cash flows in the distant future is to come up with what is called a terminal value. The terminal value is invariably calculated by assuming that beyond year 10, or whatever year is the last for which we have done annual cash flow calculations, cash flow grows perpetually at a constant proportional rate. Under this assumption, the value of those cash flows, looking forward from the end of year 10, will be the projected cash flow for year 11 times a multiple. In theory, this multiple is equal to 1 divided by the difference between the cost of capital and the perpetual growth rate. For example, if we project a cost of capital of 10% and a growth rate of 5% a year, then the multiple is 1 divided by, open parenthesis, 10% minus 5%, close parenthesis, equals 20. In practice, any of the methods that we identified before for ratio valuations may be used to provide a multiple as either a supplement to or a substitute for this theoretical measure. Since we won't see this terminal value until we look forward from the end of year 10, we need to discount the terminal value back to the present. We add that to the NPV of our first 10 years of cash flows to get an intrinsic value for the current and all future cash flows. There is a serious inconsistency here between the precision of the algebra and the uncertainties infecting the variables that drive the model. We estimate rates of growth for the first 10 years, and then another growth rate from the end of year 10 to forever. This is a heroic, not to say foolhardy exercise. Suppose that in 2 or 3 years, the company faces more competition, technological challenges, a spike in its costs of materials that it cannot pass on to customers, or any of a host of reasonable possibilities that will curtail and may even eliminate the growth of its cash flow. Imagine how accurate our estimates are likely to be even for a stable company like Procter & Gamble or Pfizer, much less for dynamic firms like Netflix or Google. We also assume that our company will have access to long-term financing at a predictable cost of capital on an ongoing basis. Yet who knows today what lenders will demand in 5 years or how much potential equity investors will be willing to pay for new shares? Profit margins and required investment levels, which are the foundations for cash flow estimates, are equally hard to project accurately into the far distant future. Compounding the problem, valuations vary significantly if the underlying assumptions are off by only small amounts. Consider the terminal value and the cash flow multiple. If future perpetual growth is 4% and the future cost of capital is 8%, then the terminal value multiple is 25. 1 divided by, open parenthesis, 8% minus 4%, close parenthesis, equals 25. If our estimate is wrong by only 1% in either direction for the cost of capital and the growth rate, the terminal value multiple can vary from a high of 50, 7% cost of capital minus 5% growth rate, to a low of 16.7, 9% cost of capital less 3% growth rate. This is a range greater than 3 to 1, and in many, probably most, valuations, The terminal value is the dominant component of the total NPV. Investors are certainly aware of these difficulties, and there are ways of attempting to deal with them. One method, which certainly saves time and effort, is to simplify the valuation process by relying on multiple-based value calculations. This amounts to moving the terminal value calculation from a future year to the immediate present, a change that can hardly be expected to add precision and has all the problems of selecting the appropriate multiple we discussed before. Another widely employed approach to dealing with the uncertainties of NPV is to perform an exhaustive number of sensitivity analyses. Here the analyst varies the projected operating parameters of a company that determine the future cash flows, the growth rates in sales, profit margins, investments required per dollar of sales, the cost of capital, and then looks at the corresponding variations in the company's valuation. The purpose is to capture the full range of valuation possibilities. The problem here is that the range is usually large. Since the underlying parameters are linked together in complicated ways, it is not clear which of the many possible valuations is the one likely to materialize. Sensitivity analysis has the virtue of making explicit the unreliability of NPV estimates, but pointing out the problem is not the same as solving it. There are two things that can be said in favor of a net present value / discounted cash flow approach to valuation. First, it is theoretically correct. If we knew the expected future cash flows without error and the exact cost of capital at which to discount them, an NPV analysis would yield the proper intrinsic value. Second, it is in theory superior to ratio valuations, since as we pointed out before, ratio valuations can be thought of as just abbreviated NPV calculations. To the extent that there are practical problems with the NPV approach, they apply equally, if not more seriously, to ratio valuations. However, in practice, there are three fundamental problems with using NPV to calculate intrinsic value that make it a poor candidate for consistently producing valuation estimates that will prove superior to those made by the investors on the other side of the trade. The problems with net present value estimates. The first and most obvious problem with the NPV approach is that it largely ignores an important source of valuation information, the current balance sheet. Future cash flows are derived essentially from estimates of future income and cash flow statements. They track future operational flows. They pay little or no attention to the contemporaneous values of assets and liabilities on the balance sheet. Sometimes for firms in distress, an analyst will calculate a liquidation value using the current balance sheet to supplement the estimate of the net present value of future cash flows. But for going concerns, these calculations have little relevance. Yet the balance sheet is one of the best and often the most reliable sources of information concerning the value of any business enterprise. Balance sheet items can in general be examined directly at the time of the analysis, and useful collateral information can often be collected to calculate their current values. In contrast, future cash flow numbers are estimates whose accuracy can only be judged as actual operations unfold over time. This relative precision should be a major inducement to use current balance sheet information. Although the balance sheet may not always be decisive in making good investment decisions, it will be critical in a significant number of cases. In these instances, an investment analyst looking carefully at the balance sheet will have a distinct advantage over an investor who has ignored it. Investors who rely solely on NPV analysis and overlook balance sheets are more likely to find themselves on the wrong side of the trade than those who do pay attention to the balance sheet. The second major shortcoming of an NPV approach is that more often than not, the terminal value number dominates the overall value and thus becomes central to the investment decision. As we described before, terminal values are measured with large degrees of error. This should not be surprising since terminal values depend on cash flows in the far distant future, which are inherently difficult to predict. This problem is not the fault of the terminal value formula, but stems from the fundamental unpredictability of the cash flows that far into the future. The shortcoming of the NPV approach arises from this increasing uncertainty. The NPV is the sum of the present values of each of the individual future cash flows. Once the time value of money has been taken into account by the discounting process, all those individual cash flows are given equal weight. However, the near-term cash flows are measured with far more precision than those in the distant future. By weighting all cash flow present values equally, the NPV takes very good information, the near-term cash flow estimates, and adds it to very poor information, the distant future cash flow present value estimates. As any engineer will attest, the inclusion of bad information corrupts the whole. Large estimation errors in the bad information completely overwhelm the small estimation errors in the good information. By failing to segregate good information from bad, the NPV approach wastes the good information in forming its valuation estimate. Now, this is hardly a prescription for landing on the right side of the trade. Those who promote the use of DCF analysis have argued that this problem is significantly reduced by the effect of the discounting itself. The poorly estimated future cash flows are reduced more by greater discount factors than are the accurately estimated near-term cash flows, lessening their impact on the NPV. Although true, the effect of this greater discounting is limited for two reasons. First, there are many more distant cash flows, in theory infinitely many more, than there are near-term ones. Second, for growth companies or other assets whose returns grow over time, distant cash flows will be larger than near-term ones and will have more weight in the NPV calculation. The practical importance of these two factors is confirmed by the fact that terminal values, representing distant future flows, typically dominate NPV valuations. A final fundamental problem with the NPV approach is a little more subtle. In the abstract, a valuation process is a machine into which an analyst puts current variables and assumptions about the future. The analyst turns the crank, and the machine spits out an estimate, or a range of estimates, of the value of the asset in question. The quality of these estimates depends critically on the quality of the assumptions that are fed into the machine. Assumptions that are by nature subject to significant errors are rarely going to produce estimated values that are not equally subject to large errors. The assumptions that go into an NPV evaluation machine are all particular numerical variables. The level of estimated cash flow in each future year is usually calculated based on assumptions about numerical revenue growth rates, gross profit margins, operating profit margins, effective tax rates on corporate or partnership earnings, capital investments requirements needed to support growth, driven by numerical estimates of fixed and working capital intensities, and predictions of the cost of capital that determine discount factors. These individual parameters are difficult to estimate with precision, especially for distant future periods. Moreover, because these numbers are highly correlated over time, these errors tend to accumulate rather than cancel one another out when computing an NPV. Given the inherently low quality of these estimates, calculated NPVs are subject to large margins of error. Of course, if this is the best that investment analyst can do, then however poor, NPV estimates would be no worse on this account than other alternatives. However, there are things we know about the future of a business with far greater confidence than we can know the particular numerical values that go into an NPV machine. We may not know the future of Ford's sales, margins, capital intensities, or cost of capital 10, 20, or 30 years from now, but we do know with some confidence that there will be a viable global automobile industry. In the late 1960s, a major consulting firm was asked, in connection with the establishment of the Urban Mass Transportation Administration, to forecast the long-term future of transportation in the United States and the world. The report concluded that in the years 2010 through 2020, transportation would consist largely of individually directed vehicles operating on multi-use rights-of-way. In other words, cars, trucks, and buses operating on roads. But 50 years later, that prediction has been borne out. The future today looks very similar going forward, even with self-driven/electric/shared vehicles. Also, there will almost certainly be a viable North American automobile production industry. The advantage of offshore production has rested on lower labor costs. The offsetting disadvantage has been in higher transportation cost and being further removed from final customers. As productivity in auto manufacturing, indeed in all manufacturing, continues to improve rapidly, required labor inputs will fall. The net impact can be dramatic. In the early 1980s, when General Motors initially got into trouble, it had 360,000 workers in North America. Today, producing roughly half as many vehicles, it is heading toward 20,000. As labor input per car shrinks, the benefit of cheaper labor becomes less significant. Transport costs and the benefits of being close to the consumer are changing at a far slower rate. As a result, manufacturing, but not manufacturing employment, is returning and will continue to return to developed economic areas such as North America. Ford, as a North America automobile producer, will continue to be an economically viable operation in the future. A final aspect of the Ford Motor Company's future that seems predictable is the degree of competition it will face. For the past 30-plus years, the market for automobiles has been global and highly competitive. None of the large auto companies, including Ford, have had technology, operating scale, or access to customers that have not been available on essentially equal terms to other large companies. In this market, returns on invested capital have on average been at or near these companies' cost of capital. Given this history, it seems unlikely that Ford will be able to establish sustainable competitive advantages in the future. It is equally unlikely that Ford will have to operate at a long-run competitive disadvantage. These are the strategic judgments regarding industry and company viability and competitive positions that we can reliably make about an extended future. An effective valuation machine would be able to integrate such assumptions directly and clearly into its estimated values. Unfortunately, there is no simple and obvious way to accomplish this feat in the context of the NPV framework. A superior alternative approach would be one that, 1, integrated all the significant value information, especially from the balance sheet. 2, organized the components of value by the reliability with which they can be estimated, ideally from most to least reliable. And 3, made clear the implications of broad strategic assumptions for estimated levels and components of value. The Graham and Dodd approach to valuation avoids the problems inherent in the NPV approach as currently practiced. It examines all the accounting information, especially a firm's balance sheet. It segregates information by reliability grade, so that good information is not contaminated by poor information. Finally, it directly integrates broad strategic judgments about competitive positions into the valuation process. This does not, however, mean that DCF valuations are never appropriate. When an investment project involves future returns that are well-defined and likely to be realized within a short time period, then an NPV approach will often be the best available since the problems we have identified will be limited. Much event-based investing in takeovers, corporate reorganization, bankruptcies, and the like will meet these criteria and is an area where an NPV approach is appropriate. The larger lesson here is that a one-size-fits-all valuation approach, which DCF often purports to be, is not a sensible way to measure how much value you are getting for your money. A three-element approach to valuations: assets, earnings power, profitable growth. The skepticism with which Graham and Dodd investors regard NPV calculations might be nothing more than a worldly cynicism toward all systematic efforts at valuation if these investors did not offer an alternative approach that avoids the pitfalls of the NPV approach. Fortunately, they have developed a valuation method that meets our three standards. It is based on a thorough grasp of the economic situation in which a company operates. It puts more emphasis on information about the firm that is solid and certain, and it values the company's future prospects with more realism and less optimism than is customary on Wall Street. It refuses to pay anything for even the rosiest prediction that has no current or historical foundation. In the late 1990s, Charlie Munger of Berkshire Hathaway said that if he were giving a test calling for an analyst to value a new .com internet company, he would fail anyone who answered the question. Some .coms did grow into their enormously high valuations, but most of them disappeared. To quote Wittgenstein, "Whereof one cannot speak, thereof one must be silent." Of what, then, can we speak? Let's go back and look at Ford. It would be rash to predict its cash flow in 2030, but there are some things we can state with confidence. Element number 1, the value of the assets. The natural place to start is with the most reliable information we possess, information about the present state of the company. This state is presented on the company's balance sheet. Following Graham and Dodd, we will speak first about the net asset value of the firm as revealed in the balance sheet at the end of the most recent operating period, or periods, if seasonal variations are significant, as determined by the company's accountants. We know that these accounting values are going to be more accurate for some assets than others. Thus, as we work down the balance sheet, we accept or adjust the stated numbers as experience and analysis dictate. Because of accounting principles and tax regulations, certain assets, a product portfolio, trained workers, customer relationships, or local business franchises do not even appear on the balance sheet. They are nevertheless important parts of the assets of a firm, and they must be valued. To estimate them with adequate precision requires the development of techniques often based on detailed industry expertise. The value analyst who has mastered these skills is collecting important information that is being ignored by most other analysts, raising the chances of being on the right side of the trade. We do the same for the liabilities side of the balance sheet, including appropriate adjustments to accounting entries and estimates of unlisted but real liabilities. At the end of the process, we subtract liabilities from assets to obtain a current net asset value, essentially the book value of the equity, properly adjusted. There's no need for us to forecast the future. The assets and liabilities exist today. Many of them are tangible or quasi-tangible, such as money in the bank account as confirmed by the bank, and these can be valued directly with great precision. Starting at the top of the balance sheet has another advantage. As we work down the asset accounts from cash at the top, whose value is unambiguous, to various intangible assets, whose value is often highly uncertain, we recognize the decreasing reliability of our estimated values. Graham himself preferred to rely entirely on current assets that could be realized within a year, and whose accounting values did not vary far from the actual cash that could be obtained by liquidating them. He subtracted all the firm's liabilities from these current assets to arrive at his famous net working capital figure for the value of the company. The results of an asset valuation depends on the principles employed to assign or adjust values to each asset and liability type. Here, strategic judgment directly and significantly enters the process. If an entire industry does not appear economically viable in the future, or if a specific firm is situated in a part of the industry where it is unlikely to survive, then assets and liabilities must be valued at what they are likely to bring in liquidation. This situation will arise whenever an industry or a firm is in terminal decline. Under these circumstances, generic assets, cash, accounts receivable, raw material inventory, some multi-use buildings and equipment, can be more or less accepted at full financial statement value. More specialized assets, finished goods inventory, specialized plant and equipment, are likely to be disposed of for cash amounts well below the figures on the balance sheet. In the worst case, they will be valued at zero. Intangibles will often be worth little or nothing in liquidation unless they are associated with independent and profitable operating divisions. Graham and Dodd, seared by their formative experiences in the Great Depression, favored liquidation value as the safest approach to asset valuation. In the post-Depression years, they were able to find many opportunities to invest in companies selling at less than net working capital, having assigned a liquidation value of zero to all non-current assets. Fortunately, Depression conditions have turned out to be the exception rather than the rule. Almost all companies are in economically viable situations almost all the time. Under these conditions, the strategic assumption that will most often underlie our asset value procedure is one of future economic viability for which liquidation values are largely irrelevant. For example, as we noted before in connection with Ford, the North American automobile industry is not going away. If it is to continue doing business, it must invest in the assets, working capital, fixed capital, and intangibles that are essential to its business operations. As these assets wear out or become obsolete, they must be replaced, presumably at the lowest possible cost, given the existing state of technology. Otherwise, the industry will not continue operating and will not supply the goods required of it. We will refer to the sums that must be spent to maintain business operations as the reproduction cost of the assets. The asset values of a firm in a viable industry should be equal to this reproduction cost. If they were available for less, competitors could buy a firm's assets more cheaply than it would cost to reproduce them. Bidding among competitors for the firm would then drive the value of the assets up to reproduction cost. At the same time, the assets should never command more than the cost of replacing their function in the most efficient way possible, since no intelligent investor would pay such a price. The process of actually estimating asset reproduction values involves working down the balance sheet from working capital to fixed capital to intangibles, whether listed or not, on the asset side, and taking a comprehensive view of liabilities. Again, as in the case of liquidation values, the cost of cash, accounts receivable, and inventory is relatively easy to calculate and close to accounting book value. The farther down the list, the more adjustments may be required, but there are appraisers who make a living by valuing plant and equipment, so we are still dealing with a more solid value than estimates of earnings growth rates 10 years into the future. Most investment analysts do not look carefully at asset reproduction values. This is an area in which industry expertise and relationships with industry sources who have detailed knowledge of the net cost of reproducing the functions of existing plants, replacing depleted natural resource reserves, or acquiring new customers to compensate for those lost to natural attrition, will be especially valuable. Having the creativity and the energy necessary to develop techniques for estimating reproduction values is likely to lead to sustainable investing advantages. Element number 2. Earnings power value. The second most reliable measure of a firm's intrinsic value is the next calculation made by Graham and Dodd, namely the value of its current earnings properly adjusted. These can be estimated with more certainty than future earnings or cash flows, and they are more relevant to today's values than earnings in the past, even though prior earnings will play a part in this estimate. To transform current earnings into an intrinsic value for the firm requires us to make assumptions both about the relationship between present and future earnings and about the cost of capital. Because we need to rely on these assumptions, intrinsic value estimates based on earnings are inherently less reliable than estimates based on assets. The traditional Graham and Dodd earnings assumptions are that earnings levels and the return investors require to justify an investment in those earnings, the cost of capital, are constant for the indefinite future. They assume that a business neither grows nor shrinks. Constant size means no net investment in either working or fixed capital. Thus, if the depreciation levels used in calculating earnings equal maintenance capital expense, estimated net income earnings should equal distributable cash flows. Graham and Dodd referred to the average sustainable level of current earnings as earnings power value, EPV, then equals the earnings power capitalized at the average future cost of capital. The formal equation for determining EPV is EPV equals earning power times 1 divided by R, where R is the currently measured constant future cost of capital. Given these assumptions, the EPV of a business is equal to the NPV of its distributable cash flows. Estimation of earnings power requires significant adjustments to currently reported accounting earnings. These adjustments, which we will discuss in greater detail in Chapter 5, include 1. Rectifying accounting misrepresentations, such as frequent, one-time charges that are supposedly unconnected to normal operations. The adjustment consists of finding the average annual ratio that these charges bear to reported earnings before adjustments and reducing the current year's reported earnings before adjustment proportionally. 2. Resolving discrepancies between depreciation and amortization as reported by the accountants and the actual amount of reinvestment the company needs to make in order to restore a firm's assets at the end of the year to their level at the start of the year, maintenance capital expense. The adjustment adds or subtracts this difference. 3. Taking into account the impact on earnings of the current position in the business cycle and other transient effects. This adjustment estimates average earnings to eliminate temporary variations. 4. Considering other modifications we will discuss in Chapter 5. The goal is to arrive at an accurate estimate of the current disposable cash flow of the company by starting with reported earnings data and refining them. We assume, to repeat, that this level of cash flow can be sustained and that it is not growing. Although the resulting EPV is somewhat less reliable than the pure asset-based valuation, it is considerably more dependable than a full-blown net present value calculation that assumes a rate of growth and a cost of capital many years in the future. And while the equation for EPV looks like other multiple-based valuations we have previously faulted, it has the advantage of being based entirely on currently available information and is uncontaminated by more uncertain conjectures about the future. Part of the benefit of this Graham-Dodd definition of earnings power is that by deferring issues of growth, it greatly simplifies calculation of the value of today's earnings. We will address the value of growth separately, since that value is both highly uncertain and depends critically on the strategic position of a business. One further set of adjustments must be made to arrive at a final EPV. The value of a firm may consist of more than just the perpetuity value of the sustainable level of operating earnings. Many firms have assets that are unnecessary for the operations of their ongoing businesses. They may have excess cash, portfolios of securities, partial ownership of other unrelated ventures, excess real estate, and other assets. To the extent that these extraneous assets can be disposed of without affecting the ongoing functioning of the core businesses, as covered by the income statement, they represent a source of value in addition to the value of sustainable earnings. This figure must be added to the initial EPV estimate to arrive at an overall earnings power value. At the same time, companies often have inherited liabilities that are also unrelated to the ongoing operations of the business. Historically underfunded pension liabilities, environmental liabilities beyond those created in the normal course of business, and other event-based liabilities, such as from past litigation, fall into this category. To mirror the extraneous assets described before, these liabilities must be subtracted from our initial EPV estimate to arrive at a final EPV. Element number 3, the value of growth. We have isolated the growth issue for 2 reasons. First, this third and last element of value is the most difficult to estimate, especially if we are trying to project it for an extended period into the future. Uncertainty regarding future growth is usually the main reason why value estimations based on net present value calculations are so prone to error. By isolating this element, we can keep it from infecting the more reliable information incorporated into the asset and earnings power valuations. Second, in many circumstances, growth in sales and even growth in earnings add nothing to a firm's intrinsic value. This claim seems to contradict a common article of faith about a company's sales and profits. Growth is good. In fact, these conditions arise only in a limited range of economic environments. These growth-friendly environments are readily identifiable based on a strategic assessment of industry economics. In most instances, a strategic analysis will indicate up front whether growth is likely to create value. Where it does not, our analysis can ignore growth dynamics in the process of estimating value. Graham and Dodd investors certainly recognize that in some important situations, growth does create value and constitutes a third element in valuation, along with assets and earnings power. The distinctiveness of the Graham and Dodd approach to valuation is to address these 3 elements of value separately, not to integrate them into a single ratio or NPV calculation. Addressing strategic dimensions of valuation within the Graham and Dodd framework. The elements of the Graham and Dodd approach to valuation are summarized graphically in Figure 3.1. The first column represents the asset value. It is the most reliably estimated element of value. For a viable business, it is the net reproduction value of the assets, what it would cost someone to replicate the assets necessary to operate this business. For a non-viable business, it is the liquidation value. The second column represents the earnings power value. It is the second most reliably calculable element of value. The data from which the EPV is calculated, historical earnings and cash flows, industry conditions, and financial market variables that determine the cost of capital, are quite different from the data underlying the calculation of asset value. Thus, asset value and EPV provide 2 distinct estimates of value that can be triangulated to obtain a more complete picture of any business whose securities we are considering buying. The strategic assumptions here are that the business is viable and that earnings are sustainable but not growing. If the industry itself is not viable, earnings power is only temporary and unlikely to add anything to the liquidation value of the assets. The earnings power value estimates may exceed or fall below the asset value. In Figure 3.1, we have drawn earnings power value in excess of asset value, but as we shall see, that is not always the case. The third column captures the total value of the firm. This differs from earnings power value by incorporating the effects of growth, which may either add to value, as in the figure, or subtract from it. We have so far said nothing about how this total value might be arrived at, except to caution that it is difficult to estimate accurately. To its credit, the NPV model makes an attempt to account for the value of growth. We have already identified what we consider the shortcomings of that effort. In later chapters, we make the case that, for practical purposes, a Graham and Dodd approach to valuing growth does a superior job and is more likely to put an investor on the right side of the trade. For a value investor, the valuation process typically begins with a careful estimate of asset value and then calculates earnings power value, including extraneous assets and liabilities. When these independent estimates are compared to one another, there are only three possibilities, each represented in Figure 3.2. The asset values exceed the EPV, case A. They are approximately equal, case B. The EPV is greater than the asset value, case C. In case A, where the asset value exceeds the EPV, there is the possibility that we have inadvertently overestimated the asset value by using a reproduction value where a liquidation value is more appropriate. This is a question of economic viability that we ought to be able to answer by looking at the long-term prospects of the company and the industry, just as we did earlier for Ford. If we conclude that the company is viable, two alternative explanations remain. First, the condition may be temporary, and we have used an inappropriately short-term measure of earnings in computing EPV. An industry cannot be viable in the long term if the value of sustainable earnings is below the reproduction cost of the required operating assets. Suppose, for example, that the asset value is $10 billion and the EPV is $5 billion. Earnings power of $500 million divided by the cost of capital of 10%. Then the return on those assets is only 5%, $500 million divided by $10 billion, which is not enough to attract capital voluntarily. In this case, investments necessary to sustain the company in the future will not be made, undermining the viability of the company. The first response to this situation should be to re-examine the estimate of sustainable earnings power, or to rethink the most efficient way of reproducing the assets. If this analysis fails to account for the discrepancy, the second possibility is that the assets are in the hands of an inferior management. This is a common situation when we find the relationship depicted in Case A. It can be confirmed by looking at the historical operating and strategic performance of management. Assets of $10 billion in the hands of a competent management should be worth their reproduction value. If they are not, current management needs to be improved or replaced. Should the inferior management persist, the business will be worth the $5 billion earnings power value at best. A more likely and discouraging scenario is that as current management reinvests a significant fraction of earnings and continues to earn returns below the 10% cost of capital, the company's value deteriorates to substantially less than $5 billion. This situation is a classic value trap. The asset value is there, but investors will never see it unless the inferior management is replaced. The critical factor in the success of the investment is the ability to replace or refocus management. Until there is a clear prospect of such an event, the only reason to consider an investment in a Case A company is if it can be acquired at a deep discount, not only to asset value, but to EPV. This clear insight is a feature of the Graham and Dodd approach and would be difficult to extract from a welter of NPV sensitivity analyses. This strategic perspective and the ability to measure valuation estimates against alternative strategic judgments is a feature of the Graham and Dodd approach. It is difficult or impossible to extract these insights from an NPV valuation. Turning to Case B, if the properly calculated asset value and EPV are approximately equal, within 25% of each other, this indicates a very different strategic situation for the business in question. It is what one would expect to see for firms with capable managements operating in competitive markets. In economic terms, no barriers to entry. In value investing terms, no moats. Why? Consider a company with $2 billion in earnings and a 10% cost of capital. Its EPV will be $20 billion. If the net asset value were only $10 billion, an entrant could reproduce the business for that net cost. In a market without structural barriers to entry, potential competitors will seize such an opportunity aggressively. Competition in the business will intensify, and profits will inevitably be driven down, even if the industry is not perfectly competitive. It can happen in stages. Suppose the first wave of new entrants reduces the incumbent company's earnings to $1.5 billion and the EPV to $15 billion. That will still exceed the required $10 billion investment. Only when the discrepancy between EPV, opportunity, and asset value, cost, is eliminated will the process of entry stop. At that point, asset value and earnings power value will be approximately equal. On the other hand, if the company, in the hands of capable management, earned $500 million with a 10% cost of capital, the EPV of $5 billion would be significantly below the asset reproduction value of $10 billion. Other companies in the industry with capable managements would earn comparable amounts. Average industry returns of $500 million represent a 5% return on capital, well below the 10% return required by investors. Confronting this reality, managements would no longer find it profitable to replace depleting assets. Industry capacity would fall, some companies would leave, and competition would diminish. After a time, profits for the surviving companies would rise, and like the entry and/or expansion process, this contraction, even though very likely slower than the expansion, would not end until the EPV equaled or exceeded the asset value. Again, the economic forces in a competitive market drive asset and EPV toward one another. As with Case A, the implications of Case B can be tested against broad strategic judgments about the nature of the company and the industry. In the instance of Ford, the unlikelihood of sustained company competitive advantages would lead us to expect the relationship depicted in Case B, an approximate equality of assets and EPV. If we do not find a rough equality, we will have to reconsider our asset and earnings power value estimates. If the asset value estimate is accurate and the market is competitive, historically there have been no significant barriers to entry, then the estimated level of earnings will not be sustainable. If EPV is below asset value and management is capable, earnings will rise until EPV approaches the asset value. Thus, an investment should be profitable so long as there is a margin of safety between price and asset value. If EPV is above asset value, it is unlikely that the level of earnings is sustainable, and careful investors will want to see a market price below the value of the assets. Again, the Graham and Dodd approach leads to a clear investment decision based on current asset and earnings power values and a strategic assessment of the nature of the market. An NPV analysis, even with extensive sensitivity trials, is unlikely to produce equal clarity. A second benefit of the Graham and Dodd approach arises because in case B, our two estimates of value are derived from distinct types of information. Asset values begin with the figures on the balance sheet and look at evidence related to what they would cost to reproduce with current technology. The firm's earnings power valuation begins with historical income and cash flow statements and looks at evidence from the annual operating performance of the firm, as well as its likely cost of attracting capital. If we have confidence in our broad strategic judgment that automobiles or any other industry will continue to be viable, with little possibility for individual firms to enjoy sustainable competitive advantages, then as we noted before, we have two independent estimates of the company's value that can be triangulated to obtain the most accurate valuation possible. One approach to triangulating between asset and EPV in case B would be to average the two. But we can do better. For some companies, earnings are highly unstable and difficult to predict. Commodity producers and other heavily cyclical businesses fall into this category. But asset reproduction values, the cost of plant capacity, working capital, the cost of replacing depleted reserves, are often quite stable. In these situations, asset values will be a more reliable measure of value than earnings power. Other industries, service businesses, branded consumer products, have stable earnings, but many of the assets are intangible and difficult to measure. For these companies, EPV without growth will be the more reliable starting point for valuation. In either situation, the estimated values are mutually supporting. When you begin with EPV, the asset value still tells the extent to which these earnings are protected from competition by asset requirements. When you begin with assets, the EPV reveals the extent to which foreseeable earnings levels will support these asset values. Nothing like this is available from an NPV approach. Finally, for case C, the EPV substantially exceeds the net reproduction value of the assets. A number of companies fit this picture. The average value of Coca-Cola's sustainable earnings in 2015 to 2016 of $50 to $60 billion, $4 to $5 billion of earnings power at a cost of capital of roughly 8%, was far greater than any reasonable cost of reproducing its assets. The book value was $30 billion, and even if we included the cost of replicating the secret Coca-Cola formula, the total would still be far less than $50 billion in EPV. The same disparity applies to other well-known companies, such as Walmart, Microsoft, Google, Nestle, and American Express. Case C is the inverse of Case A, where poor management often produces earnings that do not take full advantage of the value of the assets. Some of the excess earnings may therefore be attributable to superior management, but firms like Coca-Cola have had superior earnings for decades, while the quality of management has varied widely over this period. Consistently superior earnings power is largely attributable to industry conditions. As Warren Buffett has pointed out, when an industry with a bad reputation meets a management with a good reputation, it is almost always the reputation of the industry that survives. The opposite may also be the case. A firm in an industry with a good reputation can survive subpar management, at least for a while. The necessary industry conditions can be inferred from the previous discussion of Case B. As long as there are no structural barriers to competitive entry into a company's market, EPV in excess of the reproduction value of the assets will ultimately be competed away. Thus, from a strategic viewpoint, Coca-Cola's earnings must be protected by significant and sustainable barriers to entry. In the language of Warren Buffett, Coca-Cola's markets must be defended by wide moats. In business strategy analysis, barriers to entry exist if and only if an incumbent firm has competitive advantages that a new entrant cannot match. Competitive advantages stem from 1. Privileged access to customers. 2. Proprietary technology. Or 3, economies of scale. These advantages challenge potential entrants with the prospect of being forced to compete at a disadvantage. In most cases, they deter entry. Thus, despite the potential attractions of Case C, EPV higher than asset costs, would-be entrants are never going to reap those benefits. The firm within the moat continues to achieve earnings far in excess of the reproduction cost of its assets. The term commonly applied to this excess EPV is franchise value. The critical strategic questions associated with Case C are the strength and sustainability of this franchise. An NPV valuation pays little, if any, attention to the importance of barriers to entry. In the case of Ford, with no sustainable competitive advantage in the foreseeable future, we would distrust valuations that found sustainable EPV greatly exceeding the reproduction costs of the assets. In Chapter 6, we discuss in detail how such strategic judgments can be made. Growth. A brief preview. We have thus far ignored the value created by growth, and here we will only preview how growth considerations are integrated into a Graham and Dodd approach to valuation. While there are positive value attributes to growth, everyone knows a growing income stream is more valuable than a static one, there are negative value consequences as well. Not all growth creates value. Growth requires investment, and the cash that must be committed to the business reduces the cash that a company can distribute today. A growing income stream will therefore be associated with smaller percentage distributions at each point in time. The net value of growth depends on which of these two factors, more rapid growth versus a lower starting point, has the greater impact. Unfortunately, if we examine this question from the investment perspective, the answer is immediately apparent. Suppose a company were to invest $100 million in growth. Assume further that the cost of capital for that investment, what it would have to pay to attract investors voluntarily, was 10%. Then, an annual charge of $10 million would have to be covered out of the returns on the growth investment before any value would be created. If, because of poor management, the investment yields only $5 million, or 5%, then even though there will be earnings growth of $5 million, existing business owners will be $5 million worse off after paying the new investors. Growth investments that earn less than the cost of capital destroy value. Growth investments in competitive markets will earn average returns in the long run of 10%. Higher returns will be competed away. Lower returns will be driven up by lack of new investment. In this case, existing shareholders see earnings increase by $10 million, but pay the full amount to the new investors. Investments for growth in competitive markets, where they earn the cost of capital, neither create nor destroy value and should not influence valuation. To repeat, only growth investments that earn above the cost of capital will produce profits in excess of the returns required by new investors. For these returns to be sustainable, the investments and the growth must be protected from competition by barriers to entry. Only franchise growth creates value. These results can be summarized by reference to 3 cases in Figure 3.2. Growth in Case A, poor management, will almost certainly earn less than the cost of capital and destroy value. Here, growth is your enemy, and growing companies of this kind are worse investments than static or shrinking ones. The need for management change is amplified, not alleviated, by growth. In Case B, competitive markets with capable management, growth is irrelevant to valuation. It generally neither creates nor destroys value. Ignoring growth will not impair the quality of valuations. The fact that in NPV models, growth, even in competitive markets, usually produces an increase in estimated value is further evidence of the superiority of the Graham and Dodd approach. It is only in case C, franchise businesses growing within their areas of competitive advantage, that growth creates significant value. It is in these situations that we must take account of growth if we are to develop accurate valuations. Doing this work well requires a complete shift of valuation perspective, one we will discuss in chapters 7 and 8. And here we will note that a modern Graham and Dodd valuation approach begins with asset and earnings power value, incorporates strategic assessments of management, industry viability, and competitive advantages, and recognizes that for growing franchise businesses, Case C, valuation, requires an entirely new perspective. Once this new method is included, the modern Graham and Dodd approach is uniformly superior to NPV valuation, even when growth must be taken into account. We have described a situation in which one approach to valuation, NPV calculations, is correct in theory, precise, and is generally applied to any asset that produces a flow of income or cash to its owner. Unfortunately, it has 3 defects. 1. It ignores balance sheet information. 2. It lumps together estimates based on good information with those based on very uncertain assumptions, and the combination of the two taints the lot. 3. It relies on making accurate estimates of company operating parameters in the distant future, even as it ignores strategic judgments that are more reliably made and more important for valuation. The value alternative puts more emphasis on current information and on fundamental competitive conditions. It depends on specific knowledge about particular industries and assets, and it places much less faith in projections of rosy futures unless substantiated by current hard data. This is the discipline of value investing in the Graham and Dodd tradition. It applies to those investments with long-term future returns whose levels are determined by future business conditions. The investments in question are quite different from short-term investments with well-defined returns for which a DCF approach is appropriate. The larger lesson here is again that valuation approaches must be tailored to investment realities. One-size-fits-all valuation approaches are a bad idea. Appendix: the present value of future cash flows. The process by which money to be received at various dates in the future can be equated with money in hand today is called discounting. The term discount refers to the fact that we prefer to have a dollar in hand today than the promise, even the ironclad guarantee, of a dollar at some time in the future. The bank will pay us interest if we give them the dollar, as will other collectors of funds. In 1 year's time, at 8% simple interest, the bank will return $1.08. At 8% simple interest, $1.08 in 1 year is the equivalent of $1 today. Put differently, $1 is the present value of $1.08 1 year hence, discounted at 8%. The algebra is rudimentary. $1 times 1 plus 0.08 equals $1.08. $1.08 times open parentheses 1 divided by open parentheses 1 plus 0.08 close parentheses equals $1. The expression open parentheses 1 divided by open parentheses 1 plus 0.08 close parentheses is the discount factor. We can think of the discount rate as the equivalent of the interest rate in reverse, the rate at which the future money is reduced to determine its present value. As with the interest rate, part of the discount is to compensate the investor for inflation, the rest for risk and the willingness to part with the money. At 8% interest, compounded annually, in 2 years, a dollar deposited today will be worth $1 times open parenthesis, 1 plus 0.08, close parenthesis, times open parenthesis 1 plus 0.08, close parenthesis, or $1.164. Conversely, the present value of $1 guaranteed to us 2 years in the future at a discount rate of 8% has a present value of $1 times 1 divided by open parentheses 1.08, close parentheses, times 1 divided by open parentheses 1.08, close parentheses, or $0.857. The present value of the future cash flow is reduced more if we have to wait longer for it. The expression that captures this relationship is the time value of money. Combined with the right algebra, the concept allows us to transform a whole series of future values into their value today. The two variables we need are time, which is almost always stated in years, and that other expression we have called both interest and the discount rate. Both terms refer to the rate at which people will voluntarily commit funds to acquire the asset in question. Other phrases for this concept that are more or less equivalent are rate of return, which is how much the investor demands, and cost of capital, which is how much the user of the funds has to pay for them. The general equation for the present value of $1 received in the future is PV equals $1 times 1 divided by open parenthesis 1 plus R, close parenthesis, to the power of T, where R is the cost of capital, or rate of return per year, expressed as a percentage, and T is the number of years until payment, with the current time as 0. Let's see how this works out with a bond. We buy a 10-year government bond with a face value of $1,000 that, for simplicity's sake, pays us $80 at the end of each year. At the end of year 10, it also repays the principal amount. What is the present value of the bond, given this stream of payments? If our rate of return is 8%, then the present value exactly equals the face value of $1,000. Here are the calculations. Discount factor equals 1 divided by open parenthesis 1 plus R, close parenthesis, to the power of T, R equals 8%. Everything looks perfect because the bond's stipulated interest payments at 8% are identical to the rate of return we require, or can earn on an equivalent investment elsewhere. But suppose that after the bond is issued, interest rates on this kind of investment increase to 9%. That becomes our required rate of return. We don't want to take less than everyone else. What happens to the present value of the bond? The only change is that R now equals 9%. But as a consequence, the present value of the bond drops by $64. Discount factor equals 1 divided by open parenthesis 1 plus R, close parenthesis, to the power of T, R equals 9%. The only difference between the term present value and the almost identical expression net present value is that NPV includes the initial flow, which is usually the money laid out in year 0. In the first example, we pay $1,000 for the bond, which is a negative flow, unreduced by a discount factor because it happens today. The net present value of the cash flows would be 0, which only means that we receive back the present value of our current outlay. If interest rates go to 9% and we still insist on paying $1,000 for the note with the $80 coupon, then the NPV of the investment turns out to be negative, since we only receive back funds with a present value of $935.82. One of the cardinal rules of investing is not to make investments that have an NPV of less than 0. 4. Valuing the assets, from book value to replacement costs. The first step in a Graham and Dodd valuation is to calculate the asset value of a company. For many traditional value investors, this has been essentially the only step. The proper approach depends, as we noted in Chapter 3, on the strategic prospects of the company. If it is not economically viable because, for example, its industry is in terminal decline, then the value of the company's assets should be based on what they will bring in liquidation. If the company is viable, that means its assets will need to be reproduced as they wear out. In that case, they should be valued at the reproduction cost. The reliability of these estimates diminishes the further down the balance sheet they are located. At one extreme, Benjamin Graham began by considering just the current assets: cash, accounts receivable, inventory, and whatever else particular firms carried as current assets. Because they would be realized within a year, their values could be estimated with only minor errors, or either a liquidation or reproduction cost basis. He then subtracted the full book value of the company's liabilities. What was left was a net asset value. He sought to buy companies with market prices below 2/3 of this net figure. In the early part of Graham's career, he was able to find investments meeting this stringent standard with reasonable frequency. Today, these opportunities have largely disappeared. As a result, contemporary value investors have had to move further down the balance sheet to take into account plant, property, and equipment, and even intangible assets such as product portfolios, customer relationships, brand images, and trained employees. The error band here is wider, and valuing these assets, especially the intangibles, requires skill, ingenuity, and industry expertise. Analysts who pay close attention to the balance sheet should have a leg up on those who don't. Looking at all assets carefully, even those that are difficult to value, expands this advantage. Specialization matters in this process. One's understanding of the cost of reproducing assets or the money that can be realized from liquidating them is an area in which capabilities improve with experience. It is also importantly related to industry knowledge. An example of the usefulness of asset values beyond their immediate valuation implication arises in judging business quality. Cash flow-oriented analysts of value place great stress on the quality of a business, especially its competitive advantages. They usually judge business quality by the returns on capital or equity as reported on the balance sheet using book capital or book equity. A consistent 25% return on book equity is regarded as proof of a competitive advantage, a significant value-enhancing characteristic. But book equity often ignores important intangible assets. If these assets are included in equity, as they should be because they represent genuine investments, then actual returns on total equity employed may be much lower and thoroughly prosaic. The only systematic way to perform these adjustments is by a comprehensive asset valuation. Asset values are always worth estimating, and if they are worth estimating, they are worth estimating well. Values in liquidation. In the red, Incorporated is not anyone's idea of a wonderful business. Table 4.1. Between 2017 and 2018, the company's retained earnings fell by almost $4 million, putting its net worth below zero. Perhaps this was a temporary setback, and the firm will be able to convince its lenders to extend it more credit to meet its interest obligations. We can't tell from this fragment of information, and we really don't care. All we want to be able to do is to estimate the value of the assets if the firm is to be liquidated. For cash and marketable securities, there should be no discount from the amount as stated on the company's books, provided the securities are short-term or have been marked to market. Accounts receivable will probably not be recovered in full, but it is trade debt, and there are plenty of specialists who know how to collect it. We will estimate that 85% of book value, which already includes an allowance for bad debt, is recoverable in liquidation. What the inventory will bring depends on what it is. For a manufacturing firm, the more commodity-like the inventory, the less the discount necessary to sell it. It is yesterday's fashions that have to be marked down, not the cotton yarn. On the other hand, if the inventory consists of cartons of last season's unsaleable toys, then it may be necessary to pay someone to cart it away. We will estimate in this case that we can realize 50% on the inventory. If the inventory is highly specialized, then the valuation would have to be substantially lower. In those situations in which the value of the inventory is critical to the overall valuation, an expert appraiser can be called in to offer a more precise figure than our back-of-the-envelope estimate, Table 4.2. The same holds true for property, plant, and equipment. Detailed knowledge of the real estate and the equipment is necessary to come up with an accurate estimate. Certain broad principles apply. Generic assets such as office buildings will be worth far more, relative to their book values, than specialized structures such as chemical plants. We have put down 45% in our example as another quick and dirty valuation. If this entry is critical, we can hire another expert to do the appraisal. If we ascribe no value to the goodwill, it merely represents the excess over book value that the firm paid in making those acquisitions that may have gotten it in trouble. Deferred tax assets, the refunds the company can expect over time from the IRS, are offset against deferred taxes owed. Putting all these figures together, we come up with a value of $2.756 million for current assets and $3.375 million for property, plant, and equipment, for a total of slightly more than $6 million. Who might want to invest in this company's securities? Certainly not a traditional equity purchaser, no matter how value-oriented. But there is room for profit here, provided one is a specialist in buying up distressed debt. Though it looks fairly certain that if the company is liquidated, there will not be enough money left to pay anything to owners of either common or preferred shares, there probably will be funds for the owners of the debt. Accounts payable and accrued expenses amount to only $2.575 million. Even if they receive priority over the debt and dollar-for-dollar reimbursement, there would still be $3.556 million left for the debt holders. Everything else can flow to the holders of the debt. Debt on the books comes to $12.220 million. But given the condition of the company, the bonds would certainly have been available for substantially less. If the discount is steep enough, and there is enough value in the property, plant, and equipment, this might be a lucrative opportunity for an expert in distressed debt securities and liquidation values. Orderly liquidations. Our balance sheet-based liquidation value is the asset value for businesses at the extreme end of the non-viability scale. It applies to companies clearly worth more dead than alive, and usually the faster they are put out of their misery, the better the return. Graham, being naturally conservative, chose this kind of valuation as a worst-case possibility against which to measure his purchase price. More often, companies in distress will have some kind of future with positive operating cash flows, albeit only a short-lived one. The term applied by value investors to this kind of company is cigar butt. It has a few puffs of tobacco left, and then only the value of the remaining husk. For these companies, an orderly liquidation over, say, 3 to 5 years may yield more value than an immediate interment. In these cases, because the valuation horizon is short, an NPV will be appropriate. A plan should be developed to continue to operate the firm over this period while essentially making no new investments. Accounting profits may well be negative, but cash flows, including depreciation recoveries, should be positive. As sales decline, accounts receivable and inventories can be worked off and effectively recovered at near full value, adding to interim cash flows. Saleable general assets such as land and general purpose buildings can be sold off at non-fire sale prices. Then at the end of this period of positive, albeit declining cash flows, the current balance sheet can be evaluated on an immediate liquidation basis. The net present value of the projected interim cash flows plus the liquidation recovery can then be compared to the proceeds of immediate liquidation. If they are more valuable, the orderly liquidation over time will make sense. And because the time period over which this cash flow is realized is strictly limited, the NPV calculation should be sufficiently accurate. There's always the danger that a management caught up in this process will try to extend the life of the firm beyond its useful term. For orderly liquidation to work, this temptation must be resisted. Assets for a going concern. How much to get into the business? Liquidation value is one conservative approach to calculating what the assets of a firm are worth in the worst possible circumstances. Our principal purpose in valuing a firm based on its assets is to discover whether the economic value of the assets is accurately reflected in the price at which the firm's securities are being traded. Opportunities lie in the gap between value and price. We have already made the case that for a firm in a viable industry, the economic value of the assets is their reproduction costs, what a potential competitor would have to spend to get into this business at the scale of our firm. How do we make these estimates? Table 4.2 presents the balance sheet for another fictional company. What adjustments do we need to make here to get at reproduction costs? Table 4.3. Cash is cash, and nothing is required. For marketable securities, we have to find the current market prices. This may be difficult if the securities are not liquid, but generally this category is used only for securities that are actively traded. In principle, the book value of these securities should be based on their actual or potential market values. The serious work starts with accounts receivable. From here on, the book value should be modified up or down to get a more realistic reproduction cost. A firm's accounts receivable, as reported in the financial statement, generally contains an allowance for bills that will never be collected. A new firm starting out is even more likely to get stuck by customers who, for some reason or another, do not pay their bills. So the cost of reproducing an existing firm's accounts receivables is probably more than the book amount. Many financial statements will specify how much has been deducted for bad debt to arrive at this net figure. That amount can be added back, or an average of similar firms can be used. Valuing the inventory is more complicated. The stated number may be too high or too low by a substantial amount. Our attention should be drawn to an inventory that has been piling up. Say it equals 150 days worth of COGS, cost of goods sold, in the current year, whereas previously it had averaged only 100 days. The additional 50 days may represent items that will never sell or sell only at closeout prices. In this instance, we would be justified in reducing the reproduction cost downward. By contrast, if the company uses a LIFO, last in, first out, method for keeping track of inventory costs, and if the prices of the items it sells have been rising, then the reproduction cost of the inventory is higher than the published figures indicate. This difference is the LIFO reserve, the amount by which the current cost of any item exceeds the old recorded cost. The new entrant can't build this year's inventory at last year's prices, so we'll have to pay more to reproduce it. Prepaid expenses, such as rent or insurance, are what they are: small, and, if the accountants have done their job, properly measured by book value. They should require no adjustment. Deferred taxes as an asset are the value of the future deductions or refunds the company will get from the government. Since we are interested in the value of the assets today, we ought to get the timing of the reductions or payments and calculate their present value. In our example, deferred taxes are listed as a current asset. This firm expects to cash them in within the year, so any discount-based adjustment will be minor. But they might just as easily have been non-current, in which case the present value analysis has more significance. The adjustments we end up making to the book value of current assets are not in most cases going to be large enough to matter. The assets are current because we expect them to be turned into cash within a year. So there has been little time for great disparities between recorded costs and reproduction costs to build up. The situation changes when we examine non-current or fixed assets. The land that cost $2,000 an acre in 1985, purchased because it was cheap, plentiful, and close enough to an adequate labor market, even though a little remote from a decent restaurant, may now sit 200 yards from a new laboratory incubator developed as a private-public partnership. Our company owns 500 acres. Suppose that last month property, similarly situated, sold for $10,000 an acre. Either the land is worth that much to our company because of its proximity to the new facility, or else we should sell it and move elsewhere, pocketing the difference. In either case, the gap between the book value and either the costs of reproducing it or the net gains from an outright sale is large enough to catch our eye. Establishing the reproduction cost for plant and equipment is more complicated, less precise, and requires a higher level of specialized industry knowledge than adjusting current assets. Consider, for example, the reproduction value of an oil refinery capable of producing 60,000 barrels per day of crude oil. Suppose that the cost of a new facility on that scale is $10,000 per barrel, an estimate obtained by consulting engineering firms that manage the construction of oil refineries. This suggests a reproduction cost of $600 million. The calculation is simple enough, but there are three significant problems with this figure. First, a new facility will almost certainly have lower operating costs than the refinery on the balance sheet. The present value of the savings over the life of the existing facility can be calculated with reasonable accuracy, as they are of finite duration and should not grow rapidly and ought to be well defined. The value of the savings must be subtracted from the reproduction costs of the refinery. Second, the new facility will have a longer life than the existing one. The present value of the difference between the residual value of the new facility and the scrap value of the existing one must also be subtracted from the $600 million cost of the new facility. Third, and often most important, a new facility may not be the most efficient way to reproduce the function of the old facility. No new oil refineries have been built in the United States for decades, even as refining capacity has expanded steadily. The added capacity has come from incremental improvements to existing brownfield refineries and not from newly constructed greenfield refineries. The cost of adding brownfield capacity has been far less than the cost of greenfield activity, around $2,000 per barrel compared to $6,000 per barrel, even after making the first two adjustments we described before. The most efficient way of replacing our 60,000 barrels of refining capacity — our goal is increased oil production, not increased refinery construction — is by extending existing refineries at a total cost of $120 million. This is the properly calculated reproduction cost of the facility. In competitive situations, where companies compare the costs of building either new construction or brownfield extensions to the cost of purchasing capacity in secondary markets, these prices should be roughly equivalent. Still, it is helpful to perform the calculations and have two distinct sources of information for valuation. This kind of direct assessment of plant value is one way to estimate its reproduction cost. Another way is to start with the financial information provided by a company's balance sheet, including the associated footnotes. This generally reports original acquisition costs separately for land, plant and structures, construction in progress, equipment, and furnishings and fixtures. Accumulated accounting depreciation is then subtracted, usually as a simple aggregate, to arrive at book value. This depreciated net value of PPE will always differ significantly from reproduction cost. Land does not depreciate and may appreciate significantly due both to general inflation and economic growth. So too may plants and structures, factories, oil refineries, office buildings, motels, stores, restaurants, and facilities such as long-lived fiber optic cable linking together large cities, both at home and overseas. The potential disparity between book value and reproduction cost may be enormous for two reasons. First, although plant and structures, unlike land, do wear out, they often do so more gradually than the rates assumed by accounting standards. For example, our fiber optic cables wear out slowly, if at all, but accountants depreciate them over 20 years or so. Second, inflation and economic growth positively affect the values of plant and structures just as they do land. For land, plant, and structures, we can estimate the percentage impact of growth and inflation by looking at the rate of appreciation of comparable facilities that are sold at publicly recorded prices. We then have a basis for adjusting original costs upward. We can also make an offsetting downward adjustment to capture a realistic rate of wearing out. We put the two together to arrive at a reported balance sheet reproduction value for plant and equipment. These figures can be compared with the direct reproduction value estimates for PPE described before. Construction in progress is easy to value. These are structures in the current process of reproduction, so that the original book value should equal the reproduction cost unless the facilities in question are overcost or inappropriate. Equipment, furnishings, and fixtures wear out more rapidly than structures or fixed facilities. Depreciation plays a greater role in determining value and must be carefully considered. However, for a firm which is neither growing nor shrinking, equipment, furnishings, and fixtures should be roughly halfway through their useful lives. Even for the firm growing at 5% per year, whose equipment will be newer on average than that of the static firm, the difference from the one half of life is only on the order of 10%. Thus, for a first approximation, we can assume that equipment, furnishing, and fixtures are halfway through their useful lives. This original estimate can then be modified by trends in equipment prices, usually adjusted for changes in quality. The United States Department of Commerce tracks these prices, which have been falling relatively rapidly. To illustrate this adjustment, assume that a company's equipment has an average life of 8 years, making the average age of the existing equipment 4 years. If equipment prices have been falling at about 4% per year, the price of equipment to replace 4-year-old equipment will be about 85% of the original cost. Thus, we can estimate reproduction cost for existing equipment as 1/2 of the original cost times 85%. This figure can then be added to the estimated reproduction cost of land, building, and construction in progress to obtain a quick estimate to compare with book value after depreciation. We turn now to goodwill and other intangibles. The goodwill that appears on the company's balance sheet usually represents the residual impact of past acquisitions. When Company A acquires Company B, the difference between the price paid and the fair net value of Company B's assets appears on Company A's balance sheet as goodwill. Over time, this excess purchase cost, which covers intangibles that are not represented on the balance sheet, things such as product portfolios and customer relationships, is reduced, amortized, to account for the gradual decay in their value. At any given moment, the value of goodwill is the current amortized level of the acquisition premium the company paid. Recently, companies have begun to capitalize certain costs such as research and development, software creation, and customer acquisitions that have benefits over many future periods. Traditionally, firms deducted the full amount of such costs against current revenues when calculating profits. When capitalized, the cost of such investments is not charged against current revenues. Instead, they are accumulated in a balance sheet item labeled intangibles. This asset is then depreciated over time, the depreciation being charged against revenues in calculating profits. Both intangibles and goodwill are determined by accounting conventions and historical choices that may not reflect the reproduction value of the assets in question. A company may simply pay too much to acquire another firm, either because of perceived competitive threats or grandiose plans that don't work out, or it just makes a mistake. This acquisition premium is included in goodwill, but it may not represent any economic value. A new entrant does not need to reproduce anything here in order to compete. This portion of goodwill may represent a prior blunder, and we are justified in ignoring it entirely in coming up with our asset-based valuation. The value of goodwill depends on its source, and to determine that, we need information and industry knowledge. Because of all these uncertainties, we think the best course is to set the value of these accounting entries to zero and estimate the reproduction value of identifiable intangibles, including those that are part of goodwill, from first principles. We begin with a list of the relevant intangibles. This will not be limited to the intangibles entry on the balance sheet. For most companies, this will consist of a product portfolio with development and/or brand value, a current customer base, and a trained labor force operating within an effective organizational structure. For each of these items, we can think through several alternative processes of reproduction to get a composite estimate of their reproduction value. Multiple approaches are especially useful for intangibles that are hard to value. Let's start with a company's product portfolio. This portfolio has been created by research and development activities whose purpose is to invent, design, and produce products and services for sale. Many firms will have no significant R&D expenses, and the reproduction cost of their product portfolio will be low or zero. Others will spend only modest amounts that don't warrant their own entry in the income statement, but may be specified in the footnotes. However, many companies have highly significant levels of R&D expense. As a general rule, the higher the technology, the more R&D is embodied in a company's products, and the greater the asset value of its product portfolio. Table 4.4 presents R&D spending of some leading non-financial corporations as a percentage of sales. Those companies with NA in the column did not break out R&D spending in their financial statements. Converting R&D spending into a valuation of a company's product portfolio is most simply done by multiplying annual spending by the number of years of R&D embodied in the company's product line. If most current products were developed over the last 6 years, then 6 times current R&D spending is a useful starting point for valuing the firm's product portfolio. A new entrant would presumably have to spend a roughly equivalent amount to offer a comparable range of products. In cases where R&D output is episodic and highly significant, we need to get into more detail. For a company such as Boeing, average R&D may be relatively low as a fraction of sales in particular years. However, R&D and sales are driven by new product cycles. A new model, such as the 787 Dreamliner, will have an estimated development cost of $10 to $20 billion with uncertain sales levels, since it is still early in its production cycle. A competitor will have to develop a comparable aircraft, although perhaps without the technological missteps and therefore at lower cost than the 787. Competitors will also have to offer alternatives to the full range of mature Boeing models, the 737, 747, 757, and 777, at current costs, which, because of inflation, higher performance standards, and less experience than Boeing, will almost certainly exceed Boeing's historical costs. In this instance, it will be necessary to refer to expert industry sources who can more accurately estimate the current cost of developing a comprehensive Boeing-compatible product line. Merely multiplying Boeing's R&D levels and average product life, which may range from 15 to 40 years, will usually not be precise enough. For research-centered industries such as pharmaceutical, things are even more complicated. Existing drugs that have been tested and satisfied international regulatory standards are not the focus of current R&D spending. As established products, they have associated revenue and production cost streams that are usually highly predictable and largely independent of historical R&D spending. The best way to value these is by calculating the NPVs of these earning streams, which tend to be of relatively limited duration before the drug in question goes off patent. The cost of reproducing these drugs, which are typically not going to be reproduced since they are likely to be replaced by lower profit generics or improved substitutes, are irrelevant. R&D spending in pharmaceuticals typically drives the value of a pipeline of future drugs, not existing products. Since the pipeline extends over many years, most of the future product is visible today, although its value may be highly uncertain. For this part of the product portfolio, there are experts in evaluating drug pipelines in particular therapeutic categories like oncology, cardiology, and gastroenterology. Non-specialists in pharmaceuticals are at an obvious disadvantage. The overall lesson here is that where intangibles such as product portfolios are especially important, industry specialization is critical. A second important intangible asset is embodied in the company's book of business, that is, its revenue base. The customer relationships that underlie this revenue cost money to develop and should be regarded as an important intangible asset of the firm. Again, the best way to estimate the reproduction value of this asset is to think through the process of acquiring a particular level of revenue. For example, companies are constantly bringing new brands to market. A marketing budget and a set of revenue targets are associated with each new brand introduction. At the start of the process, costs will exceed revenues, and the cash flow will be negative. Once the brand reaches its target sales level, there should be net positive cash flows over its future life. The cost part of this plan is usually estimated reasonably well. Budgets are determined for the new brand introduction, and overrunning those budgets can have consequences for management. The sum of outlays during the investment phase can then be divided by the target for mature sales, all discounted by the timing of the cash flows to obtain a reproduction cost per dollar of sales. However, only 1/3 to 1/2 of new product introductions actually succeed. So this theoretical reproduction cost must be multiplied by a factor of 2 to 3 to calculate the reproduction cost of a successful brand that becomes part of a company's long-term revenue base. Data on these costs and success rates are usually obtainable from industry experts, often retired executives who have experience of many actual new brand introductions. A typical adult woman clothing brand in the late 1990s cost between 20 cents and 30 cents per dollar of mature sales to develop. With a success rate of between 1/3 to 1/2, the average cost per dollar of successful brand sales was between 40 cents, 2 times 20 cents, and 90 cents, 3 times 30 cents, or roughly 65 cents per dollar of sales. An alternative method of sales acquisition is to outsource the process. In many industries, there are independent sales agencies that will undertake to sell a company's product for a commission, usually set as a percentage of first-year sales. These commissions vary by industry and product type. For industrial products, they range from 5% to 15%. This information is relatively easy to obtain since these prices are widely quoted and well known to industry participants. They provide a useful check on the cost of developing the revenues internally as estimated in the business plan. A second way to outsource revenue acquisition is to buy businesses directly from competitors. Major women's fashion firms buy product lines from other firms all the time, either by acquiring specific brands or taking over smaller firms. The amount that they pay, after subtracting the value of other collateral assets acquired, can be divided by average acquired future revenues to get a cost per dollar of sales. The average cost per dollar of sales acquired for adult women's mature clothing brands in the late 1990s was between 60 cents and 70 cents, in line with our direct estimate cited before. The outsourced cost can be used as a check on internal business case estimates of the cost of revenue generation. Keeping records of revenue acquisition costs in an industry is an important part of valuing intangible assets. A third kind of intangible is embodied in a trained labor force. The cost of acquiring this staff can be estimated either from past experience or by looking at the fees charged by personnel search firms and agencies that provide trained workers of various types. Finally, there are costs to create the necessary business structures, which include human resource management, information technology, and other unglamorous but essential functions. These do not simply spring, like Athena, fully armed from the head of Zeus. After we have estimated the reproduction values of a company's product portfolio, its current customer base/book of business, and its trained labor force, we must still account for what it takes to get the business off the ground and running smoothly. Usually this will be some multiple of annual administrative costs. The multiple in question will depend on the time that it takes to ramp up operations in a particular industry, but typically it will fall between 1 and 3 years. If administrative costs are not reported separately, but are buried in the SG&A line on the income statement, then we need to identify the approximate share of this total attributable to administration. If we have not been able to break out the reproduction values of the product portfolio, book of business, and trained labor force, then we can take a multiple of total annual SG&A as a less precise but still useful estimate of the intangible assets embedded in a functioning business operation. A further approach to calculating the value of intangibles is to look, as in the case of brands and revenues, at purchase costs in the market for similar businesses as a whole. This is particularly important in situations where intangibles are highly specialized, such as broadcast rights for radio and television, local cable or utility franchises, licenses to run casinos, or sell alcoholic beverages in markets with a limited number of such licenses, mineral rights, oil and gas reserves, long-term local service contracts for transportation facilities, local distribution franchises for global companies such as Coca-Cola or AB InBev, and professional sports franchises. These assets may be difficult or impossible to reproduce at historical costs. However, both discrete assets and operating business incorporating these assets are frequently bought and sold among industry participants. Where the transaction between knowledgeable buyers and sellers takes place for cash, as opposed to stock or other kinds of less certain considerations, these private market values are important indicators of the current reproduction values of these assets. The well-prepared analyst keeps track of these transactions. The values they establish may be an important source of information in similar situations. Care must be taken when using such private market values. First, the transactions taking place will necessarily differ widely in size. A local cable system with 120,000 subscribers and $180 million in revenue is not the same as one with 6,000 subscribers and $6 million in revenue. It is always possible to translate the overall price paid into a per figure, price paid per subscriber, per regional population number, per dollar of revenue, or per dollar of operating profit. But different measures may tell different stories. Suppose in our simple example before, the big cable system is 20 times the size of the small one measured by subscribers, but due to economies of scale, 30 times the size in income. Careful consideration rooted in detailed industry knowledge is needed to decide on the most applicable metric. Second, transactions take place at widely varying times, and prices often reflect changing perceptions of future industry profitability rather than asset reproduction costs. Thus, asset values in these industries will not be fully independent of the earnings power value. In some cases, the operations in question are protected by barriers to entry, so that earnings power value, including the value of growth, is the appropriate measure. For these dealings, the lack of transaction-based asset values that are independent of earnings potential is not a problem, since asset values will be of secondary importance, and private market value will still provide a worthwhile check on the reasonableness of earnings-based valuations. But in cases where markets are competitive, such as buying oil reserves, private market value estimates should be calculated as averages over time to eliminate extreme periods of optimism and pessimism over a commodity cycle. Also, in these latter cases, unstable private market values introduce a considerable element of risk. Value investors who rely heavily on these private market values typically look for catalysts, such as takeovers, that will cause these private market values to be realized in the relatively near future. The same approach can be used in valuing a subsidiary business within a company. Private market purchases of similar businesses provide a basis for determining the worth of the subsidiary. Instead of using the price paid per subscriber or other operating figure, the standard practice is to use a multiple of a cash flow measure like EBITDA. Say, for example, that a property and casualty insurance company has bought or built a subsidiary that provides online information to insurance adjusters on the price and availability of replacement auto parts. This information is available to all insurance firms who pay for it by a combination of subscription fees and usage charges. Although it serves the insurance industry, the subsidiary is really a different business. Its success has nothing to do with careful underwriting or skillful investing of premium revenue. It is an information services provider. In arriving at a value for the whole insurance company, it makes sense to break out the earnings and assets of the information subsidiary and to look at the price at which comparable information services companies have sold in the private market. Perhaps the insurance company will take advantage of the higher PE multiples assigned to web-based businesses and sell this subsidiary, or spin it off and retain some of the shares. Whatever it decides to do, if its value is heavily affected by ownership of this other business, the other businesses deserve a separate valuation. Liabilities and net asset value. So far, we have only examined the asset side of the company's balance sheet. An investor in the company's stock who buys a proportionate share of its assets acquires an equally proportionate share of the liabilities that encumber these assets. Investors should properly be concerned with the net value of what they have bought. To arrive at a net asset value, we must subtract the negative value, cost, of the company's liabilities from the positive value of its assets. A company's liabilities consist of debt, both long and short-term, current non-debt liabilities, and long-term non-debt liabilities. We will address each of these liability categories separately. Current non-debt liabilities are those due for payment within 1 year. They consist chiefly of accounts payable to suppliers, accrued liabilities largely due to workers, and also include taxes owed to various governments. Unlike current assets such as accounts receivable, there are no allowances for non-payment of these items. Failure to pay will lead to default judgments and bankruptcy. Thus, the book values of these liabilities are the amounts a company actually has to pay, which in turn is their intrinsic value, which turns out to be negative. We can depend on book values in estimating the costs of these current non-debt liabilities. Long-term liabilities other than debt are either amounts incurred in the course of normal operations that come due more than a year in the future, or long-term future obligations that have arisen over the course of historical operations. Long-term normal operational liabilities are usually owed to the same groups as current non-debt liabilities, including dealers who supply marketing and support services, workers, and governments. Like current liabilities, they must ultimately be paid if a company is to continue to operate. Because payments may be deferred more than a year, the book values of these liabilities should be discounted by a cost of capital to arrive at their current intrinsic cost. But except for inflationary, high cost of capital environments, the effect of discounting should be small, and book values should be close enough to actual values. In high cost of capital environments, average periods until payment should be estimated and book values discounted accordingly. Inherited long-term liabilities consist chiefly of accumulated legal and environmental costs, unfunded future pension and benefit obligations, and the cost of deferred executive compensation. Now, in theory, a company's auditors should estimate the present value of these obligations fully and accurately. The book values of these liabilities should therefore be proper measures of their actual negative values. However, if an item is large and the company in question has a reputation for accounting manipulation, then an independent estimate of the liability must be made. The information necessary is usually available in footnotes to a company's reported balance sheet. Available footnotes normally present detailed calculations with clearly identified assumptions for unfunded pension and benefit liabilities, and for deferred executive compensation, including stock options. The major potential legal and environmental costs are also detailed in either footnotes to a company's balance sheet or a separate part of its annual report. This information can then be used to calculate alternative estimates of long-term, non-debt liabilities. Debt liabilities appear on company balance sheets at face value. At the time the debt is issued, interest rates are generally set so that its cost to the company, the present value of the associated payments of interest and principal, is at or near this face value. If interest rates subsequently rise, then the cost of these future payments will fall below face value. If rates fall, the cost will rise above face value. For short-term debt, except in extreme inflationary environments, these effects will be small, and book value will be an appropriate measure of the cost of the debt. For longer-term debt, the difference may be material. But for these debts, the true cost per dollar can be measured by looking at the average price as a percentage of face value at which debt of comparable duration and risk trades in public markets. Applying this adjustment factor to the book value of a company's outstanding long-term debt yields a usable measure of the true cost of that debt. A second situation in which actual debt costs would deviate from book value arises when a company is in financial distress, facing a high probability of bankruptcy. But under these circumstances, the asset value of the company's equity will be zero. Existing asset values will be divided up among the liability holders in an order of priority determined by a bankruptcy proceeding. For viable businesses, debt should be measured at book value, adjusted where necessary to account for the impact of changing interest rates. Summing up, in the value tradition, there are three alternative approaches to determining the net asset value of a company. The first, and least demanding, is to trust the accountants and use the book value of equity, the assets minus the liabilities. The second is Graham's net-net approach, current assets minus all liabilities, which is highly conservative. The third is to compute carefully a liquidation value for non-viable businesses and a reproduction value for viable ones. The broad characteristics of each of these approaches are outlined in Table 4.5. Finding the reproduction cost of a firm's assets and liabilities takes more work, more knowledge, and more everything than relying on book value or net-net figures. It is, however, the most frequently applicable approach, and the one most likely to put an investor on the right side of any investment opportunity. Still, in practice portfolios of net-nets, each purchased at prices of 2/3 or less of net-net value, have generally outperformed broad stock market indices. The same applies to low price-to-book value ratios. Indeed, consistently outperforming these mechanically selected portfolios is a feat achieved by very few investors. Those who rely on detailed analysis of reproduction values must do it well if the effort is to pay off. Example 1. Hudson General. In our discussion of valuation, we noted that although assets and earnings power values are generally mutually supporting, there are instances where they diverge. In those cases, there are some occasions in which asset values are more useful, and others where earnings power values provide better information. The choice of an approach depends on the nature of a business, the impact of management, and other future developments. It is necessary before producing any detailed numerical analysis to develop a clear picture of each of these elements of a business. This requirement is especially the case when the business is a complex combination of distinct operations that may obscure the determinants and level of intrinsic value. To illustrate the kind of preliminary analysis required, we will return to an example we analyzed in the first edition of this book, that of Hudson General in the summer of 1998. A glance at the company's income statements from 1996 to 1998 suggests that something out of the ordinary had happened during this period. Reported revenues declined by 96%, while net income fell by only 1/2. At the same time, the income statement shows a strange mix of operations. A business providing ground support, fueling, and other services to airlines at major airports, Hudson General LLC, and a joint venture for real estate development in Hawaii, Kohala. The Hudson General balance sheet also shows substantial cash, securities, and other assets held by the parent company that are part of neither enterprise. To develop a clear understanding of Hudson General's value, We need to begin by examining each of these separate sources of value, the assets and liabilities of Hudson General LLC, Koala, and the parent company. Then we can consider how they fit together to deliver value to the stockholders in Hudson General. A first preliminary step is to decide whether Hudson General is a suitable object of analysis for disciplined value investors, whether it would be identified as a good investment opportunity by an appropriate value-oriented search strategy. There are some promising characteristics of Hudson General at the July 31st, 1998 price of $48 per share. The company was small and obscure. Its market capitalization was only $85 million. It was not covered by any sell-side analysts, and it had a total of only 182 shareholders. While not cheap, Hudson General's stock, by late 1990s standards, was certainly not expensive. With average earnings of roughly $3 per share, it was selling at 16 times earnings, below the average market price-to-earnings multiple of 20. Despite a recent increase in price, its performance had trailed the market for a number of years. On the other hand, the dividend return was only 2%, $1 per share divided by $48, and the stock traded at 1.25 times book value. All things considered, it was worth a look, although we would not have been surprised if a more detailed analysis proved it to be an unattractive investment. Hudson General Parent. The balance sheet in Example 1.2 includes a 74% interest in Hudson General LLC, HLLC, a 50% interest in the Koala Land Development Venture, and a number of assets and liabilities at the parent company level, most prominently $38 million in cash and securities. The mystery of the 1996 to 1997 decline in revenues is reflected in the first of these items. In that period, Hudson General received $23 million from a branch of Lufthansa Airlines in exchange for 26% of the HLLC business, plus an option to buy an additional 23%. After the sale, Hudson General deconsolidated the operations of HLLC in its financial statements, and HLLC's revenues disappeared from the income statement. The remaining activities at the parent company were very limited. It provided support services to HLLC, for which it received revenues of $5.1 million in 1997 and $5.8 million in 1998. The parent also invested the excess cash and supervised the Koala joint venture. An obvious question is whether the parent company operations provided any value at all. If HLLC were to be sold entirely to a company like Lufthansa, the buyer could almost certainly perform the parent company's functions within its existing infrastructure at relatively little incremental cost. Given the historical performance of the Koala joint venture, Hudson General's real estate development prowess looked minimal at best, and thus dispensable. If the residual parent company's assets were liquidated and distributed to shareholders either as dividends or through stock buybacks, there would be no need to manage them, a cost savings of roughly $3 million. The operations of Hudson General were almost certainly worth more dead than alive. The best way to value the extraneous parent company assets was liquidation value. The earnings power, and therefore the earnings power value of the parent, was less than zero. Calculating a liquidation value for the LLC parent is straightforward. The cash and securities of $38 million would be worth $38 million. Money owed it by HLLC, receivables of $563,000, advances of $2,057,000, and the note receivable of $3,130,000 would all certainly have to be fully paid by whoever purchased HLLC. Like the cash and securities, They should yield book value of $5.75 million in liquidation. This would go first to settle the current liabilities of $2.83 million, leaving roughly $2.9 million in net value. Recoveries from prepaid expenses and property, plant, and equipment would be less than book value. At a 50% recovery, they would yield about $1.2 million. This resulting loss would offset some of the deferred tax liability, lowering it from $2.2 million to roughly $2 million at most. As a whole, the non-cash and securities assets of the parent should yield roughly $2.1 million, $2.9 million plus $1.2 million minus $2.0 million. These adjustments bring the total liquidation value of the Hudson General parent to approximately $40 million, $38 million in cash and securities plus $2 million in other net assets. Hudson General, LLC. Hudson General's 74% interest in HLLC was a very different asset than the largely cash holdings of the parent. HLLC was a viable ongoing business for which Hudson General published a separate income statement, Table Example 1.3, and balance sheet, Table Example 1.4. This part of the company should be valued using a full asset value/earnings power value approach. The resulting value estimate could be carried up to the parent level in either of two ways. First, it could simply be multiplied by the 74% of the business that Hudson General owned. However, Lufthansa had announced its intention to exercise its option to buy a further 23% of HLLC at a price of $29.6 million. At the completion of this transaction, Hudson General would have an additional $29.6 million in cash and own 51% of HLLC. Thus, a second, more accurate alternative would be to add $26.9 million cash plus 51% of the estimated value of HLLC to the $40 million of parent company value. Earnings power value is the best way to begin assessing the value of HLLC. HLLC was a relatively stable service business with lots of intangible assets, long-term airport contracts and relationships, trained local labor forces, and established local management teams. Evaluating these intangible assets would be far more difficult and imprecise than forecasting and valuing sustainable future earnings. Revenues for HLLC over the period 1996 to 1998 had been stable at roughly $168 million per year. However, operating earnings declined steadily from $25 million in 1996 to $14.6 million in 1998. Hudson General attributed this decline to increased competitive pressure on pricing of aviation services as a result of alliances between major commercial airline carriers. But the company had seen this trend stabilize during 1998, a development noted by other airport service companies. Thus, a reasonable starting point for estimating earnings power value would be the $14.6 million of operating earnings reported for 1998. To this, we have to add back the $5.7 million paid for unnecessary services by HLLC to Hudson General's parent. This leaves us with a sustainable earnings power estimate for HLLC of $20.4 million before tax. The tax level for HLLC reported in Table Example 1.3, about 12%, is clearly unrealistic for evaluating HLLC as an independent entity. It results from its special status as a subsidiary operation of its taxable parents, Hudson General and Lufthansa. An appropriate tax rate in 1998, including allowance for U.S. federal, state, and local taxes and Canadian taxes, would have been around 37%. This implies taxes on HLLC operating earnings of $7.5 million, $20.4 times 37%, or after-tax earnings of $12.9 million. Replacement CapEx and accounting depreciation and amortization for HLLC appear to have been about equal, so that no further significant adjustments to earnings power seem necessary. The year 1998 had been preceded by a long-term bull market, and expectations of future equity returns were relatively high. Because HLLC had almost no debt, an equity cost of capital of 10% seems appropriate for even a relatively stable company such as HLLC. Thus, our estimate of $12.9 million in earnings power should have a value of $129 million, $12.9 million divided by 10%. From this, we have to subtract HLLC's roughly $2 million in net debt, $5.2 million owed to Hudson General, less $3.4 million in cash, to arrive at a final equity earnings power value of $127 million. Since the reproduction and book values of HLLC's property, plant, and equipment look roughly similar, and adjustments to net working capital are likely to be small, a natural starting point for estimating the asset value of HLLC is the book value of $31 million. To this, we must add the reproduction value of the LLC's intangible assets, which are substantial. Its contracts last from 5 to 10 years, and only 10 to 15% of them turn over every year. Building local labor forces and infrastructure might take even longer. Thus, developing intangibles equivalent to those underpinning HLLC's business might involve as much as 7 years of overhead and marketing expense, or $100 million, 7 times $14 million, of annual HLLC overhead. But this estimate will be subject to significant potential error. Fortunately, we have, in this case, a private market estimate of the value of HLLC assets from a knowledgeable buyer willing to pay cash. That buyer was Lufthansa's ground service subsidiary. In 1996, Lufthansa paid $23 million for 26% of HLLC, establishing a value of about $88.5 million on HLLC net assets, $23 million divided by 26%. In 1998, it was willing to pay $29.6 million for another 23% of LLC, valuing all of those assets at $128.7 million, $29.6 million divided by 23%. As this asset value is very close to our estimated earnings power value of $127 million, the Lufthansa bid was by no means an unreasonably optimistic one, and Lufthansa was not paying for a control position, which by eliminating HLLC operating inefficiencies beyond the unnecessary fees paid to the Hudson General parent would further enhance HLLC's value. These calculations indicate that HLLC as a whole was worth at least $128 million. For Hudson General parent, HLLC added $29.6 million in cash and $65 million of value for its residual 51% of HLLC. Together with a parent company liquidation value of $40 million, mostly in cash, this brings the total value to roughly $70 million in cash and $65 million in its share of HLLC, compared to a Hudson General market value of $85 million, $48 per share times 1.77 million share equivalent outstanding. Koala Development. The last piece of Hudson General was its 50% interest in the Koala land development on the island of Hawaii. The balance sheet for Koala is shown in Table Example 1.5. The income statement, not presented, was a sad tale of continuous losses. $5.6 million in 1998 after a $22.6 million loss in 1997, which included a $17 million write-down in the value of Koala's assets. After having been halted by the filing of an environmental lawsuit, a recently favorable court decision would allow land sales for residential construction to resume. But the long-term reality was that Hudson General had effectively put $29 million into Koala and would recover only a fraction of that amount. Hudson General's experience as a Hawaiian land developer had been a flop. As a result, the Koala venture would be liquidated. Therefore, like the Hudson General parent, Koala should be assessed at liquidation value. We will assume that recoveries from the non-land assets of $6.2 million would be 100% for the cash, 80% for the mortgages and notes, and 50% for the foreclosed property and other assets. These total $3.9 million. From this amount, the payables of $0.9 million must be subtracted, leaving $3.0 million net, or $1.5 million for Hudson General's half interest in Koala. These are crude calculations based on common rules of thumb that may not apply to Koala, but as the amount involved is relatively small, a more detailed analysis is unwarranted. The remaining Koala asset was 1,820 acres of partially developed and undeveloped land. Of the original acquisition of 4,000 acres, 2,100 acres had been sold in phases 1 and 2 of the development, which took place before the lawsuit, and another 80 acres that were sold as part of Phase 3. Hudson General's share of this remaining portion was 910 acres. The standard way of valuing real estate assets is to rely on local assessors. In this case, the assessment produced an estimate of between $15,000 and $20,000 per acre, or from $27 million to $36 million for the entire 1,820 acres. This was well above the book value of $9.2 million, but far less than the $55 million net land investment by the partners. $58 million paid less $3 million non-land net assets. If we use the lower end of this range, Hudson General's share of the land value was $13.5 million, from which roughly 6% in sales cost would have to be deducted. This adjustment leaves the total liquidation return for Koala at about $14 million. $13.5 million times 94% plus $1.5 million for the non-land assets. Calculated as a sum of its various parts, Hudson General should be worth about $150 million. $70 million in cash from the parent liquidation, $65 million in residual 51% LLC holding, $14 million from the Koala liquidation. Compared to the market price of $85 million, this total includes a margin of safety of $65 million, or 43% of our estimated value. Hudson General as a whole. Unfortunately, that $150 million of value was potential value, what an investor would realize if Hudson General's management were to do the right thing, dismember the company, and eliminate their own jobs. As an ongoing enterprise in the hands of current management, Hudson General was considerably less valuable. As of June 30th, 1998, Hudson General generated about $5.3 million in annual earnings and paid out about $1.8 million in annual dividends. In fiscal 1997, the company did buy back roughly $9 million worth of stock, but the next year it was a net stock issuer, and its record of capital allocation to ventures like Koala did not augur well for value creation and the use of its $40 million cash hoard. If Hudson General Management were to pay out the full $5.3 million in earnings, the company might be worth $66 million, even without growth. The dividend return would be about 8%, typical for a staple dividend-paying utility. If it destroyed only 50% of the value of its cash hoard, then Hudson General's value would be about $85 million, $66 million plus $20 million, which was equal to its current market value. Hudson General is a classic Case A company, according to our taxonomy at the end of Chapter 3, for which the potential asset value of $150 million far exceeds its current earnings power value of $85 million. The critical issue here is one of management behavior. If that behavior remained unchanged, Hudson General was likely to be an unsatisfactory investment. Even if management stopped destroying value, the best an investor could earn without a sale of the assets would be a cash distribution that did not match the value of assets trapped within the firm. Situations like this require a catalyst to replace existing management. Hudson General was potentially an exemplary value trap, with asset value in excess of market price. Without management change, the full value of these assets would never be realized. Given the need for a change in management to effect either a sale or an improved return, Hudson General might not have looked like a promising investment in the summer of 1998. 4 of its 8 board members were company officers: chairman, vice chairman, president, and executive vice president. Another was an investment banker who had earned significant fees from the Lufthansa transaction. Without a clear path to management change, investing in a company like Hudson General is a perilous undertaking. In this instance, however, that change was in fact imminent. A noted value investor with an activist orientation owned a near majority of the stock and was clearly interested in forcing management change. Under these circumstances, management did not need much prompting. In November 1998, it offered to purchase the company for $100 million. Fortunately for the shareholders, the manager's move just initiated the bidding. Between then and February 1999, when Globeground, the Lufthansa unit that by then owned 49% of HLLC, put in its winning bid of $133 million, there had been a sweetened offer from management at $106 million and several bids from other companies in the aviation services industry. All this attention kept management from enriching itself at the expense of outside shareholders, though who knows what door prizes they were able to cart away. Did Globeground pay top dollar? From our analysis, we know that they got both the Hawaiian acreage and control of HLLC for nothing. But since they were the logical purchasers from a strategic sense, it is probably unreasonable to expect anyone to have bid more. For a company whose market price was $85 million only months before, a sale at $133 million generated a return of more than 50% in virtually no time at all. A rich reward for someone who had the skill and patience to work their way through the morass of Hudson General. 5. Earnings power value. The second step in a traditional Graham and Dodd valuation is calculation of a company's earnings power value, EPV, which is based on sustainable current earnings. Information related to current earnings is second only to assets as the most reliable basis for determining what a company is worth. By current earnings power, we mean the average distributable earnings of a company as it exists today. This level of earnings is assumed to be constant over an indefinite future. The value of such a stream, the EPV, is calculated as this current earnings power divided by the company's cost of capital. The cost of capital, in turn, is the expected annual return that the company must offer in order to attract willing investors. If a firm must offer an expected return of 8% and has constant future annual earnings of $10 million, then investors will properly value the firm at $125 million, $10 million divided by 8%. Because there is a forecast embedded in the assumption of a constant level of future earnings, the EPV is subject to greater potential errors of measurement than the asset value. But by concentrating on sustainable earnings as the company exists today, this estimate of future earnings is firmly based on the observable past history of the company, its management, and its industry. The EPV calculation does not attempt to anticipate future changes in a company's operations. Security analysts who incorporate developments such as future growth from new products in their forecasts have a poor record subject to both random and systematic error. By isolating the EPV from these more speculative future forecasts, Graham and Dodd estimates of sources of value move in a disciplined way from the most to the least reliable measure of value. They do not ignore the potential effects of new developments on a company's value, but defer consideration of their impact until after calculating a more basic and reliable valuation. We deal with future developments when we discuss the valuation of growth. Earnings power. In the definition of earnings power, sustainable distributable earnings are the average earnings that a company would generate in the future if its underlying operations were to continue without change. We include average in this definition to smooth out business cycles and other temporary fluctuations, positive and negative, to which short-term earnings are subject. Sustainable earnings are earnings measured after making the investments necessary to return a company's operations at the end of the year to their condition at the beginning of the year. This calculation involves correcting accounting mismeasurements of non-cash expenses such as depreciation. The distributable part of the definition is intended to deal with a second set of accounting issues. Many growing firms incur expenses for research and development, advertising, marketing, and the hiring and training of new personnel that exceed the level required to maintain the firm's current economic position. A proper sustainable earnings calculation should eliminate these excess growth-related expenditures from costs before calculating adjusted accounting earnings. Shrinking firms may underinvest in similar expenditures, e.g., cutting R&D below what would be necessary to sustain earnings, or raising prices to increase current revenues at the expense of future market position. For these firms, the estimated shortfalls must be subtracted from adjusted accounting earnings to arrive at a sustainable earnings power. Companies often record one-time events, both positive and negative, as adjustments to earnings. Usually these are related to gains from operations sold off or losses on prior investment mistakes. Theoretically, since they are unrelated to the ongoing operations of the firms, they should be ignored in calculating sustainable earnings. But for some companies, these supposedly isolated incidents are frequent, even annual, recurrences, used to conceal ongoing costs that should in fact be deducted from sustainable earnings. In such cases, some fraction of the average level of one-time charges should be treated as actual operating costs for the purposes of calculating sustainable earnings power. Even when these regular charges are legitimately independent of ongoing operations, they represent a reduction in the value of distributable earnings. To the extent that they are a regular feature of management's performance, their average level should be subtracted in calculating earnings power. Revenues tend to be far more stable than profit margins over business cycles and are subject to smaller random fluctuations. Therefore, except for highly cyclical businesses, such as natural resources where revenues do fluctuate substantially, the customary way of calculating sustainable earnings is to begin with the current year's revenue and multiply that by an average level of margins over a period that ideally encompasses at least 2 business cycles. A simple arithmetic mean is the natural place to start. But calculation of average margins may in practice be more complicated. Often margins exhibit secular trends, increases or decreases that must be taken into account. A common temptation will be to extrapolate these trends by using a sustainable margin figure well below the current margin when profitability is declining, or conversely by selecting a higher margin when profits margins are growing. This temptation should be resisted. Graham and Dodd understood the dangers of forecasting. Forecasts, especially reflexive trend extrapolations, should not be allowed to contaminate basic value estimates. There are two ways of dealing with secular margin trends in the spirit of Graham and Dodd. The first is simply to ignore them and use the arithmetic mean. This is likely to be the best way to proceed when there is no observable economic or strategic reason that can account for the trend in margin. If, on the other hand, there is an obvious source for changes in margin, such as continuous adverse technological developments that intensify competition and impair industry margins or improve operating leverage as revenues grow, then using the most recent margins, adjusted as necessary to account for other cyclical conditions, is appropriate. Any further future margin improvement or deterioration should be dealt with as part of the value of growth. A second question is which margin figure to use. Gross margins, operating margins, pre-tax margins, and net income margins are all potential candidates. The argument for using gross margin, revenue minus direct product costs, is that it is the hardest to manipulate. The overhead expenses that represent the difference between gross margins and operating margins, including research and development, marketing, and general and overhead expenses, can be increased or decreased by management to make current operating margins look better than they really should be. For example, by cutting research and development, management can raise current operating earnings with relatively little impact on current sales. However, there may be a substantial cost in lost future opportunities. But even gross margin is not a pristine figure. Accountants have considerable discretion in allocating expenses between direct production costs and overhead. Moreover, they can usually do this on paper rather than by distorting company operations, so that the economic costs of fiddling with gross margins will generally be lower, and therefore a greater temptation, than the cost of manipulating operating margins. Moreover, overhead costs are real costs. Ignoring them will always lead to a mistaken estimate of distributable earnings. Our preference here is to focus on operating earnings, but to adjust them for inexplicable changes in R&D, marketing, and other overhead expenses that are likely to be due to management earnings manipulation. There are two significant differences between operating income, often referred to as EBIT, earnings before interest and taxes, and pre-tax income, or EBT, earnings before taxes. The first and usually the more important is net interest, which is the difference between interest earned on cash and other financial assets and interest paid on a company's debt. The amount of net interest generally depends on the degree to which the company relies on debt financing. There are two ways to account for the extent of such leverage. The first is from the income statement. We can simply base our earnings power estimate on post-interest, pre-tax earnings. This approach assumes that the burden of leverage is constant over an indefinite future. But debt levels, especially increasing debt levels, are a matter of financial policy that may be changed relatively quickly at the discretion of management, and interest rates will fluctuate. When interest rates are unusually low, current pre-tax earnings will be at levels that are not sustainable when interest rates rise. The same problem in its inverse applies when interest rates are unusually high. They are likely to come down, and pre-tax margins will increase. A firm's underlying business, by contrast, is usually more stable, and changes only slowly over time. If it does not have these characteristics, it is going to be difficult to value the firm at all. Operating income, therefore, is a better place to begin thinking about sustainable earnings power than pre-tax income, even when interest is a significant expense. Table 5.1. A second way of dealing with leverage is to look at the level of net debt rather than current interest payments. We can calculate an enterprise earnings value for a firm's operating business, ignoring net interest payments, and then adjust that value to get an equity value by subtracting the estimated value of net debt. As a first estimate, we can use the latest book values of debt minus cash and marketable securities. If necessary, these figures can be adjusted to approximate market value by looking at current market prices of the firm's debt securities, both owned and owed. We prefer the net debt approach because the balance sheet levels of debt, cash, and marketable securities are measurable with considerable accuracy, whether based on book values or market prices. On the cash and security side of the equation, a company's accounts should generally already have marked the book values of cash and investments to best estimates of the market value. EPV is the value of the company's operating business. The sum of this value goes to holders of the debt, leaving less for the owners of the equity. To calculate the EPV for the equity holders, we must subtract this amount, which should in theory be the value of the outstanding debt. At the same time, the portion of the cash and financial investments that are not required to support the basic operations of a firm represent value to the equity owners above the basic earnings power value of the company. Conventionally, all the cash and financial investments are assumed to be extraneous to operations. In practice, a firm needs some of these assets, perhaps 0.25 to 0.5% of revenues, for its smooth functioning. These amounts should be subtracted from overall cash and investments before adding them to the EPV of the company. Thus, there is no compelling need to add the errors inherent in projecting future interest rates to the calculated earnings power. A second major difference between operating earnings and pre-tax income is the earnings of unconsolidated subsidiaries, joint ventures, and minority interest in consolidated operations. As in the case of debt, these items appear on both the firm's balance sheet and its income statement. If they are peripheral to a firm's principal business, as often happens, there is a strong case to be made for handling these factors as adjustments to operating income. These assets and liabilities rarely trade in public markets. Private market values are often difficult to obtain unless full details for the relevant operations are included in footnotes to a firm's financial statements. Book values are based on original equity investments, adjusted for historical gains and losses that may bear little relationship to current economic values. For example, an unconsolidated venture may be near the end of the period of losses incurred in building the business, but may have significant current profitability. Actual value will be more accurately reflected in current profitability. If there is a significant discrepancy between the value of unconsolidated operations based on current earnings power and the values recorded on the balance sheet, then operating income should include these items before calculating average sustainable distributable income. If there is no such obvious discrepancy, then balance sheet adjustments, similar to those used in accounting for debt, can be used. In either case, the basic starting point for estimating earnings power will be operating margins and operating earnings. Taxes are real and inevitable reductions of earnings power, and operating earnings must be adjusted to take them into account. Again, operating earnings are the best place to begin. Average sustainable operating income, properly calculated, reflects the underlying economics of a company's business. For firms that can be reliably valued, This figure must be fairly stable, even taking into account average cyclical fluctuations. Taxes depend on government tax policies that are subject to periodic change. Average operating margins, including at least one or ideally two business cycles, may be calculated over a period of 7 to 15 years. Current average tax rates are likely to be stable over no more than 5 years. There is an obvious mismatch between the two time periods. The purpose of this entire exercise is to calculate the average distributable, meaning after tax, earnings as the firm sits there today. If there has been a major recent tax law change, then average tax rates since that change will be the relevant ones. It is common to make a distinction between cash taxes actually paid and tax liabilities calculated for income accounting purposes. For NPV calculations, the annual cash flow impact of taxes actually paid is the proper measure of the tax burden. But earnings power calculations are designed to capture average tax levels assuming no growth. Since long-term discrepancies between cash taxes and accrued taxes depend largely on growing tax credits, the no-growth assumption argues for using accrued taxes. In the long run, these accrued taxes must be paid. They are therefore the proper adjustment to earnings power. We can now lay out the steps in a basic earnings power calculation before accounting and other adjustments. 1. Calculate an average operating margin over an appropriate period. 2. Multiply this margin by current sales or an estimate of average sustainable current sales. The product is an estimate of operating earnings, EBIT. 3. Adjust this estimate for the impact of the earnings of unconsolidated operations. 4. Calculate after-tax operating income by multiplying the pre-tax figure by 1 minus an appropriate average tax rate. Adjusted EBIT times open bracket 1 minus average tax rate, closed bracket. 5. The result is an estimate of sustainable distributable net operating profit after taxes, NOPAT. Adjusting for non-cash costs, depreciation, and amortization. Depreciation is the most significant area where there may be major differences between accounting measurements of non-current costs, the gradual wearing out of capital equipment, and economic reality. Accounting depreciation is calculated by spreading the historical acquisition costs of capital investments over an estimated useful life of each of the various types of investments involved. In the estimation of earnings power, actual depreciation is the cost of restoring the condition of the company's fixed capital at the end of the year to its state at the beginning of the year. It is the capital expense required to replace the lost capability of the firm's capital stock over the course of the year, or replacement CapEx, capital expenditures. Since replacement occurs in the present, the appropriate measure is the current cost of capital equipment, plants, and structures, rather than some arbitrary portion of the historical cost. There are two obvious differences between these accounting depreciation figures and replacement CapEx requirements. First, if there are trends in capital goods prices, current costs will differ substantially from historical costs. Inflation-driven trends of increasing costs, in railroad construction, for example, will cause replacement prices to exceed historical ones, and accounting depreciation will understate true depreciation. Technologically driven cost reductions, as in information technology equipment, especially when improved machine performance is taken into account, will lead to replacement costs below historical costs, and accounting depreciation will overstate them. In either case, direct estimates of replacement capital expense should be used in place of accounting depreciation. A useful method of estimating replacement CapEx is to start with overall capital expense and then subtract an estimate of the capital expense devoted to supporting growth. Estimation of growth CapEx can be done in at least two ways. One way to segregate the two is to look for the periods of little or no growth in the history of the company, or of comparable competitors. During this time, total capital expenditures reported on the cash flow statement should consist almost entirely of replacement capital costs, since growth-related capital costs should be negligible. Any discrepancy between total capital expenditures and accounting depreciation should capture the necessary adjustment that needs to be made to actual earnings. A second approach is to estimate growth capital costs by multiplying growth in sales by an estimate of the firm's capital intensity, which is the ratio of fixed capital to sales calculated over an appropriately recent historical period. For example, if each dollar of sales appears to require 30 cents of capital investment, then a year in which sales grow by $80 million should require roughly $24 million in growth-related capital expenditures. This growth, CapEx, can then be subtracted from total CapEx to obtain an estimate of what is being spent purely to restore the fixed assets to their level at the start of the year. This estimate can be used in place of accounting depreciation as a more accurate figure of actual replacement capital costs. Some companies, such as railroads, will report their own estimates of replacement directly. Others report the details of their capital expenditures that can then be roughly divided into growth and replacement amounts. Detailed industry knowledge may enable an analyst to make these adjustments with remarkable accuracy, even if only aggregate investment and facilities growth numbers are known. Those who make a diligent effort to improve on reported accounting depreciation in the calculation of earnings power will have an advantage over those who simply rely on the official financial statements. One shortcut should always be avoided. Analysts will often use earnings before interest, taxes, depreciation, and amortization, EBITDA, in their measure of the company's basic earnings power. The unstated assumption is that replacement costs for both tangible, depreciation, and intangible, amortization, capital are zero. This is hardly ever the case. Buildings and other structures will often have accounting lives that are far shorter than their real economic lives. Their replacement values may actually increase rather than decrease over time. Adjustments to accounting depreciation of these assets must certainly be made. However, even buildings eventually wear out, and like equipment, they must be replaced. Assuming zero depreciation is inappropriate, even in these instances. The same is true for amortization. A product portfolio, customer base, or a trained labor force will deteriorate over time and need to be replenished. In the case of intangibles, however, the necessary replacement expenses may in fact be included in overall operating costs. Under these circumstances, including amortization as a cost will involve double counting, and adding back amortization to EBIT will be appropriate. In general, however, there is always a danger that relying on EBITDA will overstate earnings and lead to overvaluation, and therefore overpayment for securities. A carefully calculated earnings power with proper adjustments to depreciation, expensed investments, and other accounting distortions will be a far superior measure of sustainable distributable earnings. EPV and estimating the cost of capital. The final step in computing a company's earnings power value is to divide its estimated earnings power by another estimate, this one of its cost of capital. This process converts the flow of earnings power into a level of value. Ultimately, we want to know what a firm is worth based on an estimate of reliably identifiable future earnings for comparison to the market price we must pay. Value is what an intelligent, well-informed investor is willing to pay for the firm at that level of sustainable earnings. Suppose the firm generates $25 million as a constant average annual future level of after-tax distributable earnings. The amount an investor would be willing to pay depends on the return he or she requires in order to voluntarily commit funds to acquiring the firm. If this figure is 10%, the investor will pay $250 million. $25 million represents an annual return of 10% on a $250 million investment. If the investor requires 12.5%, he or she will pay only $200 million, since $25 million represents a 12.5% return on $200 million. At an 8% required return, the firm will be worth $312.5 million, since the $25 million is 8% of $312.5 million. In each case, we obtain what the investor is willing to pay by dividing the earnings power by the investor's required return. Thus, the earnings-based value of the firm is EPV equals EP divided by required return. This required return is just the definition of a firm's cost of capital, the returns it must pay to attract investment voluntarily. The lower the required rate of return, the higher the value of the company. Estimation of the cost of capital, therefore, means understanding how investors determine their required returns and how these individual required returns translate into an appropriate required return for the firm. If we were asking about the average cost of labor per hour, there would be no mystery about how to proceed. We would identify the different types of labor to be hired, from highly skilled professionals to unskilled workers. We would estimate the fraction of the labor force in each category and the level of wages necessary to attract sufficient employees in each group. In competitive labor markets, we would look at what other firms are offering for similar jobs. Average wages would be calculated by multiplying the required wages for each class of workers by the fraction of such workers in our labor force and summing to get the total. We use an equivalent procedure to estimate the weighted average cost of capital. Firms basically employ two types of capital, debt and equity. The first step is to decide on the appropriate mix of debt and equity used in financing a firm's operations. Looking at the historical financial structure will be the best way to begin, just as we would look at the historical mix of labor types employed to estimate our hiring mix. However, there is one important difference when we consider the cost of capital. Debt financing imposes fixed payment requirements on a company that equity financing does not. Consider a firm that relies heavily on debt. As a rule, after-tax interest costs per dollar of financing are lower than equity costs, if only because interest payments are tax-deductible for firms. A highly leveraged firm, one with a high fraction of debt financing, will have a low calculated average cost of capital. However, this debt imposes a hidden cost. In times of economic stress, high debt, because of its payout obligations, may significantly impair the efficiency of a firm's operations. In a worst case, it will force the firm into bankruptcy. These distress costs are hard to quantify, but still need to be taken into account in calculating the cost of capital. They are not part of the cost of equity because equity financing does not interfere with company operations. Using a weighted average observed cost of debt and equity may grossly understate the true cost of capital for a company with excessive leverage. One way to handle this problem is to use a weighted average based on historical levels of debt and equity, but to set the weight of the debt at a conservative level below which it is unlikely to significantly impair a company's operations. For example, suppose that a company's recent debt level has been 70% of overall financing, but the upper limit of a safe level of debt is about 30%. Above that level, there is a significant probability of operational impairment. In that case, we would use 30%, not 70%, as the weight of debt in calculating the cost of capital. Graham and Dodd solved this problem by not investing in companies with high leverage, but we want to add a level of precision and open up opportunities. The way to estimate the cost of debt is analogous to estimating the cost of labor. Look at the yields available on publicly traded debt with comparable risk characteristics to the debt of our company. If that debt trades at yields of 5%, then our company will have to pay 5% to attract debt funding. This is the pre-tax cost of debt. If interest on debt is subtracted from profits before paying corporate income tax, then the net after-tax cost of the debt will be reduced by the tax saved. If corporate tax rates average 30%, that makes the after-tax cost of the company not 5% but 3.5%, thanks to a corporate tax saving of 1.5%, 30% of 5% on debt financing. It is in this adjustment to the cost of capital that we account for any tax savings associated with debt financing. That is why we apply the corporate tax rate to all of operating earnings in calculating NOPAT. The cost of equity is more difficult to estimate than the cost of debt. Debt instruments provide well-defined returns whose yields, in the absence of default, are easy to calculate. Stocks produce both dividends, which may vary due to business conditions and are at the discretion of management, and capital gains, which depend not only on the performance of the company, but on overall financial market circumstances. For equity investments, we cannot simply identify comparably risky stocks and look at a stated yield on an investment in those stocks. Despite these hurdles, it is possible to make sensible estimates of the cost of equity capital. We begin by recognizing that because debt receives a contractual payment schedule and has a prior claim on a company's assets and earnings, debt investments are inherently less risky than equity investments. Thus, if investment-grade, at least BAA-rated bonds, with low probabilities of default yield, returns of 5%, a reasonable lower bound on the cost of attracting higher-risk equity financing is going to be 6%. At the other end of the risk spectrum, venture capital is widely regarded as the riskiest form of equity investment. It involves buying the shares of promising companies without either established economic positions or documented operating histories. A high proportion of these investments fail. Venture capital firms that make such investments regularly provide two kinds of information on the returns they must offer to attract capital. They report the levels of returns on their past funds, and they respond to industry surveys asking directly for the level of expected returns necessary to market their latest venture funds. Not surprisingly, these figures tend to cluster together. Historically, these venture costs of capital have been as high as 18 to 20%. More recently, they have been in the range of 13 to 14%, as overall investment returns have fallen with interest rates. Required equity returns for established firms without dangerous levels of leverage should be below this venture capital level at around 13% or less. Thus, the cost of equity capital in 2020 is likely to fall in a range between roughly 6% and 13%. If we are able to make qualitative judgments of the risks associated with investments in different firms, we may make our estimate more precise. We can divide company equities into low risk, e.g., utilities and stable consumer non-durable companies such as Coca-Cola, moderate risk, e.g., general non-financial service businesses such as United Parcel, and high risk, e.g., cyclical industrial and commodity companies such as Freeport, McMoran. Low-risk equities typically have cost of capital of 6 to 8%, or roughly 7%, moderate risk equities need to offer 8 to 10%, or about 9%, and high-risk companies would face a cost of equity capital of 11 to 13%, an average of about 12%. By deciding into which risk category a particular company should be assigned, we can narrow the overall 6% to 13% range for establishing its cost of equity. As an example, we have a company in the moderate risk category that is financed with 20% debt and 80% equity. The debt has a pre-tax cost of 4.5%, which translates into 3% after taxes. The equity costs 9%. Putting the two together, we have a calculated cost of capital of 7.8%, Table 5.2. In practice, this level of precision in estimating the overall cost of capital is unrealistic. We should use 8% for computing our earnings power value, unless we had grossly misjudged the company's perceived risk and therefore its cost of attracting capital. We are not likely to be off in this estimate by more than around 1% or so in either direction, close enough for financial work. An alternative approach to estimating the cost of equity financing is provided by modern portfolio theory, MPT. One of the tenets of that theory is that the relevant measure of risk for any security is the incremental variability that it adds to a fully diversified portfolio, which is defined as the whole relevant market. The more variability the stock adds to the portfolio, which is designated beta in MPT, the riskier the investment, at least as risk is defined here. The market itself has, by definition, a beta of 1. A 1% change in the market equals a 1% change in the market. If a stock rises or falls by only 0.5% for each 1% move in the overall portfolio, adding more of that stock will lower the overall variability of the portfolio. This is the sense in which a stock like this, which has a beta of 0.5, represents a low-risk investment. In contrast, if a second stock rises or falls by 1.5% for each 1% move in the market portfolio, adding that stock to the market portfolio will increase the overall market variability. This second stock, which has a beta of 1.5, is a high-risk investment. The higher the beta, the riskier the stock. According to MPT, investors should require higher rates of return from stocks with higher betas, which are riskier by this definition. The amount of that required return can be calculated by looking at the average historical difference between the return on the market portfolio, with its beta of 1, and the return on a risk-free asset, usually assumed to be the short-term debt of a stable government securities, such as 3-month Treasury bills. Estimates of this extra return, the market risk premium, per 1 unit of beta risk run from 3 to 7%, depending on the relevant estimation period used. Another estimate of the overall cost of capital for the equity of a company with an arbitrary beta is the risk-free rate plus the risk premium per unit of beta multiplied by the estimated beta of the company's equity. Cost of equity capital equals risk-free rate plus beta times market risk premium. Betas are estimated from the slope of the historical plots of returns on the equity security in question against contemporary market returns on either a daily, weekly, or monthly basis. The beta of an average stock is 1. Errors in estimating betas are on the order of plus or minus 1/2. Thus, the beta-based estimate of the cost of capital for a moderate risk stock, at a time when the risk-free return is about 1%, runs from 2.5%, 1% plus a risk premium of 3% times a beta of 0.5, to 11.5%, 1% plus a risk premium of 7% times a beta of 1.5. In practice, for all the elegance of the theory, this range of estimated values is far too wide to be useful. The simple qualitative process described before will usually do far better. Earnings power value, equity value, and enterprise value. Once we have estimated an earnings power, including appropriate corrections for accounting depreciation and other adjustments, and a cost of capital, we can calculate the earnings power value EPV. This is an earnings-based valuation of a company's basic operations, as described in its financial statements. However, there is a final set of adjustments that must be made before the EPV can properly be compared to a company's asset value and its market price. Some of these adjustments relate to earnings. As we have noted, there may be peripheral, unconsolidated operations that are not included in operating income. Other adjustments are found on the balance sheet. There are valuable, non-operating assets that could be disposed of without impairing operations, such as excess cash, marketable securities, and non-core real property holdings. On the liability side, there are obligations that a company has incurred that may exist independently of its operating business and that do not involve explicit interest payments. Such legacy liabilities include unfunded pension obligations, unfunded retiree medical benefits, litigation cost overhangs, environmental remediation responsibilities, and similar balance sheet entries. There are a few key distinctions we need to keep in mind as we proceed between earnings power value and asset value, between the enterprise as a whole and the equity portion of it, between intrinsic value and market price. This last distinction is at the core of value investing, but it needs increased attention here because the term enterprise value can be used to refer to both an intrinsic value and a market price. We will start with the distinction between an equity approach and an enterprise value approach. Table 5.3 summarizes the key points of difference, which we discuss in more detail later. The earnings power value, the earnings power divided by a company's cost of capital, represents the value of the company's ongoing core operations. It differs from the value of the company's equity in two important ways. First, the company will often own assets that have significant value but are not required for sustaining ongoing operations. The value of these extraneous assets must be added to the core enterprise value in order to arrive at the equity value of a company. Just like the earnings of the enterprise, these assets belong to the firm's shareholders. Second, there are claims on the firm's operations and assets that must be paid before the shareholders receive their due. Outstanding debt is the most obvious of these obligations, but there are other debt-like liabilities that are not intrinsic to the firm's operations, which also must be satisfied. These include those pension obligations and other legacy liabilities, such as environmental charges and other legal settlements. The total of these claims, which we will refer to simply as debt, must be subtracted from the sum of core earnings power value plus extraneous assets to arrive at the value of the shareholders' stake in the company. Spontaneous liabilities such as accounts payable and accrued taxes arise in the normal course of business operations and need not be repaid on average, as long as a business sustains its current level of operations, and they do not usually require explicit interest payments. These spontaneous liabilities should not therefore be subtracted from the enterprise value in arriving at an equity value. To recap, the core earnings power value, EP divided by cost of capital, is an enterprise value. The value of a firm's equity is this enterprise value plus the value of extraneous assets minus debt obligations, broadly defined but not including spontaneous liabilities. By contrast, net asset values, which are calculated by adjustments to the book value of a firm's equity, are equity values from the start. Extraneous assets have been included, and the accountant's estimate of debt obligations has been subtracted to arrive at net worth, which is shareholder equity. Since we are primarily looking at equity investments in this book, it is natural to think of a margin of safety as the difference between the estimated value of a firm's equity, triangulating between earnings power and asset values, and the firm's market capitalization, which is the cost of buying the company's outstanding stock at its current market price. But we could equally well look at a margin of safety in buying the firm's ongoing enterprise. The value of that enterprise is measured by its earnings power value, sustainable earnings divided by cost of capital, on the one hand, and the net asset value associated with the core enterprise on the other. In this case, we must make adjustments to the traditionally calculated asset value of the equity. First, we must subtract the value of extraneous assets, since they do not support core operations. Second, we must add back the value of the debt liabilities, since we are calculating the firm's full enterprise value, not just the part of that value that accrues to stockholders. As with the equity valuation, spontaneous liabilities should not be added back, since they are intrinsic to the enterprise and do not require payments out of enterprise earnings. With these adjustments, we can triangulate between the earning power value and the asset value of the ongoing core enterprise to arrive at an intrinsic enterprise value. The margin of safety in buying this core enterprise is the difference between its intrinsic value and what we would have to pay to acquire it in the financial marketplace, including the debt and deducting what we could get from selling off assets extraneous to the core operating business. The result of subtracting the value of the extraneous assets from a firm's market cap and then adding the value of the outstanding debt is usually referred to as the firm's enterprise market value. This figure can be subtracted from our estimated enterprise intrinsic value to arrive at the margin of safety that applies to purchasing a firm's core ongoing operations. We can consider investments as either equity or enterprise purchases, provided we are careful to compare equity values to equity market caps and intrinsic enterprise values to market enterprise values, market cap minus extraneous assets plus debt. Even though the simplest way to proceed is to look at equity investments in terms of equity values, there is at least two advantages to taking an enterprise value approach. When we come to address the question of growth, we emphasize that growth rates typically apply to a company's core operating businesses. Non-core assets, legacy liabilities, and debt are driven by very different factors for which business growth is likely to carry limited weight. In assessing the contribution of growth to value, it clarifies matters considerably to focus on the enterprise and not overall values. In addition, where a company is highly leveraged, the extent to which its equity appears to be a bargain may be dangerously misleading. Suppose we estimate a company's basic EPV to be $800 million. Assume it has $50 million in cash and securities and debt of $700 million, or $650 million of net debt. The total equity value of the firm will be $800 million minus $650 million equals $150 million. If the market value of the firm's common stock is $75 million, it looks as if we have found a bargain with a large margin of safety. We can buy the firm for 50% of its equity value. However, if the accuracy of our estimated enterprise value, EPV and AV combined, is plus or minus 15%, which is in practice a high level of precision, then the enterprise value may easily be as low as $680 million, $800 million minus $120 million. At this level, the value of the equity will be only $30 million, $680 million minus net debt of $650 million, well below the $75 million market price of the equity. In enterprise terms, we are paying $725 million, $75 million for the stock, $700 million for the debt, less the $50 million in cash we collect, for a company operations with a value of $800 million, which leaves a margin of safety of less than 10%. Since value miscalculations are related to the size and uncertainty of the enterprise value, the enterprise margin of safety is usually a more appropriate basis for investment decisions than the equity margin of safety. One last point should be stressed. Valuations may readily be calculated on either an enterprise or an equity basis. Assets' values are naturally calculated on an equity basis, but can easily be adjusted by adding debt and legacy liabilities and subtracting cash, securities, and non-core assets to obtain an enterprise value. In contrast, earnings power values are fundamentally calculated on an enterprise basis, but can easily be adjusted to obtain equity valuations by deducting interest payments. In either case, there must be consistency. Equity asset values must be compared to equity earnings power values and the costs of acquiring a firm's equity. Enterprise earnings power values must be compared to enterprise asset values and enterprise acquisition costs. This admonition is obvious, but even seasoned investors have been confused or ignored it altogether. Example 2. Magna International. Warren Buffett's classic advice, to be fearful when others are greedy and greedy when others are fearful, applied with special force in March 2009. Following the Lehman Brothers bankruptcy on September 15, 2008, global equity markets collapsed. Driven by fears of the second Great Depression, the S&P 500 index fell from 1,400 in May 2008 to 683 on March 6, 2009. A bottom appeared to be nowhere in sight, although that 683 print turned out to be the nadir. An environment so redolent of fear has historically presented extraordinary opportunities to produce stellar returns by buying companies at very low prices. And taking maximum advantage of these opportunities means looking at the most damaged parts of the stock market for companies that are unlikely to go bankrupt or suffer severe impairment to their operations. In early March 2009, those financial institutions that survived, often with government help, represented the scariest part of the stock market. But their safety and potential for survival was very difficult to assess. The second scariest part of the market was the automobile industry. In January, Chrysler had announced a potentially life-saving alliance with Italy's Fiat. But without major government support, the deal could not be done. And without the deal, Chrysler would have been forced to declare bankruptcy. On February 26, 2009, General Motors announced that it had lost $30.9 billion in 2008. Its cash reserves were down to $14 billion, and without substantial government assistance, it too would be forced into bankruptcy. And these were not idle threats. On April 30th, Chrysler filed for bankruptcy. In June, General Motors followed suit. Independent parts suppliers to the major auto manufacturers were in even worse shape. Delphi, the leading parts supplier that had been spun out of GM in 1999, had filed for bankruptcy in 2005. In May 2008, it had tried and failed to put together a plan to emerge from Chapter 11. Visteon, spun out of Ford in 2000, was delisted from the New York Stock Exchange in March 2009, as its stock price had fallen from 7 cents to 2 cents. Visteon's UK subsidiary subsequently filed for bankruptcy on March 31, 2009, and Visteon itself followed on May 28th. Lear Corporation, a major producer of automotive interiors and electrical systems since 1917, sought to save itself by spinning off its money-losing interior systems division in 2009. Lear had to pay the buyer to take it, but it was still near bankruptcy in March 2009. Ultimately, it filed for Chapter 11 protections in July. The imminent failure of their major customers, Chrysler, GM, and perhaps even Ford, threatened to deal a final death blow to the already weak parts supplier, who would be forced to write down the value of their accounts receivable and see their future business evaporate. To make things even chancier, many of these suppliers operated with large debt loads that heightened their vulnerability. Magna International, the one-part supplier unburdened by leverage, had other concerns. Incorporated in Canada, it was controlled via a dual share class by its controversial founder, Frank Stronach. Stronach held the majority of Magna's B shares, each of which had 500 votes, compared to 1 vote each for the A shares. As a result, even though he owned only about 20% of the economic interest in Magna, Stronach had absolute control of the board selection process, and hence the company itself. He exercised this control without restraint. In 2008, he was paid a relatively small salary from the company, but a consulting firm of which Stronach was the sole employee had a long-term contract providing management services to Magna International. In the 13 years from 1996 through 2008, Stronach received more than $350 million from this arrangement, almost $30 million per year. That deal was not the only way that Stronach used his control of Magna International to enrich himself and support his personal interests. Passionately involved with thoroughbred horse racing, he was one of the largest racehorse owners in North America. In 1998, Magna, a car parts supplier, began to invest heavily in racetracks and auxiliary racetrack betting enterprises. These investments were organized into a separate subsidiary, Magna Entertainment Corporation, MEC. In 1999, MEC was spun off as a distinct entity listed on U.S. and Canadian stock exchanges, even though 90% of the stock remained in Magna International's hands. As a separate entity, MEC consisted of the horse racing properties, a greyhound track, 2 golf courses, and additional real estate to help ensure its economic viability. By December 31, 1999, Magna had invested $550 million in MEC. Profits were minimal. In 2000 and 2001, MEC had pre-tax earnings of $5.4 million and $2.4 million, respectively. In April 2002, MEC completed a secondary offering of 23 million shares, raising $142 million in additional capital. In 2002, the company had a pre-tax loss of $25.2 million, despite additional racetrack acquisitions for stock. At that point, Magna decided to place its residual 59% interest in MEC, together with its remaining portfolio of real estate, almost entirely leased to Magna International, into a new entity, MI Development, MID, which was spun off to stockholders on September 2, 2003. Shareholdings and share classes in MID mirrored those of Magna International, so that Stronach continued to have absolute control of the company. MID's subsequent history was as troubled as that of MEC. Its MEC subsidiary continued to suffer large losses. From 2003 to 2007, they totaled $412 million. These losses required substantial capital inflows in order to sustain MEC as an operating enterprise. From 2004 to 2008, contributions from MID came to $341 million. Despite the additional cash, MEC filed for bankruptcy on March 5, 2009. The shareholders of MID were dissatisfied with these practices, and MID was the subject of significant shareholder activism and lawsuits. Ultimately, in an effort to repair some of the reputational damage, MID changed its name to Granite Properties. Overall, Stronach's interest in horse racing may have cost Magna shareholders as much as $1 billion. A second troublesome Stronach intervention in the operations of Magna International was the installation of his daughter Belinda as CEO in February 2001. Belinda Stronach had attended 1 year of college and then left to begin working at Magna International. In 1988, at the age of 22, she became a director of the company. By 1997, she was a corporate vice president and head of its Divisia operating group. In 1998, she was promoted to executive vice president and within 3 years was CEO. She resigned from that position in January 2004 to pursue an interest in Canadian politics, where she had a brief but eye-catching career. She ran for the leadership of the Conservative Party against 2 experienced politicians, and having refused to join any of the public debates, finished a distant third. She later won election as a Conservative MP and then crossed the floor to the Liberal Party and provided the single-vote margin that the Liberals needed to survive in a parliamentary vote of no confidence. As a Liberal, she received a junior ministerial position. But her controversial social relationship with a senior Liberal minister was a factor that contributed to the demise of the Liberal government. As a result of that and health issues, Belinda Stronach left politics. By 2007, she was back at Magna International as a senior executive in charge of special projects, for which she received $3.8 million as compensation in 2008. One last aspect of Magna's situation in March 2009 merits attention. In 2007, Stronach had entered into a joint venture with Oleg Deripaska, one of the more controversial Russian oligarchs, to produce automobiles in Russia. As part of his contribution to this venture, Deripaska purchased shares in Magna International at slightly below prevailing market prices. In the subsequent financial crisis, commodity prices dropped sharply, including the price of aluminum. Deripaska's fortune was based on his control of Russia's leading aluminum producer. His core enterprise under pressure, Deripaska was forced to sell his recently accumulated Magna shares. This added selling pressure helped contribute to a decline in Magna's share price from the peak of $97 per share in October 2007 to slightly under $20 per share at the beginning of March 2009. The Magna situation looked grim. It was operating in an industry under long-run economic pressure, with 2 of its major customers facing imminent bankruptcy. It was controlled by a manager with a checkered history of using the company as his personal piggy bank. The broader financial climate was dominated by fear and uncertainty. Magna's stock price had fallen by roughly 80%. By conventional measures, Magna was cheap. At $20 per share, the market value of Magna's equity was $2.24 billion, just 30% of its equity book value. The dividend yield was 6.3%. Although the P/E ratio for 2008 was 31.5 times, that was due to an unusually large temporary tax bill and depressed 2008 earnings. With a more normal tax rate of 33% and still depressed earnings at the 2007 level, the P/E ratio would have been 3.5 times. Magna International in early March 2009 was potentially an extremely appealing investment opportunity. However, given the many associated problems, which are what created the opportunity, an investor would need to do a painstakingly careful analysis before committing any funds. The first step in that analysis was to determine the extent to which Magna was subject to the risk of bankruptcy, the ultimate permanent impairment of equity capital. The December 31st, 2008 balance sheet for Magna is presented in Table Example 2.1. It shows $2,757 million in cash, $194 million in long-term financial assets, auction rate notes with little default risk that had to be reclassified as long-term only because the auction market rate selling mechanism was temporarily impaired, and $1,209 million in debt. Most other auto parts suppliers were highly leveraged. Magna had $1,742 million in net cash at the end of 2008. And cash flow from operations minus investment was $315 million, $1,054 million less, $739 million in investment. In prior recession years, cash flow from operations had been only slightly negative, as decreases in investment to less than depreciation and amortization and reductions in working capital offset net losses. Unless conditions in the auto industry deteriorated severely for a very long time, Magna International was not going bankrupt. The next question was the long-run future of North America and European auto industries. Roughly half of Magna's business was in Europe, and of independent parts suppliers such as Magna. In the long run, it appeared highly unlikely that either the industry or the independent parts suppliers were going to disappear. In 1967, McKinsey had provided a report to the newly established United States Urban Mass Transportation Administration on the future of U.S. transportation. McKinsey forecast that the future would involve independently guided vehicles operating on shared use rights of way. Translated from consultant speak, it predicted there would be cars, trucks, and buses operating on roads. As late as 2009, McKinsey had been proven right. Nothing about transportation technology in the intervening years seemed to indicate that the advantages of independently guided vehicles and shared use rights of way would vanish. North American and European automobile production was protected by another significant long-term trend. Automation in manufacturing was rapidly reducing the labor input required in car production, which in turn reduced the benefits of manufacturing in low-cost labor markets outside Europe and North America. Reductions in transportation costs were much less dramatic. Seaborne transportation already used very little labor, and the benefits of being close to end markets were, if anything, increasing. As a result, by the mid-2000s, high-end manufacturing production, such as automobiles, but not manufacturing employment, was returning to developed economies from the less developed ones. This trend was likely to continue. Finally, continued unionization and/or high wage levels at the big auto producers in Europe and North America meant that the cost advantages of independent parts manufacturers like a Magna were not going to erode. Having confidence that the immediate bankruptcy risk of Magna was low and its long-term economic future was not in serious jeopardy, an investor should be prepared to expend the effort to develop a detailed evaluation for Magna International. The way to begin that valuation was by looking at Magna's asset and earnings power values in early 2009. The value of growth was likely to be minimal. Magna's customers were large automobile manufacturers, General Motors, Ford, Daimler-Benz, BMW, with large professional purchasing departments, not about to let themselves be captive to any particular parts supplier. Economies of scale were also likely to be relatively insignificant. There were many companies like Magna, each of which had multiple manufacturing facilities. Dominant competitors in any auto parts market were rare. Without barriers to entry, the value of growth for Magna, as for any company without a sustainable competitive advantage, was likely to be minimal. Historical returns on equity confirm the reality of a competitive market. Asset value. In Chapter 4, we computed the reproduction value of assets of several fictitious firms on a line-by-line basis going down the asset side of the balance sheet. We then did the same for a company's liabilities. In those cases, which we constructed to be representative, the estimated reproduction value of many assets and liabilities differed only minimally from their book values. This applied to most liabilities and most current assets. In practice, therefore, it is usually more efficient to begin with the net book value of assets and then add or subtract amounts that reflect differences between the reproduction and book values only for those assets and liabilities for which these differences are significant. For Magna, the important differences are 1. Between the book value of goodwill and the reproduction values of the intangible assets giving rise to that goodwill, and 2. Between the book value and reproduction costs of fixed assets. The book value of equity for Magna at the end of 2008 was $7,336 million. The various elements of fixed assets are presented in Table Example 2.2. As we did in the case with Hudson General, for land and buildings we called local assessors in the area where Magna's properties were located. They estimated that on average, the properties had appreciated at least 25% in value since they were acquired. Acquisition dates are roughly available from historical annual reports. Adding 25% to original costs yields estimated reproduction values for land and buildings of $265 million and $1,070 million, respectively. Construction in progress represents assets in the process of reproduction, so that original and reproduction costs for them should be the same. Magna's machinery had an estimated average life of 8 years. For a stable company, neither growing nor shrinking, machinery in place should be on average halfway through its useful life. For growing companies, it will be less than halfway. For shrinking companies, more than halfway. Magna had been growing steadily, but we will make the conservative assumption that its machinery was halfway through its useful life and retained half of its original value. Next, we recognize that the cost of acquiring new automotive manufacturing equipment had been declining over time at about 4.7% per year. Machinery that was 4 years old, on average, should have been replaceable at 20% below its original cost, a decline of 4.7% per year compounded for 4 years. Dividing the $7,700 million first in half and then by 1.2 yields a reproduction value for machinery of $3,208 million. That brings the total estimated reproduction value of all of Magna's fixed assets to $4,856 million, $1,648 million for land, buildings, and CIP, and $3,208 million for machinery. This figure is $1,115 million above Magna's year-end fixed asset book value of $3,701 million. In computing overall reproduction value for Magna's net assets at the end of 2008 in Table Example 2.3, we begin by adding this $1,115 million to the equity book value of $7,363 million. The book value of intangibles on Magna's balance sheet at the end of 2008 was represented by the goodwill item of $1,160 million. But this figure was the result of following accounting rules to value Magna's many past acquisitions. It was not based on a careful consideration of Magna's actual intangible assets. To clean this up, we will subtract this artificial figure from Magna's book value and replace it with a detailed valuation of Magna's genuine intangible assets. Magna has significant value for its intangibles in 3 areas: its book of annual business, its product portfolio, and its trained labor force. For other companies, the value of an established organizational structure could be added to this list. But Magna had a highly decentralized organization that had arisen organically from its everyday activities. The expense associated with reproducing that organization was likely to be minimal. The sustainable size of Magna's customer base, its book of business, was about $24 billion. Revenue of $26 billion in 2007 represented a cyclical peak. The subsequent drop to $23.7 billion in 2008 was the beginnings of movement toward a cyclical trough. The measure of reproduction value per dollar of revenue is the cost of acquiring those customers in the most efficient way possible. One way is through an independent sales agency. These typically charged 5 to 10% of first-year sales as commission for obtaining sales contracts from customers like Magnus. If we use a midpoint estimate of 7.5% in fees per dollar of sales, then Magnus' $24 billion book of business would have a reproduction cost of $1.8 billion, 7.5% of $24 billion. Magnus' labor force of 75,000 in early 2009 was made up of very different kinds of workers. About one quarter were unionized. The net asset value of such workers to Magna, given their wage levels, was near zero. A second quarter were skilled technicians, engineers, and managers with average salaries of roughly $60,000. Human resource recruiting firms typically received about one-third of a year's salary for successfully providing these employees. At that rate, their reproduction cost value would have been roughly $20,000 each, one-third of $60,000. The remaining half of the trained labor force would have an acquisition cost/value about halfway between that of the unionized workers and the skilled professionals, or roughly $10,000 each. The overall reproduction cost/value of Magna's labor force was 75,000 times the average acquisition costs per worker of $10,000, or $750 million. Magna's product portfolio consisted of between 4,000 and 6,000 individual items manufactured for the major automobile companies. Some of the cost of developing and preparing to produce these items was specifically reimbursed by the big automakers. In 2008, the value of these reimbursements for 1 year's new products was $92 million. This appears to have represented about one-fifth of the full cost of product design, manufacturing, development, and tooling. A product portfolio roughly 5 years or less represented a Magna investment of about $2,250 million, 450 times 5. This comes to about $0.5 million for each of Magna's 5,000 or so products, excluding assembly operations, not an unreasonably high figure. Magna's intangibles had a total value of roughly $4.8 billion, $1.8 billion plus $750 million plus $2.25 billion, or $3.7 billion above book value. These calculations are set out in Table Example 2.3. The total figure of $3.7 billion of non-acquisition-related intangible assets represents about 3 years' worth of Magna's approximately $1.2 billion of SG&A. Given the size and complexity of the company's operations, this seems an appropriate level for the reproduction cost that an entrant would incur in order to reproduce these intangibles. The resulting net asset value on an equity basis for Magna in early 2009 was about $12.2 billion. The asset value of its ongoing operations was about $10.4 billion, with the remaining $1.7 billion representing net cash. Earnings power value. A 10-year operating history for Magna's automobile business is presented in Table Example 2.4. It includes 2 down cycle years for the industry, 2001 and 2008. In general, the period from 1999 through 2008 was a difficult one for the auto companies, especially in North America, where rising gas prices, starting in 2003, undermined sales of relatively high-margin SUVs and light trucks. Average sustainable revenues for Magna in 2008 were probably between the $26 billion of 2007 and the $23.7 billion of 2008. We used $24 billion in calculating the value of Magna's book of business, which allows for the effects of the recession once every 8 or so years. Sustainable operating margins are more difficult to estimate for two reasons. First, there was a steady downward trend in margins from 7.8% in 2000 to 4.1% in 2007, and then to 1% in the recession year of 2008. If we merely extrapolated this trend, we might estimate sustainable margins of between 2% and 0. Second, the whole period after 2003 was one of poor demand conditions for Magna and the automobile industry as a whole, reflecting a slow adaptation to rising energy prices. Simply taking the 10-year average operating margin of 5.4% may actually understate future margins as the industry adjusted to lower demand. At margins below 4%, it is not certain that returns on capital would be sufficient to attract the investment necessary to sustain the output of what we have already identified as an economically viable business. Returns on equity for Magna during this period, with operating margins below 4%, were consistently less than 10%, which would be an appropriate cost of capital in early 2009 for a cyclical industry such as autos and auto parts. We will use an initial sustainable operating margin estimate of 5%, and then look at the reasonableness of the resulting earnings power value. With a sustainable margin of 5% and revenues of $24 billion, sustainable operating earnings would be $1.2 billion, close to the operating earnings of 2007. An average tax rate of 33% lies between a U.S. rate, including state and local taxes, of 39% and lower rates in Europe, where half of Magna's operations were located, and Canada. Sustainable taxes of $0.4 billion leave net operating profit after taxes of $0.8 billion, which is our estimate of the earnings power of Magna's operations. The principal adjustment that must be made to this estimate involves depreciation. As we noted in computing Magna's asset value, accounting depreciation overstates actual depreciation for two reasons. First, for accounting purposes, building values are depreciated over time, typically at 2 to 3% of original cost per year. In practice, the value of these buildings, if properly maintained, actually increases. Thus, accounting depreciation overstates economic depreciation for these components of Magna's fixed assets. Second, the cost of automotive production machinery between 2000 and 2008 was declining relatively rapidly. Economic depreciation for this equipment would be the cost of replacing it and maintaining an unimpaired capital stock. Falling machinery prices would make replacements lower than the original cost of the machines on which accounting depreciation was based. In this area as well, accounting depreciation would overstate actual depreciation. The amount of excess depreciation can be roughly estimated by looking at the years 2007 and 2008. Over this period, Magna's revenues declined slightly, so that the fraction of capital expenditure to accommodate growth should have been minimal. If we assume that for these years all capital outlays were maintenance capital expense, then true depreciation averaged $740 million, $739 million in 2008, and $741 million in 2007. See Table Example 2.4. The average accounting depreciation and amortization was about $873 million, $873 million in 2008, and $872 million in 2007. The difference of $133 million is a useful estimate of the excess accounting depreciation that must be added to accounting earnings to calculate actual earnings. In 2008, this extra $133 million in earnings was protected from taxation by the depreciation tax shield. It simply did not appear as part of taxable profits. However, as lower maintenance capital expense leads to lower subsequent depreciation, the tax shield will gradually disappear. Once the tax shield is gone, the excess depreciation part of profits will be fully taxed at the 33% rate. On average, this portion of profits would be taxed at almost 10% in present value terms. The average excess depreciation after tax was thus about $120 million, $133 million minus $13 million average tax. These adjustments bring the earnings power of Magna's core business to $920 million per year in early 2009, $800 million plus $120 million in excess depreciation. In early 2009, B-rated corporate bonds were trading at yields of roughly 7%. At the same time, returns required to attract investors to new venture capital funds were around 14%. Thus, the range of possible costs of capital for Magna lay between 7 and 14%. A relatively risky firm such as Magna, but without excess cash, would have an equity cost of capital equal to that of an average firm. Within the 7 to 14% range, the low-risk firm would have had an 8% cost of equity, an average risk firm would have had a 10% cost, and a high-risk firm would have had a cost of 12 to 13%. Thus, an appropriate cost of capital for Magna from early 2009 going forward would have been about 10%. The earnings power of Magna's core business at that time was $920 million, $800 million plus $120 million in excess depreciation. Capitalizing the $920 million in earnings power at this rate, 1 divided by 10% or 10 times, yields an earnings power value for Magna's core operating enterprise of $9.2 billion. The earnings power value of Magna's equity includes this $9.2 billion plus $1.7 billion in net cash, a total of about $10.9 billion. Final valuation. The earnings power value, asset value, and market price for Magna International in March 2009 are summarized in Table Example 2.5. The first point about these numbers is that the asset and earnings power value estimates are essentially equal, within 12% of one another. In terms of 3 possibilities for comparisons between asset value and earnings power value, this is a case B, a firm without significant competitive advantages, but with a capable management. The lack of a clear competitive advantage for Magna is also apparent from the return on equity levels in Table Example 2.4. The 10-year average return on equity of 10.4% almost exactly equals our 10% estimated cost of equity capital for Magna. Qualitative considerations further argue against the existence of sustainable competitive advantages. First, as we noted, its customers were large auto companies with professional purchasing departments. They were unlikely to be captive to any individual supplier for very long. Second, Magna's technologies were well-known and seasoned. Proprietary techniques and patents did not play a significant role in its operations. Third, given the large number of decentralized manufacturing, marketing, and other operational facilities, it is unlikely that the economies of scale were significant. Without these barriers to entry associated with sustainable competitive advantages, growth for Magna would not create value. Thus, for valuation purposes, we need not concern ourselves with future growth rates in demand and/or cost-reducing technological change at the industry level. The fact that earnings power value is so close to asset value is somewhat surprising, given the historically questionable behavior of management. But it is greatly reassuring in 2 respects. First, the asset value of $12.2 billion assures that in the long run, the negative trends in margins could not continue. An earnings power value significantly below $12.2 billion would not provide a return on assets sufficient to elicit the investment necessary for the continued viability of the North American auto and auto parts industries. Since the qualitative economic factors that we considered at the beginning of our analysis of Magna argue strongly for their continuation, future operating margins must be at or near the 5% level that we assumed in calculating our earnings power value. The triangulation between asset and earnings power values strengthens confidence in our earnings projections, confidence that was necessary to make an investment in Magna in the face of the troubling circumstances surrounding the company in March 2009. Second, despite the difficult industry conditions facing Magna between 1999 and 2008, the company's management achieved operating margins, provided you believe the accounting numbers, that produced a cost of capital return on assets. This was accomplished despite the misuse of funds for racetrack investments and the consequences of nepotism in executive appointments. The contrast with Hudson General here is instructive. Hudson General's management destroyed substantial value, as was evident from the large gap between asset value and continuing earnings power value. No such gap is apparent for Magna International. Given these considerations, the margin of safety from the valuation analysis summarized in Table Example 2.5 is comforting. In equity terms, Magna, in March 2009, was selling at just 20% of its roughly $11.6 billion intrinsic value. In enterprise terms, after deducting the net cash of $1.74 billion from Magna's $2.24 billion market price, Magna's operating business was selling for about 5% of its $9.9 billion intrinsic value. Unless we have overlooked some important negative factors, Magna, as might be expected under the then prevailing economic and market circumstances, was a highly attractive investment. Potential issues. The final step in our investment analysis is to consider problems, like the continuation of management's depredations at Hudson General, that might undermine the profitability of an investment in March 2009 in Magna International. 3 potential issues are worth examining in detail. They are: 1. The possibility that the auto industry was on a path of terminal collapse, perhaps along with the rest of the global economy. 2. The potential that the costs of mismanagement were not being fully taken into account. And 3. The chance that the accounting numbers on which we relied for our valuations were fraudulent. We consider each of these possibilities in turn. We addressed the issue of North American auto industry failure at the beginning of this analysis. Barring a global economic collapse, it was not going to happen. It is worth remembering that much of the world had begun to emerge from the Great Depression before the onset of World War II. Moreover, once the war ended, and contrary to the opinion of most contemporary economists, the Depression did not return. Modern industrial economies have proved to be very resilient. Since the end of World War II, the scope of active government support for private economic activity in times of stress has greatly increased, further reducing the already small chance of total economic meltdown. Complete economic collapse, and with it the complete collapse of the auto industry, does not seem to have been a realistic economic prospect facing Magna in early 2009. The potential damage from self-serving management behavior also appeared to be limited. First, it is important to remember that the operational and balance sheet numbers on which we base our analysis were recorded after taking account of management expropriations. Thus, only if management abuses were to increase after March 2009 would our calculated valuations be too optimistic. And the recent trend was in the opposite direction, toward a lower cost of management misbehavior. The racetrack folly was largely resolved with the spin-off of MID in 2003. More recent transactions with MEC involved golf, not horse racing, which was a much less costly undertaking. In 2006, Magna bought 2 golf courses in Ontario, Canada, and Austria from MEC for a total of $84 million, including assumed debt of $21 million. In 2007, Magna bought additional Austrian land for $29 million from MEC. Finally, in the first quarter of 2009, Magna arranged to purchase additional Austrian land from MEC for $5.7 million. The trend in the cost of Magna's interactions with MEC was clearly downward. The danger that significant company operations would come under the control of Belinda Stronach, which had never been high given the decentralized structure of divisional management, had essentially vanished by 2008. Payments to the Stronach family in salary and consulting fees seemed to be shrinking. Finally, the threat from any Deripaska joint venture had largely receded due to his financial difficulties. Overall, the cost of family control was diminishing. On the other hand, if Magna's accounting statements were fraudulent, our investment would be in genuine danger. Here, however, we were paradoxically protected by Frank Stronach's dodgy reputation. Magna's accounts in 2008 were audited by Ernst & Young, a Big Four accounting firm. In the wake of the Enron and WorldCom scandals in 2002 to 2003, which led to the demise of Arthur Andersen, large accounting firms were not likely to give the benefit of any auditing doubt to someone like Stronach. One reason that WorldCom and Enron were able to escape careful scrutiny was that they were regarded as leading-edge innovative firms run by visionary managements. In the event of an auditing dispute, a management with even a slightly questionable history was not likely to be able to manipulate a well-established auditor. The danger of accepting management accounting misrepresentation was more apt to come from firms such as Amazon, Tesla, Alibaba, Google, or Facebook than from Magna International. The credibility of Magna's profit numbers nevertheless deserves careful scrutiny. One way is to examine financial statements over an extended period of 5 years or more. Short-run accounting manipulations are far easier to sustain than long-run misstatements. From 2004 through 2008, Magna reported cumulative net earnings of $2,650 million. It also reported sales growth of $8,359 million. The profit figure might look inflated, but tampering with the sales growth numbers would be difficult. Magna's customers, who were the counterparties for its reported revenues, were large U.S. and European automobile manufacturers. In an audit, they would be contacted to verify reported sales, and they were unlikely to support any material revenue misrepresentations by Magna's management. Of the $2,650 million of reported profits, $686 million were distributed to shareholders as dividends and net stock buybacks. These payments leave a clear paper trail about which there is little definitional ambiguity. The $686 million of reported net distributions would have been almost impossible to fake. Next, from December 31, 2003 to December 31, 2008, Magna's audited balance sheets showed an increase in net cash of $512 million, from $1,230 million to $1,742 million. Outside of Italy before the Parmalat scandal, in which Parmalat claimed to have $5 billion invested in hedge funds that were non-existent, cash balances and debt obligations are essentially impossible to misrepresent. The transactions involved leave clear paper trails, and the auditor sends confirmation letters to the institutions holding the funds. Thus, of the total $2,650 million in reported profits over the 5 years, $1,198 million could reliably be accounted for by net cash accumulation and net distribution to shareholders. The remaining $1,452 million of earnings had to support revenue growth of $8,359 million, an investment of roughly 17 cents for each incremental dollar of sales. This is a very low level of net investment, especially compared to long-run levels of Magna and industry operating margins of 5 cents per dollar of revenue. If Magna were inflating its earnings by 10%, then true earnings would have been $265 million lower than the reported 5-year total of $2,650 million. As a result, true investment would have only been $1,187 million, $1,452 million minus $265 million. This would mean that Magna was investing only about 14 cents per incremental dollar of sales, a remarkably productive use of capital. The actual 10-year figure was 16 cents. Similar calculations for Enron in 2002 would have shown investment of more than $3 per $1 of incremental revenue. For WorldCom, the number would have been essentially infinite, since WorldCom was reporting huge implied investment levels while revenues were falling. Given the implied efficiencies of capital allocation implicit in Magna's numbers, it is very likely that Magna's reported long-run profits had been exaggerated. Indeed, it is clear that for all of Stronach's dubious behavior, Magna was a highly efficient capital allocator and operator. This is also evident from Magna's long-term record of solid growth and its ability to satisfy its demanding automobile manufacturing customers. The likelihood that Magna's reported results involved a significant degree of misrepresentation was very small. As a result, an investment in Magna International Equity at $20 per share around March 1, 2009, looked like an attractive opportunity. In contrast, a DCF valuation based on continuing projected declines in Magna's income would not have identified the asset protection that effectively ruled out such a scenario. Thus, investors approaching Magna from this non-Graham and Dodd perspective generally missed the opportunity. 10 years later, at the end of February 2019, the share price was $52 after a 4-for-1 split, an annual return on price appreciation of 26%. In retrospect, the Magna investment seems so obvious, given the asset protection and the deep margin of safety. But in retrospect, we are all geniuses. It takes courage to be greedy when others are fearful, and one path to courage is to have confidence that you are equipped with the analytical tools appropriate for the job. 6. Growth. Asset value and earnings power value are the first two components of a complete valuation description. We now look at the third element, growth. It has generally been taken as axiomatic that the value approach, with its preference for tangible assets and current earnings power, discourages its adherents from investing in high-technology companies and other growth stocks. Though there is some truth in this idea, especially as it applies to more traditional Graham and Dodd investors, it ignores some significant innovations in valuation that modern value investors have devised. Warren Buffett and a number of other prominent value investors favor the shares of good companies, by which they mean firms like Coca-Cola, companies that increase steadily in value over those that are merely cheap. In this context, a good company, sometimes elevated to a great company, is one that can pay out cash to its investors even as it funds its growth. Today, these companies, franchise businesses in Buffett's terms, constitute a large and growing fraction of the market value of publicly traded securities. At the same time, hard asset-based businesses are becoming less important. This trend toward franchise-based value is evident in the high profitability and sustained trillion-dollar valuations of companies such as Microsoft, Google, and Apple. It is also clear from the way in which Walmart and McDonald's have created hundreds of billions in market value for traditionally atomized service industries. Healthcare, now a major sector, was formerly represented in securities markets almost exclusively by the major pharmaceutical companies. Today, significant health investment opportunities include health insurers, prescription drug fulfillment companies, hospital chains, specialized treatment businesses, and a multitude of high-tech equipment and biotech opportunities. All of these non-pharma companies have franchise characteristics. At the same time, historically dominant franchises businesses, General Electric, IBM, General Motors, and whole industries such as newspapers have seen their values greatly diminished or even disappear. The ability to recognize franchises and to value growth accurately are essential and challenging skills required of modern Graham and Dodd investors. For value investors as a group, the main historical reason for avoiding these growth companies is that they are rarely favorably priced. They are often the kinds of lottery ticket, get-rich-quick stocks for which many investors repeatedly overpay. The evidence cited in Chapter 2 indicates that in almost all extended periods, in almost all countries, portfolios of growth stocks regularly underperform broad market indices. After years in which expectations drove prices beyond any reasonable estimate of underlying value, markets corrected. Some telling examples are Japanese stocks in the 1980s, technology and telecom stocks in the 1990s, and Chinese and other emerging market stocks more recently. By the time their prices declined and their valuations returned to earth, they had cost their enthusiastic shareholders substantial sums, as well as vaporizing their unrealistic expectations. Value investors of any stripe need to be keenly aware of this pattern. The historical success of value investing has been based in large measure on the ability of value investors to avoid being caught up in these manic episodes. Growth stocks, chosen selectively, are not forbidden fruit for value investors, as Buffett and others have demonstrated, but they must be bought with great care and the skillful application of an appropriate valuation process. The traditional Graham and Dodd approach to growth investing. Graham and Dodd recognized that the value of a franchise business is rooted in earnings power rather than assets. Being unwilling to pay extra for growth, they based stock purchase decisions on the margin of safety between the current earnings power value without growth and the market price of a company. Growth was treated as a qualitative factor that might justify a smaller margin of safety, but its calculated impact was never incorporated into quantitative valuations. In a world where investors have historically overpaid for growth stocks, this cautious approach has much to recommend it. Most forecasts of future growth rates of company revenues, earnings, and thus value are systematically biased. First, growth forecasts suffer from significant systematic biases. Short-term trend extrapolation is a staple of forecasting practice. Companies that have produced high recent growth rates are forecast to have high future growth rates. Companies that have shown low or even negative growth rates are expected to continue on that path. But the realized growth rates for the formerly high flyers generally disappoint, while the slow growers exceed expectations. These forecasting biases have been widely reported in the academic and professional literature. Yet most investment analysts persist in projecting the most recent past into the future. The traditional Graham and Dodd approach avoids these pitfalls by not relying on quantitative growth forecasts. Second, growth stocks will be overpriced when estimated values depend on the growth of companies whose supposed competitive advantages are hard to identify, or if they exist at all, are likely to be short-lived. In these cases, the allure of growth overwhelms the fact that only franchise growth creates sustainable value. For example, many companies in some emerging markets show rapid earnings growth, but most of them do not benefit from sustainable competitive advantages. In emerging economies, consumer tastes evolve quickly, an unstable preference that undermines customer captivity. Also, especially in Asia, emerging market countries have high population density. Thus, even in local service operations such as retail, new entrants can be viable at relatively low levels of market share. With fragile market share advantages and low customer captivity, competitive advantages, or moats, will be narrow and often insignificant. At the same time, there's usually a large roster of powerful companies in developed countries, hungry for the growth opportunities offered in emerging markets. Emerging market companies that are export-oriented may also expand rapidly, but they are necessarily competing in large global markets that are highly competitive. The ability of companies in emerging markets to transform rapid growth into value creation is likely to be far less than is often forecast. A similar reality affects markets for exciting new products and services, the emerging markets of product geography. The often touted first mover advantage, meaning entry into these markets in their early, rapid growth phases, does not usually lead to sustainable, long-term competitive advantage and high profitability. Rapidly changing technology is the enemy of customer captivity. Early adopters are constantly on the lookout for newer and better alternative products. Subsequent adopters who look at the range of products available are unattached and non-captive customers. During early rapid growth periods, most potential users are not yet customers. Their numbers are usually sufficiently large compared to existing users that in the race for economies of scale, later entrants are not materially disadvantaged. Finally, rapid technological change tends to undermine and hence minimize the advantages of proprietary technology. Firms that ultimately dominate these markets have generally been those that enter at a time when technology is stabilized and user numbers are a high enough proportion of the ultimate market to produce sustainable scale advantages, a development for which Google and the search engine market is a prime example. Judging whether this point has been reached and what ultimate value will look like is difficult even for expert industry observers. It is almost certainly beyond the capacity of most general investors. A third problem that besets growth investing is that growth stocks are usually priced at very high multiples of current earnings or cash flows. For example, in late 1999, Microsoft traded at 70 times any reasonable estimate of current sustainable earnings. At that time, Microsoft paid no dividends. Any direct cash returns to investors, as opposed to potential capital gains, were being deferred into the far distant future. Microsoft's earnings were growing at more than 25% per year, an attractive rate, but one that was clearly not going to last indefinitely. To establish a value for cash returns to investors, let us assume that Microsoft were to start distributing half its reported earnings to shareholders and could do so without impairing its growth rate. Assume further that the growth rate were to average 25% in the intermediate future, up to 10 years out, and investors were to discount future cash returns at a cost of capital of 10% per year, a relatively low rate for a then high-risk tech stock as Microsoft. Using these assumptions, the value of cash received over the 10-year period from 2000 through 2009 would be worth roughly 10 times Microsoft's current earnings. This discounted dividend payout would represent about 15% of Microsoft's then market price of 70 times earnings. The remaining 85% of the price paid for Microsoft in 1999 depended on payouts and performance in the years after 2009. For a company operating in a rapidly changing economic and technological environment as Microsoft in 1999, accurately anticipating events in 2009 and beyond was difficult if not impossible. Such a growth stock purchase in 1999 would have been, in Benjamin Graham's terms, a speculation, not an investment. Not surprisingly, it would not have worked out well. After the tech bubble burst in 2000, it took Microsoft stock 16 years to return to its price in 1999, although there were dividend distributions along the way. Similarly, expensive growth stocks are usually poor investments, meaning they have returned less than the market overall. Given upwardly biased growth rate forecasts, the limited duration of many competitive advantages, and the high prices at which growth stocks sell when compared to current earnings or cash flow, it is hard to disagree with the traditional Graham and Dodd aversion to paying explicitly for growth. Despite these difficulties, Warren Buffett, Charlie Munger, and several other modern value-oriented investors have earned consistently above-market returns by investing in growing franchise businesses. They have demonstrated that a disciplined value approach to investing in growth opportunities can be successful. A traditional value investor will sell when a company's market price reaches or exceeds its value. If the value is static, the investor sells when the price is recovered from what is often a temporary sell-off or setback. This recovery approach defines a fixed horizon for earning a decent return. But if the value of the company increases continuously, it may be many years before a company's value and market price converge. A longer holding period means lower trading frequencies, lower transaction costs, and deferral of capital gains taxes for many years. As a consequence, while investing intelligently in growth stocks is difficult, it is an essential and worthwhile extension of the traditional Graham and Dodd approach to investing. An investment based on a firm's prospects for growth must satisfy two requirements. First, the growth must create value, which is no sure thing. For many companies, or more precisely for the shareholders of most companies, the growth is at best a break-even proposition. As we noted briefly in Chapter 4, this sobering news applies equally to high-tech firms that expand by selling more superbly engineered tools or aesthetically elegant gadgets, to online retailers who multiply their offerings, and to restaurant franchisors that expand by opening more outlets. Growth creates value only when the investments required to support the growth earn more than the cost of capital. In the distinction we made in Chapter 3, in Figure 3.2, it is only case C, where earnings power value significantly exceeds assets values, that growth will produce net distributable cash after investment to existing investors. Second, not all growth, even growth that is worth something, can be appraised with enough precision to permit an accurate valuation. Because value investors demand a margin of safety, they will buy growth only at a substantial discount from its estimated value, a discount large enough to make up for the greater uncertainty in valuation. The ideal price for growth is zero. Pay in full for the current assets or earnings power and get the growth for free. Despite these warnings, there are circumstances under which even disciplined value investors may pay something for growth and be rewarded provided they keep these two requirements squarely in view. 1, that the growth will in fact create value. 2, that there is a measurable margin of safety included in the price paid for it. Though the first rule is uncomplicated, it is not well understood by most investors. The second calls for a major readjustment in the Graham and Dodd approach to valuation. We will discuss the two requirements one at a time. In this chapter, we will identify the circumstances under which growth genuinely creates value, as distinguished from those in which either growth contributes nothing and can therefore be ignored in the investment decision, or those in which growth actually destroys value and investment should be avoided entirely. In Chapter 8, we will develop an approach for calculating an appropriate margin of safety for growth stocks. When growth creates value. One of the advantages that stocks are thought to have in comparison with bonds, fixed income securities, is that they are a claim on a potentially growing stream of income. Within equity investing, the shares of a growth company, one with appealing future prospects, typically command a higher price relative to current earning, a higher price to earnings, P to E multiple, than those of a company that is not increasing its revenues or income. The reasoning is obvious. If the growth company can generate $1 per share in earnings this year, $1.20 next year, $1.44 in the year after that, and continue at that rate for some time into the future, the shares of that company are more attractive than those in a company producing a level stream of $1 per share in perpetuity. But this view ignores a key element of growth It comes at a price. Growth in virtually every instance requires additional investment, and that investment must be paid for. For the example before, where earnings grow at 20% per year, let us assume that that growth needs 50 cents per share each year for added plant capacity and working capital. We will make a second assumption that the additional investment is funded by retained earnings. That means that each year, the company can distribute 50 cents less to shareholders than would be the case if it did not have to reinvest that money. So in the first year, of the $1 in earnings, shareholders get a dividend of 50 cents. The other 50 cents is retained and invested. The reinvestment continues each year, reducing the amount of earnings that can be distributed. By contrast, a non-growing company that earns $1 each year does not require new investment and can distribute the entire amount to shareholders. In this example, that $1 per year is more than the investors in the growth company receive until year 4. The crucial question for determining the net value of growth for a company is the relationship between the amount of investment needed to pay for the growth compared with the additional amounts and timing of distributions that the growth may produce. It should be intuitively clear that if the growth is slow enough and the investment requirements high enough, the current costs will not be offset by future gains, and the net value of the growth will be zero or even negative. Identifying a break-even growth rate that is high enough to create value for investors when compared to the additional investment required seems at first glance to be a complicated question, calling for intricate calculations. However, if this question is posed correctly, the answer is immediately apparent. The growth rate is not the main issue. In examining this relationship, the cleanest approach is to concentrate on cash investments required to support growth. Focusing on attention-grabbing growth rates and the high future earnings they may generate demands a complicated analysis that most growth investors shortchange. The allure of riches is one of the reasons investors tend to overpay for growth. A simple yet general example illustrates the point. Assume a company decides to spend $100 million to support its plans for growth. The investment might consist of new plants, new products, distribution facilities, and sales offices, all acquired for the express purpose of generating additional revenues and increasing earnings. Or it might be spent on acquisitions of new businesses or competitors in existing markets. A third possibility is that the money goes into the additional working capital, accounts receivables and inventory minus accounts payables necessary to support growing demand in existing product lines and markets. Whatever the use, some investment is required to fund growth. No new investment means no growth. Growth that requires no supporting investment is extremely rare. The investors who provide the $100 million need to be compensated for the use of their funds. This point is obvious when the money is raised from outside investors. If it comes in the form of debt, the creditors will receive interest and ultimately the repayment of principal. If it comes from the sale of additional stock, then the new equity investors will be rewarded with their share of the earnings of the overall enterprise. But even when the funds come entirely from retained earnings, they still represent an additional investment. The existing shareholders are, in effect, providing the capital by accepting management's decision to make the investment to fund the anticipated growth. A decent management will take this fact into account in evaluating the investment and require a return at least equal to what those shareholders would demand if they were making the investments voluntarily. No matter the source, the cost of capital is the same. In each case, the return that must be offered to attract the funds voluntarily is the cost of capital associated with the $100 million investment in growth. That cost, in theory at least, depends on the level of risk inherent in the investment. For our simple example, we will assume that the required return is 10% and ignore for the moment the difference between debt and equity financing. Thus, the cost of attracting $100 million voluntarily from investors is $10 million per year. This cost is the downside of growth, and if it is high enough, it can turn growth from a profitable into a losing proposition. The upside is the future cash flows that the $100 million will produce. Again, to keep things simple, we will assume that this cash flow occurs as a constant percentage throughout the future and unlimited life of the investment. We will also assume that this rate varies across companies. As with all investments, some will have higher returns than others. Our cost of capital is 10%, and the annual cost of the $100 million investment is $10 million. For an investment that returns 5%, the $5 million of additional earnings is only half of the $10 million that must be paid to the investors who provided the $100 million in capital. Growth at this rate of return generates an annual loss of $5 million and destroys value for existing shareholders. If we value the annual $5 million loss at 10%, that produces a total loss in value of $50 million, or half the original $100 million investment. The company will have growing sales, assets, and operating income. If the $100 million comes predominantly from retained earnings, it will have increasing net income and earnings per share. Nevertheless, value has been unambiguously destroyed by the 5% return on investment. Next, consider a company that earns 10% on the $100 million and thus generates an additional $10 million in distributable cash flow. All of this money goes to the investors who provided the $100 million. There is no additional cash for the original owners of the firm. Despite the additional reported earnings, no value will be created and none will be destroyed. Unlike the first example, where growth was destructive, growth that increases returns by precisely the cost of the new investment is neutral and therefore irrelevant. It represents the boundary between growth that destroys value and growth that creates it, and helps us separate those investments that we do not want to consider from those we do. Our third example is a company for which the $100 million produces a still greater increase in sales and with higher profit margins. This project may return as much as 20% per year, which translates into $20 million in extra earnings. Paying the $10 million cost of the investment still leaves $10 million left for the original owners of the company. The growth produced by this project will create substantial total value for the existing shareholders or other stakeholders. Even after the new investors have been paid $10 million, there remains an additional $10 million per year in cash flow. If that is valued at the 10% cost of capital, this project creates $100 million in extra value on its $100 million investment in growth, meaning $100 million in added value. If $100 million can be invested every year with the same results, then the value of growth is prodigious and long-lasting, as the investment pays for itself and still leaves an additional $10 million for every $100 million invested. The key is the rate of return on the invested capital. High rates lead to value creation, just as low or negative rates, such as 5%, lead to value destruction. The answer to the question, is growth a good or bad thing for existing shareholders, is that it all depends on whether the return on the growth investment is less than, just equal to, or more than the cost of capital required. Our three simple examples provide the entire set of possibilities. What does not matter is the size of the investment or the specific cost of capital. The same consideration applies to an investment of $1,000 as to one of $1 billion. It applies to a cost of capital of 4%, 10%, or 15%. It is the cost of that capital when compared to the return the investment generates that counts. Which growth is this? How do we tell in advance whether the potential growth for this investment will equal, exceed, or even fall short of the cost of capital? Consider a firm that seeks to expand in markets or product lines where it has no sustainable competitive advantages and therefore benefits from no barriers to entry. In its projections, the firm may anticipate a return on investment that will exceed its cost of capital, say a 15% return on capital that costs 10%. But other companies will be scouting for similar opportunities, and they will locate this one, especially if the first firm's investments turn out to be highly and visibly profitable. With no barriers to entry, these followers will join the party, driving down the initially high returns of the first firm. These returns will continue to fall until all the attractive profit opportunities have been eliminated. Sooner or later, and generally sooner, every competitor will earn only its cost of capital at best. At that point, all the benefits of growth will vanish, and the brief phase of higher returns will have added precious little to the value of the company. More damaging still, this limited period will often be more than offset by a longer stretch in which overcapacity from all the new entrants will force returns down below the cost of capital. The lesson is clear. Without competitive advantages and barriers to entry protecting the returns of the initial firm, growth will create little or no value. Firms that seek to grow by entering a highly profitable market in which incumbents enjoy sustainable competitive advantages over potential entrants face even worse results. The high returns are a temptation. If the existing companies are flourishing, why not enter the market and enjoy a similar profitability? But the returns are high precisely because of the competitive advantages and barriers to entry that protect the incumbents from would-be entrants. A company trying to penetrate this market is on track to earn substandard returns or to fail in its attempt to establish a presence. A new, small, and aggressive entrant may be tolerated by larger and stronger incumbents, but its operations will be limited in scale. Since sustainable competitive advantages ultimately rest on economies of scale, it is difficult to see how the undersized firm can flourish. The likely result is that the entrant earns returns below its cost of capital. Any growth for a firm operating at a competitive disadvantage, or one with low quality management, is likely to destroy value. The only growth that creates value by producing a return above the cost of capital is in markets where the firm enjoys an actual competitive advantage or has the potential to create one, typically markets it can dominate in the future. A sustainable competitive advantage produces current high returns, and the barriers to entry protect the firm from having them eroded by would-be entrants in the future. The three levels of returns from growth we described in Table 6.3, below, equal to, or above the cost of capital, correspond respectively to the three instances of firms operating with regard to competitive advantage: those who operate at a competitive disadvantage, those competing on a level playing field, those who benefit from a competitive advantage. And these correspond to the three cases A, B, and C we identified in Chapter 3, in which earnings power falls below, equals, or exceeds the asset value of the enterprise. Thus, the Graham and Dodd approach to valuation, when coupled with a thorough grasp of competitive advantage, allows the investor to extend the analysis from existing operations to growth in the future and provides a direct and comprehensive answer to the question, when does growth create value? Understanding the competitive conditions that determine the value of growth provides insight into a host of growth-related issues. 1. The value of organic growth that is driven by increasing market demand, as distinguished from growth that is actively pursued by the firm. 2. The consequences of other favorable developments, such as new technologies that reduce costs and lead to growth in earnings, even if they do not directly increase demand. 3. The value of growth options, secondary opportunities that a company can pursue if warranted and avoid if unattractive. 4. The consequences of market shrinkage as opposed to expansion. 5. The differences between growth in core markets compared to growth in new markets. We will examine each of these issues in turn. Organic growth. The most desirable kind of growth for any company is revenue growth that arises organically from market conditions as opposed to growth in response to active investment initiatives. The investment involved is minimal. Additional capital consists chiefly of net working capital, largely additional inventory, and accounts receivable offset by growth in accounts payable and accrued liabilities. Fixed investments in incremental production capacity tend to be small relative to the average cost of capacity. When Walmart's revenue increases because more customers, due to local population growth, are spending more per capita, thanks to rising income levels, the incremental returns are usually higher than those produced by new store openings. This is especially true for markets in which growing demand results in higher prices. Consultants and books on business strategy invariably stress the benefits of operating in high-growth markets rather than those that are stagnant or growing slowly. However desirable and profitable, the benefits of organic growth and the value creation that ensues depend on the existence and sustainability of barriers to entry, meaning incumbent competitive advantages. Without these barriers, higher initial returns arising from organic growth will encourage existing firms to expand and draw new entrants into the market. The heightened competition will then drive down returns on invested capital for everyone. Entry and expansion will continue until returns no longer exceed the appropriate cost of capital for the market in question. They may persist even longer if there is an enthusiastic overreaction to the initial opportunities. The end result will not be value creation for the individual firm, but rather a greater number of companies in the market and more capital employed. Since this capital earns its cost, there will be no value creation in the long run, despite the initial high rates of returns from organic market growth. Only for firms in markets protected by barriers to entry will organic growth lead to sustained value creation. Favorable economic developments. In addition to high organic growth, there are other favorable economic developments that lead to higher returns. Two common examples are technologies that lower costs and innovations in marketing and distribution that increase operating efficiencies. Personal computers, tablets, and smartphones have all benefited from rapidly improving performance at declining costs. Again, the extent to which these developments create value for the firms that make them, rather than their customers, depends on the same factors that govern the value of organic growth: barriers to entry, sustainable competitive advantages. Without these barriers, the higher profitability that comes from lower costs, product improvements, and more efficient distribution will merely attract new entrants and additional capacity, both of which will intensify competition and drive down profitability. As in the case of organic growth, entry will slow down only when returns fall to the cost of capital appropriate for the market in question. All of these improvements will not lead to sustainable value creation for the existing firms unless there are effective barriers to entry that limit the impact of new competition. Growth options. Much has been written in finance about the value to firms of entering markets with extensive new potential opportunities that are created by unanticipated developments. The basic thesis is that firms that spot these opportunities can enhance their returns by responding aggressively to them. Conversely, they can minimize the impact of unfavorable developments by responding defensively. Again, as we should expect by now, in markets not protected by barriers to entry, the value of these growth options is severely limited by the increased competition that is sure to follow a successful innovator. Take the case of a smartphone manager who notices that certain combinations of features generate unusually high demand among particular consumers. For example, the ability to download and play music is strongly appealing to teenagers and young adults. The company adds that feature, raises the price of the phone to more than cover the additional cost, and sees sales rise rapidly among the targeted demographic groups, with profits growing in line. If the company had not originally anticipated this kind of response, the serendipitous profits earned represent a classic growth option. What happens next? We already know the answer. Without barriers to entry, competitors copy the innovating firm, add those features and perhaps a few additional ones, and market aggressively to the targeted groups. Competition, as always, drives down profitability, and new firms continue to arrive until returns have fallen below the cost of capital. This growth option then does not lead to sustainably higher earnings. If a new product feature fails, then the innovator eats the loss and competitors avoid the same mistake. In this case, too, the growth option has no long-run value. Also, a market with attractive profit potential and extensive growth options, unless they are unrecognized, will draw more competitors into the market in the first place, not a positive setting for high returns on investment. Without barriers to entry, this negative effect should on average offset the benefits of the potential growth options. Like other ostensibly favorable market factors, growth options generate significant economic value only in markets protected by barriers to entry. Shrinking markets. Markets shrink as well as grow. Creative destruction applies to markets as well as to firms. Tastes and technological changes induce consumers to spend their money on items that may not have existed 5 or 10 years ago. Where are the great turntable manufacturers of the 1960s? The Betamax tape format fell victim to a supposedly inferior VHS standard. Each is now a collector's item, as are the smaller tape recorders that replaced both of them. So markets do shrink and even disappear. Consumers do not have limitless amounts of money to spend and will shift their purchases from one place to another. The digitalization of so many things has eliminated a number of physical products and many of the firms that produce them. The consequences for firms operating in a shrinking market are in important ways the inverse of what occurs when markets are growing. It is the companies with competitive advantages in markets protected by barriers to entry that are hurt the most and experience the most value destruction. By contrast, firms in competitive markets with free entry suffer less from a decline in demand. Lower earnings in the future are offset by recoveries of capital, assuming firms are rational and willing to shrink or exit with dignity. Plants and equipment can be allowed to wear out or sold into other industries that might find them useful. Inventory can be reduced. If the capital recovered was previously earning around its costs, then the amount realized from the disposition and shrinkage of assets should roughly equal the value of the earnings that will no longer be generated by this investment. For example, if a company's earnings are reduced by $2 million, but it can recover $20 million from the surplus assets, it has essentially realized the same 10% return it was making before. Firms with competitive advantages are more hard hit by shrinking markets for two reasons. First, since they have been earning more than their cost of capital on investments, the capital recoveries from declines in demand are smaller relative to the income they had generated. The $20 million recovered may have been earning $4 million per year, for example. Its recovery does not fully offset the value of that $4 million in annual earnings. Second, sustainable competitive advantages are generally associated with economies of scale. Shrinkage leads to declining operating margins that are not compensated for by a reduction in capital employed. Fixed costs remain, and overall incremental declines are limited. When powerful monopolies with significant local economies of scale, such as local newspapers, see their market shrink, the magnitude of the value destruction is far larger than it is for local restaurants and other service businesses that had operated on a level playing field and were not protected by barriers to entry. Also, there is a better market for the restaurant's equipment and leases than the newspaper's presses, which may have to be sold for scrap. Expanding into new markets. A company with a competitive advantage in its core market may be tempted to expand into markets that are not a part of that core. The geography may be different, the product itself may be novel, it may even be crossing industry boundaries. For some reason, the management thinks that it can bring with it the competitive advantages it enjoys in its current locational and product markets. This decision almost always turns out to be a mistake. It is in the new market that the firm must achieve a competitive advantage for value to be created. No matter how strong its competitive position in its core market may be, if the firm has no competitive advantages in the new markets into which it expands, the growth involved will not create value. IBM and Eastman Kodak both entered the copier market in the 1970s. Each had what they considered technology that would allow them to compete successfully with Xerox, the market leader. But these choices did not work out as anticipated. Xerox had a competitive advantage, at least at that time, and even these two technology giants could not break in. When Walmart adds stores in its core markets, it does not need to increase advertising or recreate the distribution and management infrastructure already in place. It benefits from the barriers to entry erected by the regional economies of scale it already enjoys in these areas. Therefore, the stores, if they are properly located, should earn returns above the cost of the additional capital necessary to open and run them. The company can extend these advantages and profitability into adjacent markets that are within reach of its overhead infrastructure in advertising, distribution, and regional management. But the situation has been quite different when it has moved far afield and cannot rely on its existing infrastructure and captive customers. In these cases, it is often an established local firm that enjoys the benefit of a competitive advantage. Growth in these distant markets will almost surely destroy value, even before considering the difficulties of implementation and the need to overcome cultural differences. Walmart's actual experience of global expansion beyond adjacent markets in Mexico and Canada has confirmed this principle. For growth to create value in new markets, the firm has to benefit from competitive advantages within these markets. The advantages it enjoys at home are irrelevant. They may be harmful in producing overconfidence and the idea that the capital it will need to invest is somehow cheap, having been produced by retained earnings in the core business where the return on investment is high. As we have shown, this calculation is an illusion. Growth opportunities for value creation. Most of the situations we have described about the profit potential from growth strategies are cautionary tales. Profitable growth is hard to pull off in part because it sends a powerful signal to other firms that returns above the cost of capital are being earned by someone, and they think, why not me? Competition erodes superior returns, so the most positive opportunity for growth-related investments are those that are concentrated within core or adjacent markets where the firm's existing competitive advantages may allow it to prevent an onslaught of potential competitors and continue to earn returns above its cost of capital. In geographic terms, this involves filling in areas within core regions that a company already dominates and then expanding at the edges of those regions. This has been Walmart's strategy and that of other successful retail firms. It also describes the growth of Southwest Airlines, the most consistently profitable U.S. carrier. Southwest began with a single hub at Love Field in Dallas, focusing initially on flights only within Texas. It then extended its reach to adjacent states and secondary airports that it could dominate. Turning from geographic to product space, Microsoft serves as both a positive and a cautionary example. As it added essential office software, Excel, Word, PowerPoint, around its core operating system market, Microsoft was behaving much as Walmart did geographically. The result was a long period of consistent and large increases in profits and value. When Microsoft jumped into unrelated markets, such as game consoles, the results were far less successful. Walmart has done much less well in its ventures into Europe and Asia than it did extending from its home base in Arkansas. The second most positive growth opportunities come from entering markets where there are no existing dominant competitors who have both captive customers and economies of scale advantages. An outside firm with a focused strategy that it executes well may succeed in dominating these markets, as Walmart came to dominate Arkansas and the Mid-South in its early years, or Microsoft controlled operating systems for personal computers, aided, of course, by its adoption by IBM. These became the companies with competitive advantages, protected by barriers to entry, and they earned returns above the cost of capital that did lead to value creation. Though it all seems so inevitable looking back, it is important to remember that there were other firms in those markets, each of which had, at least at the start, the same opportunities as Walmart and Microsoft. Firms seeking to dominate these virgin markets must be extremely disciplined, focus on one market at a time, and superb at execution. Other than these two situations, the prospects for adding value through growth are at best limited and often negative. If the new market has no current barriers to entry, and given its size, structure, and other features, no likelihood that anyone will be able to create competitive advantages for itself, then the firm has at least the chance of doing well through superior management within a competitive environment. But if barriers to entry do exist, and other firms are already taking advantage of them, under no circumstances should the firm try to enter. This warning seems so obvious that it should hardly need stating, yet history has demonstrated repeatedly that the temptation to enter is strong and resisting it more difficult than it should be. The major firms in these markets are reporting high returns on invested capital, and many managers wonder why they too cannot rake in these profits and the rewards that accompany them. But these returns would not be sustainable without significant barriers to entry, so the newcomer is operating at a major disadvantage from the start. And should it somehow succeed in breaching the barriers and joining the inner circle of profitable firms, the implication is that those barriers are no longer intact, and other firms will follow, leading to the competition that takes its toll on profit margins and returns on investment. In a sense, the fact of a successful entry should lead not to celebration, but should raise the question, if they can do it, why not others? Markets with strong barriers to entry are like the classic Groucho Marx definition of a desirable club, one that would not admit him as a member. A last cautionary word on paying for growth. Any investor who pays up for growth by buying stocks selling for a high multiple of earnings or net assets in anticipation that future growth will create more than enough value to justify the price of the shares should remember what behavioral finance has learned about investing in these kinds of companies. First, they tend to be lottery ticket stocks with get-rich-quick potential at impossibly long odds. Therefore, as a group, they are systematically overvalued. Second, when investors or security analysts forecast growth rates, they extrapolate recent experience into the future. For high growth rates, as we noted earlier, this is an invitation to disappointment. Third, the estimates of value created by growth are extremely sensitive to the growth rates themselves. The value is great when the growth rates are high, but drops considerably as the growth rates decline. Even a small shortfall in rates has a major impact on value. Therefore, even after verifying that the anticipated growth will actually create value, that the market is protected by actual or potential barriers to entry from which this firm will benefit, value investors must proceed with caution when they invest in these companies. Growth in value there may be, but its ultimate size is difficult to ascertain. As we indicated at the start of this chapter, growth investing in franchises businesses has become an inescapable part of a value approach, but it must be practiced with extreme care. 7. Good businesses. 3 rules summarize our discussion thus far of the implications of growth for valuation. First, for firms with asset values above earnings power value, generally firms with poor managements or those operating at a competitive disadvantage, growth is destructive. It erodes value and is yet another reason for replacing current management as rapidly as possible. Second, for firms with competent managements in competitive markets, that is, firms with asset values roughly equal to earnings power values, growth is at best irrelevant and at worst a distraction. It neither creates nor destroys value. For these firms, we need not consider growth at all. Third, only for firms protected from competition by sustainable competitive advantages, those that can earn above their cost of capital on growth investments, does growth create value. And even these good, from here on we will dispense with the quotation marks, businesses, are likely to create value only when their growth is within or adjacent to protected markets. So the first question we must address in evaluating growth is whether a company meets these criteria. Its earnings power value is above its asset value. It operates in a market in which it has sustainable competitive advantages. It currently earns above its cost of capital, and it is likely to make growth investments in current or adjacent markets to which its competitive advantages can be extended. The term value investors use to describe such businesses, following Warren Buffett, is franchises. Because they will have current earnings power values well above the value of the assets values will not be critical to determining what they are worth. The enhanced importance of earnings and the need to value growth means that we must apply a tailored valuation approach to franchise businesses. We can no longer rely just on asset and earnings power values as a check on each other and as a test of whether we have a franchise business. This chapter will describe the process of identifying franchises. The recognition that franchise businesses are different from others and must be valued in their own way, not just using a one-size-fits-all DCF approach, is one of the critical insights of modern Graham and Dodd investing. Investors use several indicators to identify good businesses. They look for high profit margins that return large amounts of cash to their owners, even as they are growing rapidly. The high margins may be high returns on sales, gross margins, operating margins, or net income margins, especially relative to competitors in the same industry. But ultimately, good businesses are ones that earn high returns on capital invested. There are alternative ways to measure returns on capital invested. 1. Returns on equity, ROE, or net income divided by the book value of the equity. 2. Return on capital, operating income divided by net debt plus equity invested. 3. After-tax returns on capital, net income plus net interest paid divided by net debt plus equity. Good businesses steadily earn returns of 15 to 20% or more by these measures, well above a typical 10% cost of capital. These returns should increase rather than erode over time. Good businesses are also ones that grow. Growing firms can have either high levels of investment per unit sales, asset-heavy, or low levels of investment, asset light. The asset-heavy firms are desirable because they can deploy a lot of capital at high rates of return. The asset-light firms are capable of earning especially high rates of return because, requiring so little capital to support growth, they can distribute most of their profits. In both cases, the key to these sustainably high returns and the value of growth lies in the economic characteristics of franchise businesses, the qualitative factors that enable them to protect these returns from competitive erosion. What good businesses look like. There is widespread agreement that good businesses in market economies are those that enjoy sustainable competitive advantages over other companies. Sustainable competitive advantages, if held by incumbent firms, create barriers to entry. Barriers to entry are what Warren Buffett and other value investors refer to as moats. Franchise businesses, in the language of value investing, are simply businesses whose operations are protected from competition by wide, long-lived moats. These sustainable incumbent competitive advantages, barriers to entry, moats, and franchises are all terms that refer to the same underlying features of a business environment. The only problematic term in these expressions that are more or less synonymous is the role of incumbency in qualifying relevant competitive advantages. In certain situations, incumbents operate at competitive disadvantages. For example, where technology is changing rapidly, a newcomer may be able to leapfrog an incumbent and set up operations with a later generation of equipment at lower cost. Situations such as these are inherently unstable and benefit no one except consumers. Today's entrant is tomorrow's incumbent. If the technology continues to evolve, the entrant's competitive advantage will itself be undermined by a newcomer whose kit is even more advanced. The result is that no company establishes sustainable barriers to entry that might protect it from relentless competition. There are no good businesses in a competitive environment with relentless change. There may be widespread agreement that competitive advantages, barriers to entry, moats, and franchises are the essential economic factor for defining a good business. There is less agreement on what competitive advantages look like. One common view is that good businesses are synonymous with strong brand images. If customers perceive a brand as superior to competing products, it should be able to command a premium price. These premium prices should lead to the high profit margins characteristic of good business. A careful examination of the history of actual businesses suggests that things are not so simple. In Table 7.1, the left column contains businesses that have historically earned high profits. These are matched with high-profile brands in the right column that, for all the luster associated with their names, have not generally been nearly so profitable. Individual consumers certainly do not expect to bask in the reflected glory of products like Colgate toothpaste, Tide detergent, Purina dog chow, the Buffalo Evening News, or a Walmart shirt. On the other hand, showing up in a Mercedes-Benz, a Rolls, or a Cadillac may turn heads and elevate the status of the owner, at least in some eyes. These are the iconic brands, widely used to connote quality and class. They have become metaphors, the Rolls-Royce of stoves or the Cadillac of lawnmowers. Nobody calls something the Coca-Cola of handbags or even of vodkas. Sony is widely recognized for the quality of its products. The Hoover name was so widely recognized that in many parts of the world it became synonymous with vacuum cleaners, the Kleenex of vacuums, we might say. Yet for all their iconic appeal, these brands and the companies that produce them have not been extraordinarily profitable, especially when compared with the less glamorous brands in the column on the left. Rolls-Royce and General Motors, the maker of Cadillac, have gone through bankruptcies. In the U.S. cell phone market, it was not the former monopoly with a universally known brand, AT&T, that won out, but its regional offspring and then competitors, Verizon and Southwestern Bell, which eventually bought AT&T and took its name, that came out on top. Local newspapers, like those owned by Gannett, have historically been more profitable than revered national names like the New York Times and the Wall Street Journal, even as the latter have dominated the competition for journalist awards and recognition. Whole industries, such as cosmetics with high levels of advertising and brand awareness, are often far less profitable than no-name businesses like title insurance, in which FNF is a leading competitor. Brands simply do not tell anything like the whole story about what constitutes a sustainable competitive advantage and therefore a good business. First mover advantage is a second frequently cited competitive advantage that looks even worse as an indicator of historical profitability. In Table 7.2 arrays first movers with the companies that ultimately came to dominate their industries and achieve much higher profitability. In many cases, such as airlines, Pan Am and TWA, automobiles, Ford, and personal computers, Atari, Apple, pioneers have given way to competitive markets in which no one earns the returns we expect of a good business. In other instances, such as personal computer operating systems, ISPs, Internet Service Providers, Internet search engines, and television networks, pioneers have been displaced by later, now dominant competitors. In a handful of industries, notably online auctions, eBay, the first mover has managed to remain the dominant competitor. First movers have been no better than companies with esteemed brands in achieving sustainable competitive advantages and the profitability that we expect from good businesses. Other approaches, rooted more in the field of business strategy than investing, typically depend on many factors or long lists of potential competitive advantages to identify good businesses and appropriate business strategies. Probably the most notable example of this approach is Michael Porter's 5 Forces analysis, which looks not just at barriers to entry, but also an intra-industry competition, supplier power, customer power, and substitute products. The problem with these approaches is that they are unwieldy, difficult to apply in practice, and often lead to ambiguous conclusions that can be used to justify conflicting judgments of the strength of any particular competitive advantage. When the creator of this approach sought to identify good, generic business strategies, the 5 Forces tellingly played no role in his analysis. Since understanding the special characteristics of a franchise business is so central to modern Graham and Dodd valuation approaches, we would like a simple, transparent, and accurate approach to identify the competitive advantages that distinguish good franchise businesses from the others. We will begin with an example that seeks to classify the mechanisms of competition and thus the ultimate factors that protect company returns from its consequences. Toasted earnings. Consider a hypothetical company. We will call it Top Toaster because toasters are what it makes, that has been particularly successful. For the last 5 years, it has earned around $20 million each year. To keep things simple, we will state that there is no substantial difference between reported net income and the amount of earnings it can distribute to shareholders. Investors in the company are willing to accept a 10% annual return on their investment. Applying the EPV equation we developed in Chapter 5, the EPV of the toaster company is earnings times 1 divided by cost of capital, $20 million divided by 10%, or $200 million. Assume next that the company's asset value is $80 million. This figure includes all the tangible assets, cash, accounts receivable, inventory, and plant, property, and equipment, each adjusted to reflect any differences between the figures on the company's books and the actual money a competitor would need to spend to reproduce them, and the intangibles as well, including consumer recognition and reputation, product design, production know-how, worker training, distribution channel development, whose reproduction also requires expense. There is a $120 million discrepancy here between the asset value and the EPV, and if the stock market should value the company at $300 million, then the gap above the asset value would be wider still. Unfortunately for Top Toaster, the EPV of $200 million and the market value of $300 million will be a green flag to potential competitors. Some bright entrepreneur, perhaps someone already in the small appliance business, or an executive at another toaster company with access to investment capital and experience with retail outlets, will recognize that they can produce this income stream worth $200 million for an investment of only $80 million. Or, to put it differently, they can earn $20 million a year on an $80 million investment, a 25% return that almost qualifies as exorbitant. The entrepreneur enters the toaster business by opening a new plant, expanding the capacity of an existing one, or finding a contractor to produce the toasters. He or she finds or buys an acceptable design, develops attractive packaging, and hires experienced sales agents to hawk the stuff. Assume for the moment that toasters are a commodity-like product, meaning that they are more or less interchangeable with one another and are selected entirely on the basis of price. Increased competition means more toasters on the market, and more toasters means lower toaster prices. As toaster prices fall, the profits of all toaster companies fall in tandem with one another. As the earnings of Top Toaster start to shrink, so does its earning power. After the first competitive wave hits, assume that earnings decline to $16 million. Unfortunately, the waves continue to break. Earnings of $16 million, with a desired return of 10%, value the company at $160 million. The assets still cost $80 million to replicate. That leaves an $80 million gap, sufficient inducement for a second entrepreneur to start stamping out toasters. In fact, only after the gap disappears and the EPV falls to $80 million will new entrants, or incumbents expanding their production, stop their invasion of Top Toaster's inviting financial territory. The process ends, in other words, when there are so many indistinguishable toasters on the market that prices and profits have fallen to the level at which none of the suppliers earns more than the cost of capital that investors demand on their money. For many toaster companies, life will be even nastier, shorter, and more brutish. The final industry price, at which any incentive to enter will have been eliminated, will be one at which only the most efficient toaster producers will survive. Inefficient incumbent producers, those who cannot meet this price, will leave the business. It is the entry of the lowest cost, most efficient producers that drives prices, not the threat of future inefficient ones who will simply stay away. In this competitive process, it is the strongest competitors that matter, not the weaker ones. The problem of declining profits in the face of increased price competition has challenged thousands of companies that cannot distinguish their goods or services from those of other players. It is a truth universally acknowledged that all sensible people abhor commodity businesses, the archetype of bad businesses. The standard advice for avoiding this fate is to differentiate your product or service from all the others. For Top Toaster, that means spending money on advertising, adding product features, or changing the design. All of these may work to temporarily insulate Top Toaster from the immediate pressure to cut its price. Unfortunately, these moves do not solve the fundamental problem. The competitors are still there, aiming for a share of Top Toaster's attractive market. Nothing prevents them from introducing competing designs, adding their own features, and matching Top Toaster's spending on advertising. Inevitably, they take away some of Top Toaster's business. Even if its prices do not decline, Top Toaster sells fewer units, but fixed costs such as product development, package design, and advertising do not decrease proportionately. In the face of active competition, they may actually rise. At the same time, Top Toaster is not going to be able to raise prices, and its variable costs are not declining. If anything, intensified competition for resources will drive variable costs up. Top Toaster finds itself staggered by two blows. It is selling fewer toasters, and because its fixed costs are spread over fewer units, its profit margin on each one has contracted. Overall earnings decline, as in a commodity market, until EPV and asset value are equal. Differentiating the toaster is at best a short-term fix. New entrepreneurs will keep showing up, or old competitors continue expanding. Toaster production will keep increasing, and products will proliferate until the profit opportunity motivating it disappears, until, that is, the $80 million of assets produces an income stream of $8 million, provided investors still will take a 10% return on their capital. At that point, the EPV and the reproduction cost of the assets are equal to one another, and there is no easy money to be made by entering or expanding in the toaster business. It doesn't matter if the toaster is a commodity and sells only on price, or a differentiated product and sells on features, providing Top Toaster with discretionary control of prices. So long as Top Toaster cannot separate itself from the competition, new entrants will appear until the EPV becomes equal to the asset value. This equality is not an accident. It is a fundamental economic condition, and it results from the corrosive influence of competition on prices and profit margins. The process of competition again displays itself by the ability of other firms to enter or expand in quest of a profit opportunity. The proximate causes of profit erosion for a firm with differentiated products like Top Toaster are not identical to what would be the case with pure commodities. Rising unit costs and declining unit sales are the villains, not declining prices. But the end result is the same. Only the most efficient toaster producers survive, and in the long run, returns on capital are driven down to the cost of capital. Moreover, in both commodity and differentiated product competition, periods of temporary prosperity will attract enthusiastic entry. This will often be followed by extended periods of overcapacity due to the long-lived nature of the capacity the new entrants have added. So even though average results over the long term should just equal the cost of capital, there may be significant fluctuations around this level. Although this process is rough on the Top Toasters of the world and on their investors, it is a benefit for consumers, meaning all those who had been financing the difference between the EPV and the asset value with the price they paid for toasters. Automobiles. Value in the nameplate? Top Toaster and its competitors are figments of our imagination, but in the absence of barriers that impede entry, the process through which the value of the firm in the long run comes to equal the value of the assets is real enough. And this process works, even in situations where companies and products benefit from strong brand images. An example from recent history confirms the theory. In the entire world, there are few brand names as widely recognized as Mercedes-Benz. It is universally associated with a superior product, high in quality and prestige. The cars themselves are immediately distinguishable from other automobiles by the Mercedes-Benz star, which serves as both hood ornament and icon for the corporate commitment to excellence. By all rules of product differentiation, Mercedes-Benz ought to enjoy a strongly protected market position and, as a consequence, high profitability. Yet for the 3 years, 1995 to 1997, before the company acquired Chrysler, Daimler's pre-tax return on the identifiable assets in its automotive business averaged 7.2%. If there is a franchise here It does not show up in the returns being generated. They are at or below any reasonable cost of capital for the automobile industry. We can also analyze this situation from a value perspective. Suppose that the cost of capital for Daimler-Benz is 10%. In 1997, the automotive division earned 3.5 billion DM pre-tax. Based on these figures, its EPV would be 35 billion DM, again pre-tax. The reproduction value of its assets is equal at least to these amounts. The book value of capital was approximately 30 billion DM at the end of 1997. This excludes the cost of reproducing the engineering knowledge, images, dealer network, and organizational experience of the corporation. At a minimum, that would amount to an additional 10 billion DM, representing 3 years of R&D. A new entrant would gain precious little above this asset value of 40 billion DM by entering Mercedes-Benz's market. Mercedes-Benz is not unique. The history of the automobile market in the United States illustrates the same characteristics. General Motors was a master of product differentiation. Its range of brands, from Chevrolet at the low end through Pontiac, Oldsmobile, Buick, and Cadillac, was intended to segment the market based on images tailored to particular demographics and income levels. In the 1960s, this strategy produced annual returns on capital that averaged 46%, implying an EPV well in excess of asset values. European car manufacturers looked at this return as a measure of the profit opportunities in the American car market. They judged that GM enjoyed neither superior technology nor fundamental advantages in reaching customers, nor, in a market becoming increasingly global, advantages of scale. Over the course of the 1960s and 1970s, Volkswagen, Mercedes, BMW, Jaguar, Rover, Citroën, Renault, Peugeot, Volvo, and Saab all expanded aggressively in the United States. General Motors' average return on capital fell to 28% for the 1970s. But the invasion did not stop. Starting in the 1970s, the Japanese entered the U.S. market in force. By the 1980s, Japanese manufacturers had the luxury car market in their sights. Honda started with its Acura line, followed by Toyota with Lexus, and finally, Nissan with Infiniti. By the 1990s, GM's return on capital had fallen to 6 to 7%, and in 2009, during the Great Recession, the company went bankrupt. In a competitive market, it was no longer an efficient producer. Globalization of the car market, including even the most luxurious and highly differentiated brands of the luxury car market, created irresistible competitive pressure. In practice, as well as in theory, the absence of barriers to entry meant that product differentiation alone could not sustain a good business. The nature of a franchise. The critical element in both the top toaster fable and the history of the luxury car market is the process of entry and the ability of entrants to compete with the established firms. So long as newcomers can develop and distribute new products on an equal footing with incumbents, they have, for example, an equal ability to differentiate, then all products are effectively commodities. Companies that have above-average earnings for sustained periods of time benefit from the inability of competitors, both actual and potential, to do what they do, and they are generally awarded higher valuations in the market. None of this means that brands have no value. A strong brand is an asset like any other. Its value is equal to its reproduction cost. However, if the value of a brand is equal to what it costs to create, then branding by itself is not the source of value. Value is only created when the incumbent has abilities that new entrants cannot match. When a potential entrant sees top toasters earning $20 million per year on assets of $80 million, it must recognize that it will not be able to do as well. Top Toaster must enjoy a competitive advantage over would-be rivals. The newcomer will stay out of the market if it sees that it cannot compete on equal terms. Top Toaster's competitive advantage acts as a barrier to entry and puts a brake on the profit-eroding process that occurs when entrants are able to compete on potentially equal terms. Another way to say the same things is that the continued existence of Top Toaster's profitable franchise depends on the existence of competitive advantages it enjoys. These act as barriers to entry and deter competitors. They are the major sources in a modern market economy of any value that exceeds the cost of reproducing a firm's assets. Competitive advantages. Contrary to popular management discourse, there are only a few types of competitive advantages. Examples of sustained competitive advantages in the business world are the exception rather than the rule. The simplest form is the advantage created by the government when it grants a license to one or several firms to engage in some kind of business, leaving everyone else excluded. Cable franchises, broadcast television stations, telephone companies, and electric utilities all enjoyed exclusive local franchises. Potential competitors were deterred by law. As technology has changed, so have the regulatory and licensing regimes under which these firms operate, and some formerly protected businesses have had to learn to compete. It is unlikely that all forms of exclusive, governmentally generated franchises will disappear. However, governments in modern constitutional democracies are not generally committed to making business owners rich. Exclusive government franchises tend to be restricted to the few industries, electric utilities, cable TV, and local telephone service, where the underlying cost structures mean that the most efficient configuration is to have a single provider, and the duplication of basic infrastructure is inherently wasteful. Economists describe these industries as natural monopolies. In exchange for awarding exclusive franchises, governments usually get to control prices and profits to make sure that the selected companies do not earn excessive returns. To the extent that governments are successful in their oversight, the firms will earn just their cost of capital on both future and past investments. As a result, these regulated monopolies should have asset values equal to EPVs and should create no long-term value through growth. From a value perspective, therefore, we are going to be much more interested in franchises that arise outside the protection of government regulation than those that are subject to it. Cost and revenue advantages. The list of non-government competitive advantages follows from the basic profit equation of any business. Revenues less costs equals profits. One key term in the equation is costs. Potential competitors of Top Toaster or Mercedes-Benz might be deterred because they are unable to meet the low costs of these firms. The only way such cost advantages are sustainable is if the incumbents possess production techniques or products that the entrants cannot match. Patents, for example, whether on the products themselves or the process of producing them, create one kind of cost-based competitive advantage. Know-how, sometimes described as the downward-sloping learning curve, is another important advantage. Even as it gains experience, the entrant will always trail the incumbent in the necessary expertise it takes to make things efficiently. The test here is whether the required technology, including the human-based skill, is accessible to the entrant on the same terms as it is to the incumbent. Neither Top Toaster nor Mercedes-Benz has access to technology or other knowledge that is not equally available to their potential competitors. Another possible cost advantage is access to cheap resources like labor and capital. This advantage is hardly ever found in practice. Most resources are mobile and plentifully available on a global basis, and there is nothing that inhibits entrants from acquiring them on the same terms as incumbents. Some firms with unionized labor or other constraints may be forced to operate with high resource costs, but the incumbent has to worry about its most efficient competitor, not its least. Firms that operate in countries with low wage costs, such as China, are often thought of as having a competitive advantage based on their ready access to cheap labor, but this advantage is illusory. Their strong competitors are in China and other low-wage countries, and they all have access to similar labor pools. Some companies make the argument that their advantage is access to cheap capital. This argument takes two forms. Large companies often refer to advantages associated with deep pockets, implying access to large amounts of capital at costs their competitors cannot match. The competitors they have in mind are much smaller, the mom-and-pop businesses that play such a large role in American economic folklore. But these small firms are their weakest competitors, not the relevant, strong competitors who are invariably large firms with pockets equally deep. Companies that talk about deep pockets as a competitive advantage end up emptying those pockets much more frequently than they fill them. A second common version of the cheap capital argument arises when companies have sold securities in favorable capital market conditions, and their competitors are faced with the need to raise capital on less attractive terms. Consider a firm that issued long-term debt at an interest rate of 2%. Suppose that the yield on comparable long-term debt had risen to 7%. The price competitors would have to pay to raise funds today. The fortunate company may feel that with a cost of capital of 2%, it has a competitive advantage over the companies paying 7%. Again, this supposed advantage is an illusion. Devoting the proceeds of the 2% bond issue to projects yielding 2%, when these funds can reliably earn 7% elsewhere, buying the competitor's bonds, for example, is gross stupidity, and stupidity is never a competitive advantage. The true cost of these funds is today's 7% opportunity costs, not the original 2% contract cost. Genuine cost advantages related to inputs are usually based on specialized resources, such as a mine with particularly high-grade ore, a store with a prime location, or a special talent, like Beyoncé, signed at a favorable price. But 3 points need to be made about even these resource advantages. First, the mine, the store location, or the talent is often controlled by someone outside the company, a government, a real estate company, or the talent herself. At some point, the terms will be renegotiated, and the competitive advantage will be priced away. Specialized resource advantages are often short-term ones. Second, such specialized resources are fungible. There is no particular reason why they reside in a particular company. They can, therefore, be regarded as special assets rather than competitive advantages. Third, and related, these special resources are not barriers to entry unless they are truly irreplaceable and fully occupy a market. Unless an efficient copper mine is capable of providing so much supply that there is no room for other, higher-cost entrants, it will not represent a barrier to entry. The same applies to store locations. New stores will be built either near the special location or in competing areas. These stores will attract customers, and despite its favorable location, the existing company will see some of its customers shop elsewhere. Similarly, Beyoncé will face competition as new musical talent appears all the time. It makes more sense to think of special resources as assets rather than competitive advantages. An important distinction is that these kinds of assets only rarely generate growth-related value. Proprietary technology is a more common source of cost advantage, but it also tends to be fairly limited both in the range of industries in which it is significant and in the extent to which it contributes to barriers to entry. In industries subject to rapid change, both patent protection and proprietary experience-based advantages tend to be short-lived. Technological advantages are usually specific to particular technologies. They disappear when a technology is replaced by a better alternative. In high-tech industries, this sort of generational change occurs frequently, and current advantages must be constantly renewed to make them durable. A company's ability to maintain its lead through many generations, like Intel, is by no means guaranteed. As a consequence, technological advantages in the high-tech sector are generally of short duration. At the other end of the spectrum, in low-tech service businesses such as retailing, the pace of technological change is glacial. After a time, most innovations that were once leading edge become embedded in industry-wide practices, spreading from the developers or early adopters to all the firms that operate efficiently. It is primarily in those industries with intermediate rates of technological change that proprietary technology represents a significant competitive advantage. Customer demand advantages. The other key term in the profit equation is revenues, which depend on customer demand. If the incumbent is to have a competitive advantage here, it must have superior access to those customers that are the source of that demand. For this incumbent demand advantage to persist, customers must in some way be captive to those incumbents. In an open and competitive economy, there are only a limited number of ways in which customer behavior leads to captivity. Habit, usually associated with high purchase frequency, is probably the most powerful. For a soda company to compete with Coca-Cola, it must induce Coca-Cola drinkers to stop drinking their favorite beverage. This is no easy task. Consumer studies and historical experience suggest that Coke drinkers are fiercely attached to their Cokes. By comparison, the attachment to Budweiser, another leading beverage brand, is weaker. When diners go to Chinese, Japanese, or Mexican restaurants, they have no reluctance to order a beer from that country, but the chances of them asking for a local cola are slim. For items that are not on the weekly shopping list, there are other processes through which customers are made captive to specific products or services. If the cost of searching for an alternative to the existing supplier is high, then new entrants have a difficult time attracting customers who are not actually dissatisfied with their current arrangements. Take the case of the residential insurance market. There are many dimensions to a policy, in addition to its cost: coverage, deductibles, levels of service, exceptions, creditworthiness of the carrier, and several others. Unless they are strongly motivated, few homeowners are going to take the trouble to search for a replacement. Their aversion to change is reinforced in this example by the painful results that may ensue from an inappropriate choice. It hurts to have the wrong insurance carrier or policy after the disaster strikes. Given these difficulties and dangers, a new entrant into this market will find it difficult to induce customers who have had decent experiences with their existing carriers even to begin searching for a replacement. Practically the only way the entrant can make any inroads is by offering to write the insurance at premiums substantially lower than the incumbents are charging. As long as incumbent pricing policies are neither inflexibly unresponsive to competition nor overly aggressive, this is almost always a losing strategy. Entry in situations like this stop well before the high profit levels of the incumbents are completely eliminated. In the model we have proposed here, the high search cost limits the arrival of new entrants, and the gap between the asset values and the earnings power values of the incumbents does not disappear. High switching costs are the third and probably the most common source of customer captivity. If it costs money, time, and effort for a customer to switch from one supplier to another, incumbents have an advantage over entrants. For example, when a company changes software systems for payroll, benefits management, internal communications, funds transfer, or other important functions, they have to spend not only on the software, but also on extensive retraining of their staff. That is bad enough. Even worse, the error rate on the new installation still goes up. It is no wonder that there is a powerful bias toward keeping the current system. And if this is true for functions such as payroll, it is 10 times truer for the aptly named mission-critical or even enterprise-critical systems that manage order entry, purchasing, production, inventory, shipping, billing, and accounts receivable. The corporate graveyard is filled with firms that bet the business on introducing a new, improved, integrated, and full-featured system and lost. Switching costs are a powerful source of competitive advantage for companies such as Microsoft and, in a previous computer era, IBM. An entrant going after this business will not be playing on a level field. Because most users are already familiar with Microsoft systems, any successful entrant must overcome the costs to those customers of switching to an unfamiliar alternative. Additionally, as computer users increasingly communicate with each other, any single user incurs additional costs of switching to a new software supplier unless all others do so at the same time. It doesn't pay to have the best communication program in the world if there is no one else connected to it. Less dramatically, there is a cost to switching any time the new supplier has to master the particulars of the customer, client, or patient. This applies to new lawyers, banks, and service companies, such as mechanics who are familiar with the existing systems, health insurance plans, and drugs for a doctor who must learn the risks and potentials of the new medication. It also applies to Google competitors who must learn to process search queries for users as effectively as Google, which has had many years of individual experience to adapt its search procedures to meet the needs of each customer. Neither the fictional top toaster nor the very material Mercedes-Benz and its luxury car rivals are likely to benefit from significant customer captivity. Purchases are infrequent and not driven to any significant degree by habit. Search costs are low for top toaster. They may even be negative for luxury automobiles, where search involves visiting attractive showrooms, being catered to by attentive sales staff, and taking test drives in luxurious new cars, hardly an onerous process. Finally, once a decision has been made to replace an existing toaster or automobile, the switching costs are generally the same no matter which alternative a customer selects. In the language of marketing, it is brand loyalty, not brand image, that is critical. Neither top toaster nor Mercedes-Benz are likely to be brands with high loyalty and repeat purchases. We contended earlier that although the term barriers to entry was frequently used by investment analysts, generally to justify the high price of a particular security, in a world where businesses fiercely compete with one another, real barriers come in very few forms. The clearest cut are governmental privileges, such as licenses, patents, copyrights, or other protections that keep potential competitors at a safe distance. The other barriers we have described stem from either cost, supply, or customer demand advantages. These consist chiefly of proprietary technology or customer captivity. Given that they address the two halves of the profit equation, it is natural to think that they exhaust useful categories of competitive advantage. They do not. Especially where we emphasize the sustainability of competitive advantages, there is a third important category that has to be identified and discussed in detail. Economies of scale and sustainable competitive advantages. The downside to the advantages of customer captivity and proprietary technology is that they have limited lives. As we discussed before, Technology advantages are inherently transitory. They erode in the presence of both rapid and slow change. Customer captivity is generally long-lived, but like technologies, customers eventually die. Sometimes this is literally true. At other times, they simply move on as tastes change and buying habits mature. Children are captive customers with strong habitual preferences, but they don't stay children forever. A company marketing to youngsters has to capture each generation of children anew. For a company to benefit from barriers to entry over an extended period of time, it must enjoy competitive advantages in the process for acquiring new generations of technology and of customers. This is what advantages of scale provide. The benefits of scale advantages are straightforward. Current and potential competitors cannot match an incumbent's performance because they cannot match its scale of operation. The advantages of scale have to be found either in lower costs or greater access to customers. For the advantages to be durable, the company has to be able to defend its position. If competitors can easily steal away customers, then the scale advantage evaporates. Finally, the advantages conferred by greater scale must be material. Smaller competitors must operate at a significant disadvantage. If the advantages of scale are largely achieved with a mere 2 to 3% market share, then it will be difficult to deny them to any potential competitors. The cost side of economies of scale is related to the proportion that fixed costs account for in the entire cost structure. When fixed costs are a major part, the more units a company makes, the lower its average costs, provided that variable costs do not increase with scale, because the fixed cost burden is shared over more units. In our age, the archetypal example is off-the-shelf software, programs that are sold to thousands and millions of users. It costs a fortune to organize the operation, design the program, write the code, debug it, and get it tested by hundreds of users. It costs virtually nothing to publish one more box of CD-ROMs, even less to distribute it via internet downloads or to have it available in the electronic cloud for a subscription fee. Under these conditions, a competitor who can acquire a majority share of the market will enjoy lower unit costs than other firms in the business. On the demand side, economies of scale take the form of network effects. This refers to situations in which the more customers who use a particular product, the more valuable it becomes to each individual customer. Microsoft has been the beneficiary of these network effects, both for the Windows operating system and its business suite of application programs, Word, Excel, PowerPoint, and Outlook. If these are the common tools of white-collar workers in businesses and other organizations, then schools are going to train their students on them so that graduates will be ready when they transition to work. And to complete the circle, businesses that hire these students will also use Microsoft products because the cost of training is minimized compared to what it might be with more esoteric competitive products, no matter how technically superior they might be. Similarly, if most online individual sellers of stuff they want to unload or even sell commercially operate through eBay using PayPal as a preferred payment option, more buyers will be attracted because of the greater range of choices than elsewhere and will need to master only PayPal as a payment mechanism. The buyer experience is simplified and improved for auction-like purchases from a widely dispersed universe of sellers. The same conditions apply on the seller side: more customers and only one payment system to master. The network effect helps both buyers and sellers deal more efficiently with larger markets. These same features apply even more powerfully in aptly named social networks. Facebook is the most obvious example, and would be even without a movie credit. It has reinforced its barriers to entry by buying potential competitors such as Instagram and WhatsApp before they could mount serious challenges. The critical feature of these scale advantages is that they apply equally to existing and potentially new technologies and customers. In the case of proprietary technology, consider the competition between Intel and Advanced Micro Devices (AMD) to produce the next generation of microprocessors for personal computers. If Intel has the dominant market share today and expects to continue to dominate the microprocessor market in the future, it will have resources 8 to 10 times the size of AMD. If the two companies spend the same proportion of revenue on R&D, meaning the same level per each unit sold, Intel will be able to spend 8 to 10 times as much in pursuit of the next generation of microprocessors as AMD. AMD may sometimes get lucky and produce a microprocessor that temporarily outperforms Intel's current product line. But given the disparity in spending on R&D, Intel will soon have a new generation of products that outperforms AMD. In the long run, the race for new technology, given the resource disparity, will always be won by Intel. Intel will also have advantages in attracting new customers, meaning new PC manufacturers. Intel has the choice of spending less than AMD as a percentage of sales, say only 5 times in total more than AMD, as has historically been the case, and with lower unit costs, charge PC manufacturers lower prices. Also, Intel benefits from significant network effects. Because the Intel/Microsoft standard dominates the PC market, applications programmers tend to write programs that work especially well in that environment. The result is a greater range and quality of applications programs for PCs with Intel chips. This numerical and operational superiority induces manufacturers to prefer Intel's chip architecture and wait for its next generation of processors, rather than switch to an AMD chip with currently superior technology. Because of this advantage with customers, the Microsoft/Intel system has remained dominant through 20-plus generations of technology over 30 years. This is the sustainability of economies of scale in action, even in a sector with robust technological change. Economies of scale are also sustainable in low-technology markets. Consider a retailer such as Walmart in a local market, such as Arkansas, where it has 60% of the market share. Local distribution, warehouses, and trucks to carry goods to individual stores all benefit from local economies of scale. With higher sales, Walmart warehouses will have greater throughput rates and lower unit costs than those of smaller competitors. Its trucks will have shorter routes for the same volume and thus lower unit delivery costs. Local advertising is a fixed cost that Walmart can spread over many more dollars of sales than its Arkansas rivals. Experienced Walmart managers who supervise numbers of local stores will spend far less time traveling and thus have more time to manage than the executives of competitors with a less dense network of stores. In an industry such as retailing, with relatively high turnover of low-skilled labor, management effectiveness and involvement are critical to efficient operations. The overall result is that Walmart has lower costs and often a better store experience than its rivals. Walmart has used these scale advantages to support an everyday low price strategy that its local competitors cannot match. The everyday low prices, in turn, give Walmart a significant advantage in attracting new customers, sustaining and even adding to its dominant market share over time. Again, economies of scale advantages, in this case without any network effects, lead to long-run sustainable advantages through multiple generations of customers. For manufacturers, development costs are usually fixed by product line, making market share within the product line what counts for economies of scale. General Electric is a giant company, but it only benefits from economies of scale where it dominates the market for a particular product line. Competitive advantages grounded on regional and product line economies of scale are the ones we are most likely to encounter in practice. Only rarely do firms achieve national or global advantages, and these hardly ever spread across a range of product lines. IBM, to cite the most obvious example, could not extend its dominance in mainframe computers into the desktop era, even though it established the standards for the microcomputer. That advantage went to Microsoft, which itself has not been successful in dominating markets beyond operating systems and standard Office applications. Those, as we know, have been enormous. A second important aspect of economies of scale is implicit in both these examples. The scale involved is not overall size, but the size relative to the particular markets in which companies, in our examples Intel and Walmart, operate. Intel has scale advantages in the market for PC microprocessors. It does not have comparable scale advantage in making signal processing chips for smartphones, graphic chips for game consoles, or memory chips for personal computers. The scope of the relevant market is defined by the fixed costs involved. If Intel were to attempt to enter any of these markets, it would incur a whole new set of R&D costs that would have to be spread over its signal processing, graphics, or memory chip sales. With minimal current share in those markets, Intel would have no scale advantages. Network effects are similarly market-specific. Applications developers for smartphones or game consoles are not writing programs for an Intel/Microsoft environment. Other firms dominate in these areas, and Intel would be operating at a competitive disadvantage. Intel's scale advantages are global in geographic reach thanks to the global nature of the PC market, but they are decidedly local in product space. In the Walmart example, distribution, advertising, and regional management are specific to particular geographic areas. It is not Walmart's overall size that matters, but its density, its local share in each regional market, as its advertising blankets a region, and its distribution and management systems serve the region efficiently. Expanding to countries where it has neither adjacent facilities, as it does in Mexico and Canada, nor dominant local share has been consistently unprofitable for Walmart. An identical situation applies to health maintenance organizations, HMOs, and other service businesses. An HMO that has enrolled 60% of New York metropolitan area patients will spread its local fixed costs of marketing and administration over a much larger customer base than its competitors. It will also benefit from powerful local network effects. With 60% of patients, virtually all local doctors and hospitals will find it necessary to join the HMO's network. With such a comprehensive population of affiliated doctors and hospitals, the HMO will offer a better range of treatment choices than its competitors, reinforcing its hold on patients. None of these scale advantages are affected by the HMO's market positions in Chicago, Miami, Dallas, or even Boston. For service businesses, it is local geographic scale, density, not global size, that matters. A third feature specific to economies of scale is that they cannot stand by themselves. To benefit from scale advantages, a company must be able to defend that advantage from competition. It is not just that Intel has a higher market share today that allows it to outspend AMD or other potential entrants on R&D. It can afford to do that because it expects to have the same dominant scale in the future. Suppose that AMD expected to capture the whole market with a better chip. In that case, AMD would be happy chasing the same future scale as Intel and could, in theory, afford to spend the same amount as Intel on R&D. Similarly, Walmart earns advantages from the greater use of its advertising, distribution, and management infrastructure only if it can keep its customers in the face of competition. If a new entrant matching Walmart on prices could divide the customers equally with Walmart, then Walmart's scale advantages in using its infrastructure of warehouses, delivery trucks, and experienced management would disappear, and the barriers to entry with them. Scale advantages have to be acquired. They also have to be defended. The defense depends on some degree of customer captivity, or at least customer inertia. The demand advantages can be small, but they must rule out the possibility of a new competitor gaining an equal share of the market. Suppose an incumbent company whose cost structure benefits from economies of scale has won a disproportionate share of the market. If it can retain its customers at a price, product quality, and marketing budget that just match those of potential competitors, it will be able to defend its dominant market share, and thanks to the lower unit costs it achieves through its scale advantages, it will have higher margins and profitability than its rivals, which should provide the basis for continued market dominance. A strategy of matching whatever innovations entrants employ will always be a successful one. For network effects, there is a natural element of customer captivity, since customers would have to move to a competitor in a coordinated way to undermine the incumbent. Nevertheless, where economies of scale are involved, consistent vigilance in protecting these advantages is always called for. The first priority of management is to protect market share, matching or anticipating rivals' product features, advertising campaigns, or pricing initiatives. All this is essential because once market share starts to erode, underlying cost and network advantages shrink with it. In our Intel and Walmart examples, Intel is protected by customer captivity. Its customers are leading PC manufacturers who have learned to depend on Intel to deliver leading-edge, quality chips in high volumes. Switching to any other untried suppliers, even one with the resources of an IBM, is a risky undertaking. The manufacturers have a natural preference for Intel that Intel consistently seeks to reinforce by its relentless pursuit of leading-edge technology and high quality, coupled with its Intel Inside and subsequent campaigns to lock in end-use customers. Walmart benefits from a degree of habitual behavior that characterizes most shoppers, but it too seeks to reinforce this behavior with its everyday low price policy, even at the expense of current profits. The good business in sum. We can now summarize what a good business enjoying a sustainable competitive advantage looks like. It must enjoy economies of scale advantages buttressed by customer captivity, and in some cases, also proprietary technology. Economies of scale are defined on a market-by-market basis. It is not size but size in a specific market that matters. One final example should help make this clear. Coca-Cola is a classic franchise business. It has earned extraordinary returns on capital for more than a century. It is widely regarded as a quintessential global brand, but in fact, it makes essentially all its profits in a relatively small number of national markets that it dominates. Local bottling and distribution involve significant fixed costs that are specific to each local market served. Advertising and marketing in retail outlets are also locally bounded expenses. In the markets where Coca-Cola is dominant, it spreads these fixed costs over far more units than its competitors. As a result, its overall costs are relatively much lower than those of its competitors. It can charge less for its products and spend more on promotion than its competitors and still enjoy high profit margins. Given the deep attachment of Coca-Cola drinkers to the brand, even if Coke were to raise its prices, it would lose very little in market share. In these high-profit national/local markets, Coca-Cola has powerful competitive advantages that create strong barriers to entry independently of any secret formula. We can quantify the width of Coca-Cola's moat. To start with the required market share an entrant would have to attain in order to earn anything like its cost of capital. This will depend on the size of Coca-Cola's economies of scale advantages in each local market. We can get a rough estimate of that by looking at the profitability of beverage companies around the world as a function of their local market share. This varies with the locality and the nature of the beverage. For example, high-priced craft beers or products distributed jointly with brands like Coca-Cola may require less, but in general, mass-market beverages like Coca-Cola must have at least a 20% local market share to be economically viable. The second element of the moat is customer captivity, which determines how hard it is to acquire that target market share. Again, there are many variables involved. If an incumbent vigorously defends its position, then a market share goal will be harder to reach than if an incumbent firm is more accommodative and more concerned with its own current profit. We can look at historical market share stabilities for caffeinated soft drinks over a range of local markets and time periods. On average, no more than 0.2% of market share changes hands in any given year. This is not surprising given the deep brand loyalty of Coca-Cola drinkers. With market share changing 0.2% annually, it will take 100 years for a competitor to reach a 20% share. This is a wide moat indeed, and it is enhanced by Coke's generally aggressive defense of its territories. This defense takes two forms. First, Coke can increase advertising and improve distribution in ways that increase fixed costs for itself and, more importantly, for its competitors. Higher fixed costs in a stable market raise the target share that an entrant must reach to be viable. Second, it can implement pricing policies and loyalty programs that reinforce customer captivity and reduce the rate at which entrants can acquire market share. The global market for luxury cars is at the other end of the spectrum in moat size. As part of a large global market, car companies that originally sold almost exclusively within their national markets can now be economically viable with as little as 2% global market share. The share stability is also much lower in this market than it is for colas. We have seen changes of 0.5 to 1% in a single year. So getting to 2% might only take 2 years. The moat in the luxury car markets, then, is narrow and bridgeable. These calculations are based on historical evidence about competitive advantages and franchises businesses. They reveal that franchises are overwhelmingly niche businesses. Large global markets are difficult, if not impossible, to dominate. If, as in the global automobile market, entrants can be viable at a market share of 3% or less, it is going to be difficult to keep anyone out. As the history of the personal computer industry demonstrates, it has been the niche businesses that have prospered, not the highly visible, broadly based PC makers. IBM, Dell, Sony, Hewlett-Packard/Compaq, and even Apple, with its distinctive operating system, have ultimately seen limited profits or have exited the business altogether. In contrast, Microsoft, with its operating system and adjacent Office suite, Oracle, with its database expanding to adjacent applied business software, Google, with its search engine, Adobe in fonts and graphics, and Intel in microprocessors after it abandoned memory chips, have all enjoyed high profitability and long-lived dominant positions in their niche markets. Highly profitable service businesses such as Walmart, Verizon in cell phones, and United Healthcare in health insurance have all dominated particular geographic regions and been careful to expand at the edges of those regions. Sustainable competitive advantages are grounded in economies of scale, a proportion of fixed costs, and/or network effects. In each local market, it will be the largest or dominant firm that possesses these advantages. This, in fact, is the primary characteristic of a franchise business, that it dominates its local market. The scale advantages will be protected and supplemented by customer captivity, proprietary technology, and sometimes government licenses or other restrictions on entry. These firms will produce high returns on investment over many years, during which they are able to sustain their dominant market positions. There will be high share stability within their markets and a history of failed attempts, or in some cases, no attempts at all at entry. The analysis here must be done on a market-by-market basis. Markets with no dominant competitor and/or a large and fluid population of companies are rarely markets with sustainable competitive advantages. For franchise businesses, value-creating growth is growth that occurs in markets in which the company's existing competitive advantage apply, usually within or adjacent to its existing dominant market position. In assessing competitive advantages, it is usually clearest to begin by looking at the more qualitative dimensions of a franchise business: market dominance, failed entry, economies of scale, customer captivity, and proprietary technology. Only after these qualities have been identified is it worthwhile to examine the more quantitative measures of a franchise business: returns on investment, market share stability, and years of moat duration. Clarity rarely begins with complex numerical calculations. Two final points are worth noting. First, as with Coke and Pepsi in the United States, or Airbus and Boeing in the global airframe market, a dominant market position may be shared by more than one competitor. Under these conditions, the competitive dynamics between these firms is a critical determinant of profitability and the value of growth. The best management strategy is cooperation. Shared competitive advantages lie between situations of individual dominance on the one hand and competitive markets with no barriers to entry on the other. Cooperative managements, provided they steer clear of antitrust law violations, will produce a level of total industry profitability resembling that of a single dominant company. Growth will also be value-creating, provided each of them restrains the natural desire to grab it all. Failed cooperation and testosterone-driven competition will reproduce a competitive market environment that will undermine the value of any competitive advantages and lead to growth that does not create value. Second, as the previous point illustrates, management quality matters to valuation. Good management is certainly an advantage, but there is nothing built into competitive situations to assure that a company's superior talent will endure. As Warren Buffett has pointed out, when an industry with a bad reputation meets a management with a good reputation, it is generally the reputation of the industry that survives. And taking that wisdom to heart, we have focused on the industry's, or more precisely, on the market's reputation. We will address issues of management in a later chapter. The symbols by which securities are identified in the public markets do not include labels that allow investors to differentiate companies with genuine franchises from those without. No visitor to the corporate headquarters needs to climb over barriers to entry, should they exist, in order to meet with company executives. And of the many advantages a firm proclaims for its flagship products, durable competitive advantages are generally not among them. Spotting franchises is a difficult skill, one that takes time and work to master. Also, it is not easily extensible. Value investors like to operate within their own circle of competence, where the knowledge they have accumulated about newspapers, insurance companies, cable stocks, bankrupt bonds, or other types of investment can be applied in a new but still familiar situation. When Benjamin Graham went scouring financial statements looking for his net nets, it did not concern him that he may have known little about the industry in which he found his targets. All he was concerned with were asset values and a margin of safety sufficiently large to protect him from too frequent losses. But in a world where market prices already exceed asset values and the margin of safety by that measure is negative, a contemporary value investor had better be able to identify and understand the sources of a company's franchise and the nature of its competitive advantages. Otherwise, he or she is just another punter, taking a flyer rather than making an investment. 8. The valuation of franchise stocks. Franchise businesses are the only ones for which growth creates significant long-term value. We have described the characteristics of these companies and explained why they alone benefit from growth. Identifying these companies is only half the task of making sound investment decisions. The other part is determining how much to pay for growth. The historical record confirms that investors as a group have substantially overpaid. Returns on portfolios of high-growth, glamour stocks trading at rich valuations have generally been lower than the returns on a market portfolio. Graham and Dodd investors purchasing growth stocks must be able reliably to distinguish those that are overpriced from those that offer genuine value. This chapter describes a value approach to growth stock investing that extends the Graham and Dodd philosophy and methodology without violating its basic principles. Growth investors face a fundamental problem. The intrinsic values of growth companies cannot ordinarily be calculated accurately enough to be useful. The standard formula for determining the value of a constantly growing cash flow stream with a constant cost of capital applies a multiple to the initial level of that stream. In an elementary example, assume the initial cash flow level is $100 million. The multiple is equal to 1 divided by the difference between the constant cost of capital, say 10% per year, and the constant growth rate, say 5% per year. The difference between 10% and 5% is 5%. 1 divided by 5% is 20. That makes our constantly growing perpetual cash flow stream worth $2 billion, 20 times $100 million. Though simple and clear, this formula is precarious. Even minimal changes in the underlying variables subject the calculation to wide swings. Suppose that instead of growing at 5% per year, our cash flow stream were to grow at only 4% per year. And instead of the cost of capital averaging 10% in the future, it turns out to be 11%. Then our multiple, 1 divided by the 7% difference between 11% and 4%, is reduced to 14, which leaves the value of our cash flow stream at $1.4 billion. Alternatively, if the cost of capital were 9% and the growth rate 6%, then the valuation multiple would be 33, 1 over 3%, and the value of our cash flow stream becomes $3.3 billion. These slight changes produce an error range of $1.9 billion, $3.3 billion minus $1.4 billion, on an average value of $2 billion, or roughly 100%. In practice, it is difficult to avoid errors of at least 1% in estimating both long-term future growth rates and the long-term cost of capital. Value estimates for growth stocks based on this approach are routinely subject to margins of error of 100% or more. Identifying a comfortable margin of safety under these circumstances is a challenging exercise. This problem does not depend on either the particular numbers we have chosen or the constant growth and cost of capital assumptions. It is a consequence of the effects of compounding. We are valuing this company as a perpetuity, and it is the great number of years that gives compounding time to work. On the growth rate side, small differences in growth trajectories lead ultimately, via compounding, to large differences in cash flows far in the distant future. On the time value of money side, small differences in the cost of capital used to generate discounted future values lead to large differences in the values of far future cash flows. The interaction of these two factors for growth stocks, whose value depends significantly on those far distant future cash flows, is what leads estimates of current values to vary so markedly with small changes in growth rates and costs of capital. To avoid this problem, we need another method for making investment decisions that does not depend on error-prone estimates of intrinsic value. Instead, we will compare the estimated returns attainable from buying a growth security at its current market price to reasonable alternative returns available to us. This approach has two advantages. First, future returns can generally be estimated more accurately than future values. Second, the connection between the underlying determinants of future returns, growth rates, discount factors, franchise erosion rates, and the returns themselves are more straightforward and transparent than their relatively complicated and nonlinear relationship to intrinsic value. A major benefit of a Grahn and Dodd approach to investing is the use of value measures that are clearly and directly related to underlying assumptions. Despite that disclaimer, intrinsic values do affect future returns as we calculate them here. Intrinsic value, after all, is the Grahn and Dodd term for the economic value of the business enterprise, in contrast to the price the market is willing to pay for that enterprise at any moment. The ratio of intrinsic value to market price affects the value creation/growth return independently of future growth rates and earnings. Even though we cannot precisely compute an intrinsic value, we can start with a simplifying assumption that intrinsic value and market value are equal. This calculable benchmark return will understate actual return if intrinsic value is greater than market value, the traditional Grahn and Dodd target. If intrinsic value is lower than market value, we have overpaid for the stock. The benchmark return will overstate the actual return. And we can tell which situation holds by comparing the benchmark return to the cost of capital. When the benchmark return exceeds the costs of capital, intrinsic value is greater than market value, and the return created by growth is greater than the growth rate. If the benchmark return is below the cost of capital, the actual return is below the benchmark return. Nevertheless, focusing on returns for growth stocks has its costs. By concentrating on returns, we surrender the ability to compare asset values with earnings power values, which practice, as we have heard, is an essential check on earnings-based valuations. But because growth stocks are by definition franchise stocks, the existence of moats protecting earnings means that asset values are only a secondary determinant of value. For companies such as Coca-Cola, calculating the asset value contributes relatively little to estimating overall intrinsic value. A second problem involves sell decisions. Buy decisions are based on current market prices. Sell decisions require selecting a price at which to sell. When growth does not significantly affect value, as is the case for non-franchise businesses, intrinsic value can be estimated with reasonable accuracy. A sell decision based on a price that approaches or exceeds intrinsic value will be well defined. For growth, meaning franchise stocks, there is no solid estimate of intrinsic value to serve as grounds for a decision to sell. We could decide to sell at a price at which the calculated future return on that stock falls below some predefined level, such as an average market return. However, estimated returns are often insensitive to changes in market prices. Thus, a wide range of market prices will yield calculated future returns that are broadly acceptable. A return-based approach, though it improves the buy decision for franchise/growth stocks, does not solve the sell decision problem. It is not surprising, therefore, that successful Grahn and Dodd-oriented growth investors uniformly regard the sell decision, when and at what price, as their greatest challenge. Estimating growth stock returns. Though it may be impossible to estimate precisely the intrinsic values of growth stocks, it is possible to calculate with reasonable accuracy the return that can be earned by buying a stock at any given market price. A productive method is to break down the calculation into component parts, each of which, in the Grahn and Dodd tradition, can be clearly related to important underlying assumptions about the future of the business under analysis. The three components we will highlight are 1. The cash return from current earnings power, 2. Organic growth in earnings, and thus value, that results from market developments external to the company, And 3. Active growth in value that arises from management's allocation of retained capital above the amount required to support organic growth. Dividing a company's earning power by the market price of its stock provides a sustainable earnings return. Multiplying that earnings return by an estimate of the fraction of earnings the company is expected to distribute in the future to shareholders through dividends and stock buybacks yields an estimated cash return. The future growth rate of that cash return can be estimated from likely future organic growth in the company's core markets and the likely future returns on the fraction of earnings reinvested. The overall growth rate in cash distributions and earnings, assuming a constant payout policy, should translate into a rate of growth in value and ultimately the market price of the stock. The estimated total return from buying the stock will then be the sum of the estimated cash return plus the estimated growth rate in value. This figure can then be compared to likely average returns from investing in a market portfolio of stocks, which should be a relevant alternative for equity investors. A sensible investment decision can then be based on whether the margin of safety in returns between an estimated growth stock return and the overall market return is sufficient to compensate for the risks of a growth stock investment, especially the risk of future franchise erosion due to changing economic conditions, which we will refer to as franchise fade. 1. Cash return on current earnings power. A simple example will illustrate the process involved. Consider a company we will call Consolidated General, CG, that dominates a particular product market. It has current sustainable revenues of $3 billion and a sustainable net profit margin of 8% on sales. These figures produce a sustainable earnings power of $240 million. It is entirely equity financed, holds no excess cash or other assets, and has a current market price of $4 billion. The earnings return from buying all of CG at the current price is 6%, $240 million divided by $4 billion. Management determines the fraction of these earnings distributed to shareholders. Likely future distributions can be estimated from an explicitly articulated policy or from historical distribution practices. In the hypothetical case of CG, we will assume management has a declared objective of distributing 60% of earnings to shareholders, a target consistent with historical practice. This policy makes the estimated future cash return $144 million per year, 60% of $240 million, which amounts to a return of 3.6%, 60% of 6% on the $4 billion invested. This 3.6% is the cash return from the current earnings power. The remaining $96 million of earnings, 2.4% of the return, will be retained and reinvested in company operations. 2. Organic growth. Growth that creates value, for CG as well as any other firm, is growth that generates returns above the cost of capital on the funds invested to support that growth. Typically, this will mean only growth within the core markets in which CG enjoys sustainable competitive advantages, that is, markets within CG's moats. What we are calling organic growth has two sources. The first is growth in the company's core markets. This includes population growth, more customers, rising household income, more demand per customer, and sometimes the continuous exercise of pricing power. The second is cost reductions from improved productivity. These will raise profit margins in those markets where barriers to entry prevent any erosion in prices from intensified competition. Since these higher margins will produce an earnings increase above the growth in revenue, they will add to the rate of organic growth in value. Future organic revenue growth in CG's core market can be estimated by looking at the historical trend of direct measures of organic growth. These will be measures of demand growth within its existing geographical footprint and product profile. They do not include the effects of expansion beyond these areas, as that is usually the result of an active investment decision. Same-store sales growth for mature stores with stable product lines is one such measure for retail firms. Revenue growth for established product lines in existing markets is a more general measure. If the historical growth rates of these measures have been stable, then we can reasonably assume they will roughly continue. If growth has been accelerating, estimated organic growth may exceed the historical rate. If growth has been slowing, then estimated future organic will be less than the historical rate. In any case, it is the long-term rates that we will focus on, not recent changes to them. For CG, we will assume that historical measures of organic growth have been stable for many years at roughly 3% per year. An alternative approach is to estimate future organic growth in revenue based on the likely impacts of underlying trends in population, income, and customer behavior. The natural place to start is with overall growth in economic activity as measured by GDP. This macroeconomic growth rate should then be adjusted to account for the specific geographic, demographic, and product markets in which a company operates. For example, the Southeast and Southwest regions of the United States have been growing more rapidly than the Northeast and the Midwest, a trend that is likely to continue. In both the United States and globally, the incomes of affluent households have for many years been increasing 2 to 3% more rapidly than average incomes. Incomes of less well-off households have been growing around 2% less than the overall economies. In most developed economies, spending on services such as housing, medical care, education, travel, and entertainment has been increasing faster than spending on goods. For example, in 1970, an average U.S. household spent 23% of its income on food, 18% went for groceries, and 5% on restaurant meals. In 2010, spending on restaurant meals remained at 5%, but only 9% went for groceries, half the figure for 1970. A third alternative is to look at historical growth rates in demand for markets or products that are similar to those of our target company. For example, if we are attempting to forecast organic growth for a budget airline with a dominant market share on European routes, we can look at historical growth rates for similar operations in the U.S. or Asia, adjusted for differences in regional GDP growth. We will assume that CG sells an average mix of services and goods to an average mix of all households. In this case, organic growth should correspond roughly to expected future GDP growth of about 3% in nominal terms. We will also assume that this 3% figure tracks well with CG's history of a stable 3% constant footprint revenue growth. In this case, both the firm's own history and projections driven by economic trends lead to an estimate annual future organic growth in CG's revenue of 3%. Because sustainable barriers to entry are ultimately rooted in economies of scale, organic revenue growth within core markets should lead to increased operating leverage and thus larger profit margins. Improved technology should also enhance margins. Organic growth in earnings, then, should exceed organic growth in revenues. This effect is usually small, but should be detectable by examining historical margin growth within CG's core market. We will assume that core market earnings growth for CG has on average been about 0.5% above historical revenue growth. Adding this margin benefit to the projected revenue growth of 3% produces an estimate of annual organic growth in earnings, and thus in value, of about 3.5%. This organic growth in value is the second component above the cash returns of 3.6% from current earnings, and the overall return to buying CG's equity at $4 billion. Organic growth does require some investment, usually in net working capital. An organic growth rate of 3% in CG's revenue of $3 billion produces additional sales of $90 million in year one. We will assume that each additional dollar of revenue requires an extra 15 cents in accounts receivable and inventory, and no significant fixed investment. This figure is partially offset by 10 cents in higher accounts payable and accrued liabilities. That leaves required net investment at 5 cents for each extra dollar of sales. For an increase in sales of $90 million, required net investment is $4.5 million. This money has to come out of the $96 million in earnings that CG retains on an average sustainable basis at current levels. The remaining $91.5 million is available for active investments that should increase total earnings growth above the 3.5% organic growth rate. 3. Active investment growth. This additional increase in growth and in value will depend on how effectively CG's management deploys the $91.5 million available for active investments. If it is wasted in attempts to penetrate highly profitable markets dominated by others and protected by wide moats, attempts that have a low probability of succeeding, then management will earn far less than the cost of capital if it earns anything at all. If the company earns 5% on these investments when its cost of capital is 10%, then each dollar reinvested generates only 50 cents worth of value. In these circumstances, the $91.5 million reinvestment rate will add only $45.75 million per year to a firm's intrinsic value. On the other hand, management could use the reinvested $91.5 million on major improvements in efficiency in its franchise markets, or to add facilities and/or extend its product line in ways that benefit from existing economies of scale in advertising, R&D, distribution, and management. In this alternative scenario, returns on the new investment may substantially exceed the company's cost of capital, since they are protected from competitive erosion by its current moat. If the company earns 20% on incremental investment when its cost of capital is 10%, then each dollar reinvested is worth $2, and the active reinvestment-driven growth in value is $183 million, $91.5 million times 2. For convenience, we will refer to the value created per dollar of active reinvestment as the value creation factor associated with management's capital allocation initiatives. A value creation factor of less than 1, e.g., 0.5 in our initial example, indicates that management is destroying value. A factor above 1 means management is creating value. The value created by active reinvestment is simply this value creation factor multiplied by the amount of active reinvestment. This dollar figure can be converted into a reinvestment return by dividing the value created by the $4 billion market price paid for access to that value. With poor capital allocation and a value creation factor in this example of 0.5, the $45.75 million in value creation represents an active investment return of only 1.14%. $45.75 divided by $4,000. With good capital allocation, the $183 million in added value raises this return to 4.58%, $183 divided by $4,000. The quality of capital allocation can have a major impact on the future returns likely to be realized from investing in growth stocks. Company managements that devote funds, time, and attention relentlessly to improving operational efficiency, which is generally the greatest source of investment-driven value creation, will add much more to returns than growth initiatives that are far outside core markets and do not benefit from existing competitive advantages. Calculating the value creation factor by a thorough assessment of capital allocation strategies is a critical and difficult element in successful growth stock investing. The analysis entails a degree of complexity well beyond that associated with estimation of current cash flow returns and organic growth rates. We will discuss it in more detail in a separate section later in the chapter. For the moment, we will assume that CG Management's allocation of the $91.5 million of active investment funds is good but not great, that every dollar of active investment generates $1.60 of value. The active investment then produces $146.4 million of value, a value creation factor of 1.6 times $91.5 million, which is a 3.66% return on the $4 billion paid for CG. As with any investment, this rate of return depends on the amount paid for CG. The less paid, the higher the return. We can now calculate our total return for CG. The cash return is 3.6%. Organic growth in earnings adds 3.5%. Active investment of retained earnings contributes another 3.66% or 3.7% to avoid specious precision. the total annual return to an investment in CG is 10.8%, or between 10.5 and 11%. These calculations are summarized in Table 8.1. Growth rates and growth returns. The total CG return of 10.8% consists of a cash return of 3.6% and a growth return of 7.2%. The growth return is the sum of organic growth of 3.5% and the results of active reinvestment of 3.7%. In this and similar examples, we have implicitly assumed that the returns generated by growth are equal to the related growth rates, that a 3.5% organic growth rate produces a 3.5% organic growth return. But this assumption is not generally accurate, and understanding why is critical to understanding a return-based approach to evaluating franchises businesses. To highlight the difference between growth rates and growth returns, we will consider first the effect of organic growth. For the constant growth rate with constant cost of capital world that we have assumed, a 3.5% organic growth rate in Consolidated General's earnings leads to 3.5% increase in intrinsic value, which for this franchise business is based on earnings power value. Thus, if CG has an intrinsic value of $3 billion, a 3.5% increase in earnings adds $105 million, 3.5% times $3 billion, to shareholder value. But the resulting percentage return to shareholders depends on the price paid for CG's business. If CG trades in the stock market at a price of $4 billion, then 3.5% organic growth produces a shareholder return of just 2.63%, $105 million divided by $4 billion. If CG's market price were $2 billion, then 3.5% organic growth in earnings would yield a 5.25% organic growth return, $105 million divided by $2 billion. Only when CG's intrinsic value and market price are equal will a 3.5% organic growth rate in earnings equal 3.5% organic growth return, $105 million divided by $3 billion. A simple but important formula is at work here. For any business, let us designate the rate of organic growth in earnings by G, the percentage organic growth return by R, the intrinsic value by V, and the market price by M. The dollar addition to shareholder value will be GV, G times V. This represents a return percentage of GV divided by M. Thus, R equals organic growth return equals GV divided by M equals G, open parenthesis, V divided by M, close parenthesis. In words, the organic growth return is equal to the growth rate in earnings multiplied by the ratio of intrinsic value to market price. If CG stock is a bargain, available in the market for less than the intrinsic value, then the percentage return from organic growth will exceed the organic growth rate in earnings. If CG stock is overpriced, selling for more than the intrinsic value, then the percentage return to organic growth will be below the rate of organic growth. When intrinsic value and market price are equal, then the default assumption that the return from growth equals the growth rate will apply. These relationships are depicted in the diagram below. In Case 1, undervaluation of the stocks amplifies the effect of the organic growth rate on returns. In Case 2, accurate valuation leaves the effect of organic growth on returns unchanged. In Case 3, overvaluation attenuates the impact on returns of the organic growth rate. Conventional return calculations, such as those of a dividend discount model, automatically but rarely explicitly, assume that market and intrinsic values are always equal, so that growth rates and growth-related returns are always equivalent. In reality, and especially in Graham and Dodd reality, the divergence of market price from intrinsic value is at the heart of the investment process. As a consequence, we must consider explicitly the impact of the ratio of intrinsic to market values on future returns. Our difficulty is that we are concentrating on returns precisely because, for growth stocks, we cannot reliably measure intrinsic values. As a result, We cannot calculate the ratio of intrinsic to market value to use as an adjustment in translating growth rates into growth-related returns. Therefore, we will for the moment base our return calculations on the simplifying assumption that intrinsic and market value are equal and that the ratio of V to M is 1. Later we will address in detail the effects of relaxing this assumption. An additional consequence of equation 1 applies to our calculation of active investment returns. We calculated this part of the growth return directly, dividing the value created from active investment, amount invested times the value creation factor, by the market price of CG. The growth rate and earnings corresponding to this return must be calculated from equation 1, since the growth return R is the growth rate, G, times the ratio of intrinsic value to market price. Conversely, the growth rate, G, is the growth return, R, divided by the ratio of intrinsic value to market price. If CG stock is undervalued, then the earnings growth rate corresponding to our 3.7% active investment return will be less than 3.7%. The ratio V divided by M is greater than 1. If CG stock is overvalued, then the growth rate and earnings from active investment will be greater than 3.7%. Again, the growth return of 3.7% and the growth rate of earnings will only be equal when CG's market price and intrinsic value are equal. Since we cannot measure intrinsic value accurately, we will for the moment assume this equality holds. Under this assumption, our active investment return of 3.7% should correspond to a 3.7% active investment-related growth in earnings, or a 7.2% earnings growth overall. This figure can be compared to average historical earnings growth rates for CG as an important check on our assumptions about organic growth and active investment returns. But we must remember that this simple comparison only properly applies when a company's market price and intrinsic value are equal. For the moment, let us assume that growth rates and earnings for CG have averaged around 7% over the last 10 to 20 years. With that caveat cited before, this would indicate that our estimated growth returns are broadly consistent with past history. A final check on the validity of our growth estimate of 7.2% is that it is not so high as to have unreasonable implications concerning the future role of CG in the overall economy. If we were to project a long-term growth rate above 15% for the firm compared to nominal GDP growth of 3 to 4%, then CG would eventually become a conspicuous part of the overall economy, which is not a realistic prospect for most companies. In addition to the cash return of 3.6%, the 7.2% projected growth in value yields an overall return of 10.8%, or more realistically, 10 to 11% on our $4 billion investment. 4. Comparison returns. A return of 10 to 11% speaks directly to the attractiveness of a CG investment. As we write, interest rates run from below zero on much short-term government debt to between 2% and 3% on long-term government bonds to 4% on relatively safe long-term corporate debt. By these standards, 10 to 11% looks to be a highly desirable return. But CG's return should be judged against returns on comparably risky assets and equity markets, whose risks more closely resemble those of a CG investment, appear likely to return 6.7%. This alternative implies a significantly smaller return advantage for CG. It is clearly important in making investment decisions to calculate appropriate alternative returns as accurately as possible. This step is a virtual requirement for Graham and Dodd investors, for whom a margin of safety between value and price is at the heart of the investing process. For investments with measurable intrinsic values, the margin of safety is the difference between value received and price paid. The price paid represents the value of foregone alternative opportunities. For a decision based on returns, the calculated future return captures the value received, while the appropriate alternative return represents the opportunities foregone. Both parts of this comparison must be estimated as accurately as possible, so that the difference between them can provide a sound basis for making investment decisions. The nature of a franchise business makes it particularly important to have as precise as possible a measure of the margin of safety in returns. No franchise lasts forever. When it is impaired, the damage to its values is far worse than for competitive businesses. In declining competitive markets, capital recoveries should largely offset lost profits. For franchise businesses, decline brings substantial value destruction. A margin of safety based on return estimates must be large enough to anticipate the inevitable but not predictable possibility of franchise impairment, what we have called fade. There are two ways to estimate a benchmark return against which the 10 to 11% expected return from CG can be compared. Although a 10 to 11% return from an unlevered franchise business will be attractive under most circumstances. The first is to estimate a cost of capital for CG, as we discussed in Chapter 5, earnings power value. Since we are assuming that CG is all equity financed, its cost of capital will be its cost of equity. We will assume that at the time of purchase, the range of possible equity returns runs from a venture capital return of 12%, high-risk equity, to a return on a contemporary B-rated bond of 5% plus 1%, or 6% total, low-risk equity with near-bond returns. The midpoint of this range, which is a rough estimate of average equity risk, is 9%. We will also assume that given its lack of leverage and stable franchise position, CG's risk falls just within the lower half of this range, or roughly 7.5%, midway between 9 and 6%. This figure is safely below our estimated 10 to 11% return from purchasing CG at a market price of $4 billion. A second alternative return can be calculated by looking at current potential returns from the stock market as a whole. Suppose that the average cash return on stocks is 2.5% per year. We find this figure by taking all the dividends and net share buybacks during the past year from a broad market basket of stocks, such as the S&P 500, and dividing by the cost of buying that market basket today. Average future growth in value for this basket will be driven by the average future growth in earnings. Earnings growth, in turn, will be based on growth in aggregate U.S. or global output and incomes, and by any trend in the share of profits as a fraction of overall income. Assume nominal GDP growth is expected to be about 3.5% per year, a level roughly equal to actual average growth in the early 21st century. This figure is the combination of around 1.5% annual inflation, 1% annual growth in the labor force, and about 1% annual growth in productivity. Between the late 1980s and the early 21st century, profits as a share of overall national income in the U.S. increased from around 18.5 to 13.5%, an annual rate of 1.5 to 2%. Combining this increased share of GDP with estimated GDP growth indicates corporate profit growth of 5.0 to 5.5%. Adding this rate to the cash return of 2.5% produces an overall future U.S. equity market return of 7.5 to 8%. Since CG is a stock with a below-average level of risk, it should have a cost of capital of about 7%, which is close to our direct cost of capital estimate of 7.5%. An alternative approach to estimating the benchmark equity return is to base it on an aggregate market earnings return. Suppose that the S&P 500 index trades at 17 times earnings for the stocks in the index. This price-to-earnings multiple inverts into an earnings return of roughly 6%. On average, reinvested earnings should earn something very close to the cost of capital of the firms making these investments. There will be some net value creation from the active investments of franchise firms, protected by barriers to entry from the leveling effect of competition. These should be offset in part by poor capital allocation that occurs because these same firms' managements are protected from the full force of competition. The same equalizing process occurs in non-franchise firms, Good management makes good investments. Poor management makes poor investments. At the same time, the organic real growth of some franchise businesses will be offset by the fading franchises of others. The only organic growth we need worry about is that relative to low levels of inflation. High levels of inflation are associated with economic disruptions that have historically had significant negative impacts on corporate profit performance. The early 21st century environment has been one of a relatively benign inflation rate of 1.5%. Adding this growth in nominal earnings to the 6% earnings returns produces a likely future market return of 7.5%. This figure closely aligns with our other estimate of 7 to 8%. Because we are assuming that CG is a low-risk stock, the rate of return against which it should be compared is slightly lower than the market return, around 7%. That is the figure we will use for computing a return-based margin of safety. Our expected return of 10 to 11% on the $4 billion investment in CG leaves a margin of safety of between 3 and 4%. These calculations are summarized in Table 8.2. Franchise fade. This 3 to 4% margin of safety must, as always for a Graham and Dodd investor, provide protection against miscalculations and unexpected future developments. There is an additional concern when deciding to purchase a franchise business. No franchise is eternal. Some, such as Coca-Cola, which has been around for well over a century, may last for a very long time, but others like Xerox, local newspapers, or the Daily Racing Sheet, a favorite early example of Warren Buffett's, had established positions but were subject to significant erosion over relatively short periods of time. Our margin of safety and returns for franchise businesses must also provide protection against such possibilities. We have referred to these possibilities as franchise fade, and we have included this fade in our margin of safety discussion because fade rates are difficult to calculate precisely and are better considered as qualitative factors affecting the desired margin of safety rather than quantitative factors that are included in the calculated rate of return. Clearly, a company such as Coca-Cola, with a durable franchise, requires a smaller margin of safety than even an established technology company such as Intel, or one in a rapidly changing industry such as Tesla, if indeed it is a franchise business at all. Nevertheless, it will be useful to consider how important fade rates are in quantitative terms. The simplest, although perhaps not the most realistic way to think of franchise fade is to assume that the business and its values dies at an exponential rate of, say, 2% per year. For this case, fade is a subtraction from growth. Net growth would then be the sum of organic growth plus active investment growth minus fade, taking care to distinguish between the growth rate of a business and the return from the growth obtainable by purchasing the business at its current market value. For this simple case, we can compare the margin of safety for CG directly to its fade rate, with the difference between the two being a net margin of safety. Also for this case, when we look at overall historical growth rates in a business, the fade rate will already be incorporated as part of the total. A more realistic way to look at franchise fade is in terms of survival probabilities for the franchise. Franchises such as Xerox and newspapers are generally undermined by social or technological developments that arrive within discrete, relatively short periods of time. Assume that the likely arrival rate for such fatal developments is roughly constant at a rate of 2% in any given year. In this case, the probability that the firm is alive at the end of this year is 98%. At the end of 2 years, the survival probability is 98% times 98%. If the value of CG's business, provided it survives, grows by 7% per year, then, incorporating the fade rate, the expected value of the business at the end of the year is 98% times 107% of the value at the start of the year, or approximately 105% of its original value. This more realistic fade process affects the growth of CG's value, its expected value, in exactly the same way as the less realistic exponential decay we discussed before. In general, these episodic fade rates can be treated as subtractions from basic growth rate estimates, just as we did for constant erosion. There is an important empirical implication of this more realistic view of fade. The historical growth rate of the business is in this case a pre-fade rate of growth, since the death event has usually not yet materialized. The historical growth must be adjusted by the fade rate to provide an estimate that will incorporate fade possibilities going forward. It is difficult to estimate precisely this episodic fade rate for a franchise business. One way to start is by thinking of the half-life of the business, the number of years in the future at which its survival probability declines to 50%. For a durable franchise such as Coca-Cola, this might be 80 years or more. For a more recent tech-dependent franchise such as Apple or Intel, it might be as brief as 15 or 20 years. The half-life can be translated into annual fade probabilities using the rule of 72. An 80-year half-life corresponds to an annual fade rate of roughly 0.9%, 72 divided by 80, which will usually be immaterial, i.e., equivalent to an annual downward adjustment of 1% in the organic growth rate of value. But an 18-year half-life corresponds to a 4% fade rate, 72 divided by 18, which is far more serious. In general, half-lives of 25 years or less, meaning at least 3% a year, need to be taken seriously. These annual fade rates, or extinction rates, are negative annual returns and must be covered by the margin of safety calculated without fade. It should be clear that they are substantial and must be taken into account in making franchise investment decisions. If we believe CG operates in a highly stable economic environment with a franchise half-life of 50 years, then the fade rate is 1.5%, which is covered by our 3 to 4% margin of safety. On the other hand, if it is likely half-life is only 20 years, then the fade rate is 3.6%, which eliminates the entire margin of safety. From a Graham and Dodd perspective, a particularly attractive feature of this approach is that the fade rate, calculated from its half-life, is linearly and clearly related to the margin of safety required of the returns. Episodic fade rates should be subtracted from the estimated return to calculate the overall expected return because it is not part of the historical growth experience. This overall calculation is important since our benchmark return, including fade, is conservative only if it is greater than the cost of capital. Successful growth investing is by definition investing in franchise businesses. Ignoring the fade rate overstates the margin of safety and increases the risk that the decisions will be based on over-optimistic return forecasts, which is the main vulnerability of all growth stock investments. The return formula. The calculations that we have just worked through for the case of Consolidated General are based on the familiar dividend discount model for estimating stock returns. In that model, the overall return per share for an equity investor consists of a dividend and a rate of capital appreciation. Formally, R equals return per share equals open parenthesis D divided by P, close parenthesis, plus G, where D is the current dividend per share, P is the market price of a share of stock, and G is the anticipated growth rate in the share price. In practice, this estimate of the return assumes that the anticipated growth rate in the stock prices is driven by the future growth rate in dividends, which is itself driven by the growth rate in earnings and ultimately the growth rate of the revenue and profitability of the enterprise. The CG calculations differ from those of the traditional dividend discount model in several ways. First, for CG, we looked at the return to owning the company as a whole rather than the return to a single share. In the case of an all-equity financed CG, this distinction is inconsequential. If there are no share repurchases, total dividends divided by market value is identical to dividend per share divided by price per share. Also, if the number of shares is constant, then the percentage growth rate in total dividends will be exactly the same as the growth rate in dividends per share. In this case, the company-level calculation and the traditional per share calculation are exactly equivalent. The complicating factor here is net share buybacks, A repurchase of 2% of the shares outstanding will, other things being equal, increase dividends per share by 2%, since the number of shares has declined by 2%. From a company-level perspective, repurchase of 2% of the shares outstanding at the current market price will add 2% of the market value, price times 2% of the number of shares outstanding, to the total cash return. From both perspectives, the individual share and the company's total equity, the cash return will increase by 2%. The change in total return in both cases will be this 2% less the impact of the loss of the distributed cash on future growth, which is also the same in both cases. We prefer the company-level analysis because it is better adapted to analyzing returns to owning a proportionate share of a core enterprise than the single-share approach. For a franchise business, an enterprise valuation approach, as opposed to an equity-only approach, is particularly important. The essential value of a franchise business, especially the value created by growth, is produced by its core operations that are protected from competition by barriers to entry. Adding a growth component to the returns from non-core assets, such as net cash, securities, real estate, and business segments that operate in competitive markets, is a mistake. We should evaluate a franchise business by calculating the return it produces on the net cost of the core business itself, the cost of the company, equity plus debt, minus the value of non-franchise assets. In this framework, distributions to investors includes dividends, net stock buybacks, net interest payments, and net debt repurchases, which must be made out of the net operating after-tax profits of the core business. None of these calculations are easy to adapt to the traditional dividend discount model. The impact of assuming market and intrinsic values are equal. As we noted before, when we calculated growth rates from the underlying characteristics of a business, the value impact of these growth rates applies to the intrinsic value of the business, not its market price. The true total return formula is R is the same as return equals D divided by M plus G, open parenthesis, V divided by M, close parenthesis, where D represents the total cash return, G is the growth rate in earnings, V is the firm's intrinsic value, and M is the price at which it trades in the market. This same formula applies equally to the dividend discount model, which should properly be R equals D divided by P plus G, open parenthesis, V divided by P, close parenthesis, where D is dividend per share, G is the growth rate in earnings, V is the intrinsic value per share, and P is the market price per share. The V divided by P term, which has been ignored in the standard version of the dividend discount model, corrects for one of the obvious problems of that model. Without it, the growth part of the return is the same regardless of the price paid for the firm's stock. Even an infinitely high price would not reduce the growth return, and hence the overall return, to zero. But unless we can measure a firm's intrinsic value, which we have acknowledged we cannot, the return formula of equation 3 is unusable. That is why, in calculating returns, we start with the assumption that price and value are equal. But we do not stop there. We will refer to the return calculated on this basis as the benchmark return, and for ease of reference, designate it as R sub B. By definition, R sub B equals D divided by M plus G. Consider next the effect of basing an investment decision on the benchmark return, which can be calculated just as we did in the case of CG. For a growing franchise business, one in which G is greater than zero, the difference between the actual return R and the benchmark return R sub B is R minus R sub B equals D divided by M plus G, open parenthesis, V divided by M, close parenthesis, minus, open parenthesis, D divided by M plus G, close parenthesis, equals G, open parenthesis, V divided by m minus 1, close parenthesis. The first equality in equation 6 simply substitutes the definitions of R and R sub b, equations 3 and 5, into the expression R minus R sub b. The second equality follows from canceling out the d divided by m terms. If the growth g is positive and v divided by m is greater than 1, then g, open parenthesis, v divided by m minus 1, will be positive. This means that the actual albeit unobservable return, R, will be greater than the benchmark return, R sub b. For growing franchise businesses, the actual return will exceed the benchmark return if we purchase the company at a market value, M, below its intrinsic value, V. In the appendix to this chapter, we show that whenever a benchmark return exceeds a business's cost of capital, the intrinsic value of the business is greater than its current market price. This means that the actual return exceeds the benchmark return, and using the benchmark return minus the cost of capital as the margin of safety understates the true margin of safety. If the benchmark return and cost of capital are equal, then the market and intrinsic values are equal, which means in turn that the actual returns and the benchmark returns are equal. If the benchmark return is below the cost of capital, then a business's market value will exceed intrinsic value, and the actual return will be below the benchmark return. As a consequence, if we purchase a company where there is a margin of safety between the benchmark return and the cost of capital, the margin of safety between the actual return and the cost of capital will be still larger. Using a benchmark return and insisting on a benchmark margin of safety is therefore a conservative investment strategy. In taking advantage of this relationship, any franchise fade rate should be included as part of the overall growth rate, G. The actual future growth rate of expected earnings, including the impact of future franchise erosion, must be used to calculate the benchmark return. If we choose to exclude the fade rate in our benchmark growth calculation, then the necessary standard for conservatively judging an investment is that this pre-fade return should exceed our cost of capital by more than our estimated fade rate. This is the criterion we used in evaluating the CG investment. Properly applied, our approach to evaluating growth stocks on the basis of the benchmark return remains a conservative one. Active reinvestment returns revisited. As we pointed out earlier, calculating returns to active reinvestment of retained earnings involves both practical and theoretical complexities that require separate, more detailed discussion. Estimate of the current cash return is straightforward. For the benchmark return, calculating the organic growth return, which in the benchmark case equals the organic growth rate in earnings, is also relatively uncomplicated. We describe the process in the consolidated general example. For the active reinvestment component of returns, the value created is the amount invested times the value creation factor associated with each dollar reinvested. The associated return contribution is the value created divided by the price paid for the company in question. The math is uncomplicated. The difficulty lies first in defining and identifying the amount that a company actively reinvests, and then in defining and identifying the value creation factor associated with that investment. We will deal with each of these issues separately. The complication in calculating the amount reinvested arises because some active investment does not get identified as such in standard financial accounts. Expenditures on research and development, new customer acquisition, and improved operational efficiency typically do not get treated as investments for accounting purposes. To the extent that this spending is to sustain the quality of a firm's product portfolio, customer base, and operating structure, leaving them at the end of the year just as capable as they were at the start of the year, no net investment is involved. The new investment merely offsets the depreciation of unaccounted for intangible assets as products become obsolete, customers leave, and operating discipline deteriorates. However, in cases where these hidden investments generate net business improvements, they are in effect net investments in intangible assets. If the spending were capitalized rather than expensed, operating margins and net income would be higher. In that framework, this spending represents active reinvestment. Fortunately, where the level of hidden net investment relative to the size of a business is stable, we need not account for its effect explicitly. The associated returns will show up as steady earnings growth above the growth attributable to organic market factors and explicitly identified active investments. The earnings growth at issue will often be included as part of organic growth in earnings. If we believe we can identify significant levels of hidden net investment in a business, we should be able to account for it as part of a historically elevated R&D or other operating expenses which accompany higher than average growth rates. Assuming net hidden investments continue at past levels, we can simply incorporate the higher historical growth rate in our estimate of future growth in value. If the historical growth does not exceed our conventionally calculated organic plus active reinvestment growth rate, then any hidden investment appears unlikely to be making a significant value contribution, in which case its impact can be safely ignored. The value creation factor. Estimate of a valuation creation factor is a complex task representing both practical and theoretical issues. It will be useful, therefore, to keep certain broadly applicable principles in mind. First, value creation factors, the ratio of the return to the cost of capital, greater than 1, apply only to investments protected by sustainable existing competitive advantages, or moats. New business initiatives, whether by acquisition or direct investment, that do not occur within a franchise will at most have value creation factors of 1. Historically, more often than not, they have been significantly less than 1, representing major value destruction. Financial investments in competitive markets will also have value creation factors of 1, or if they are subject to double taxation, less than 1. Only well-focused investments in operational efficiencies, and those that extend existing competitive advantages geographically or in product space, will have value creation factors above 1. Second, precise value creation factor estimates will not be necessary for companies that distribute more than 3/4 of their earnings. Suppose a franchise trades at an earnings return, sustainable earnings divided by market price, of 6.5%, which is a sustainable multiple of 15, a potentially attractive rate for a growing franchise business. If it distributes 75% of its earnings, retained earnings will equal roughly 1.6% of the price of the firm, 6.5% times 25%. Some small amount will be required to support organic growth. At most, 1.5% of the market price will be actively reinvested. Average capital allocation, a value creation factor of 1, will add 1.5% to the overall benchmark return. Poor capital allocation, say with a value creation factor of 0.5, will add 0.75% to the benchmark return. Good capital allocation, a value creation factor of 1.5, would add 2.25%. Variations of 0.25 in the value creation factor around these levels will affect the active investment return by less than 0.4%, an amount that should not be critical to a sound investment decision. For companies that distribute 3/4 or more of their earnings, broad judgments of the quality of capital allocation should be adequate. Third, if a company retains 1/3 or more of earnings, and the growth in operating earnings can be accounted for largely by organic growth, i.e., the overall historical earnings growth rate is 1% or less above that implied by organic growth alone, then the value creation factor has historically been close to 0. Without clear evidence of improvement in capital allocation practices, a value creation factor of 0 or close should be used. Finally, retained earnings are often held in cash or used to retire debt that presents no major threat of impairing business operations. The returns to these actions depend on what is ultimately done with the cash or the debt capacity. In the best case, the available funds will be distributed to shareholders. In the worst case, they will be expended on value-destroying investments, for which a value creation factor of less than 1/2 is appropriate. But even in the best case, the tax consequences of holding cash, the interest is taxed, or paying down debt, reducing the tax shield of paying interest, means that the value creation factor is less than 1. In practice, these kinds of investments warrant a value creation factor of around 0.8, sparing the reader the detailed calculations underlying this figure. We have to know how management allocates active investment among initiatives that 1. Improve efficiency, 2. Extend either the geographic footprint with new stores or production facilities or product lines, or 3. Acquire new business or invest in other new revenue acquisition projects, such as expensive marketing campaigns. For each of these distinct types of investments, we need to estimate a range of returns relative to the associated cost of capital. In some cases, these returns can be gleaned from broad industry data. For example, efficiency-improving investments have historically had payback periods of between 6 months and 2 years, a pre-tax annual rate of return from 50 to 200%. A value creation factor of 5 or more is not excessive for these investments, which usually constitute only a small fraction of overall capital budgets. In some instances, industry experts have produced detailed return calculations that are publicly available. There is an extensive literature on the returns to Walmart from new superstore openings and the conversion of existing stores to the superstore format. The returns to acquisitions can often be estimated from post-acquisition financial reports. A weighted average of these individual category returns will then yield an overall value creation factor for the company under consideration. A theoretical problem with estimating value creation factors arises because the ultimate value of any active investment depends on what happens to the returns generated by that investment. The default assumption is that they are fully distributed to shareholders. In that case, each dollar of return is worth exactly $1, and we need not worry further about what happens to active reinvestment returns. But if all or part of the initial returns is actively reinvested in other projects, the value per dollar of the initial return depends on the value creation factors associated with these secondary investments. But the value of these secondary investments depends in turn on what is done with their returns, and so on, in a theoretically infinite sequence. We cannot calculate a value creation factor unless we can calculate the returns of the proceeds of an active investment that depend on an as yet unknown value creation factor for those proceeds. One exit from this difficulty is to simply make the default assumption that net active investment proceeds are fully distributed to investors. But it would still be useful to know how this assumption is likely to affect our calculated value creation factors when a substantial part of the active reinvestment returns are themselves reinvested. We address this problem in the appendix to this chapter. Here, we will simply state the results of that investigation for 2 polar cases. In the first case, secondary reinvestments neither create nor destroy value. The assumption is that all of the value-creating investment opportunities are fully funded from the primary retained earnings, essentially that the level of retained earnings is set to meet this objective. This situation is equivalent to the default assumption that active investments returns are fully distributed to investors, since in both cases the value creation factor is 1. With a value creation factor of 1, it makes no difference whether earnings are distributed or fully reinvested. Thus, the incremental return per dollar of active reinvestment, the value creation factor, is equal to incremental earnings plus the organic growth rate in the incremental earnings. In the second polar case, the value creation factors on the original active reinvestment and on the reinvestment of the proceeds of the original investment are equal. This assumes that the original active reinvestment level does not exhaust or even diminish value-creating opportunities. In other words, the returns from the first round of capital allocation are compounded by the second round and subsequent rounds with an equivalent value creation factor. If the initial capital allocation creates value, a value creation factor greater than 1, under the assumption of case 1 before, then the actual value creation factor is even greater than the case 1 value creation factor. Thus, use of the value creation factor of case 1 is conservative. By contrast, if the initial capital allocation under the assumptions of case 1 destroys value, then in a case 2 reality, things are even worse. Management with consistently bad capital allocation of both initial and secondary returns should generally be avoided unless current cash returns are likely to be sustainable and by themselves exceed a business cost of capital. Recap. We begin this chapter by identifying the need for an approach to investing in franchise/growth businesses that did not rely on estimates of current intrinsic value. The values of such businesses are extremely sensitive to variations in growth rates and costs of capital. As a result, they cannot be estimated with the degree of precision required to provide a sound basis for investment decisions. An alternative approach is to calculate an expected future return from buying the business at its current market price and to compare that return to an appropriate cost of capital. The process developed in this chapter for implementing this approach should mitigate the problem of extreme sensitivity to growth rates and costs of capital, leading to better franchise/growth investing, especially for value investors who have shied away from investing in growth stocks. The return approach has several other advantages. First and most important is the direct, linear relationship among the critical factors that determine the margin of safety in returns. The estimated return is the simple sum of a growth rate and a current cash return. A 1% increase in the forecast growth in earnings raises the expected return by 1%. This relationship holds for all current levels of earnings, all costs of capital, and all fade rates. A 1% increase in organic growth increases the overall growth rate by 1%, regardless of the level of active investment. A 1% change in the cost of capital changes the margin of safety by 1%. Analysis of the sensitivity of investment decisions to changes in these underlying factors is simple and straightforward. This simplicity is in marked contrast to the complicated, interdependent relationships between these factors and any measure of intrinsic value. For intrinsic value, the impact of a 1% change in growth rates depends on the level of the cost of capital, the level of cash returns, and, if it is even recognized, the franchise fade rate. Changes in earnings power estimates do have more complicated implications, but even in this case, the sensitivity analysis is far more direct than for intrinsic value. A 1% change in earnings power leads, other things being equal, to a 1% change in cash distributions. If the cash distribution return is 3%, the 1% change adds 3 basis points to the expected return. Added complexity arises because retained earnings and active reinvestment also increase. But if we have a well-formed idea of the value creation associated with active reinvestment, then we merely multiply the increase in retained earnings by the value creation factor and divide by the market price of the company to arrive at the change in return. A second benefit of the return approach is that it isolates the individual factors that determine the attractiveness of a franchise company investment so that research efforts can be focused efficiently on those that are most important. Current earnings power, distribution and reinvestment policy, organic growth, active investment effectiveness, franchise fade, and the appropriate cost of capital can each be investigated independently. Many of these factors are often overlooked in a conventional intrinsic value analysis. The distinction between organic growth and the results of the capital allocation decisions that constitute active reinvestment often goes unrecognized. The effect of distribution policy on organic growth is minimal, but the effect on the amount available for reinvestment is significant. The difference between current franchise strength, which affects margins and earnings power, and franchise stability, which may be imperiled by the fade rate, is also often ignored. Using a return framework, These differences are clearly recognized, and the impacts of the individual factors are relatively easy to trace. The return approach highlights the particular importance of franchise fade, which is rarely analyzed effectively, if at all, by conventional intrinsic value methods. Finally, a return approach by its nature focuses on the very long-run future. When we use a constant growth assumption, the growth rates should be an average for the whole of the future that plays a significant role in determining today's value. That may be 40 years or more. Fade rate assumptions do the same thing. A 40-year half-life corresponds to an annual fade rate of 1.8%. A very long-run focus is essential for investing in franchise businesses and taking advantage of the lower taxes and transactions costs that come with long holding periods. Decisions based on intrinsic value calculations, especially DCF-based decisions, typically consider only events occurring within a 7 to 10-year horizon. At that point, a terminal multiple is applied to the contemporary earnings. This multiple is usually chosen to be conservative, but without considering fade rates and long-run declines in earnings growth, it is not clear what a truly conservative multiple looks like. Take railroads as an example. For the last 2 decades, railroad earnings have done extremely well, thanks to the combination of deregulation, operating efficiencies, and rising fuel costs that have enhanced the competitive position of trains over trucks. Taken together, these events have led to steadily higher earnings margins. But looking forward, there are long-term trends that are far less favorable. The economic transition of consumption from goods manufactured in concentrated industrial sites to services delivered locally will lower the demand for railroad services. Developments such as 3D printing will decentralize manufacturing and adversely affect transportation as a whole. Smart trucks that can travel in convoys without drivers will capture many of the current benefits of railroads while taking advantage of the shared rights of way that are the highway system and the ability to target more precisely the final local destination. None of these developments are likely to have a major impact in the next 7 to 10 years, but in the longer term, they will be important. A constant growth return model will take these factors into account. An intrinsic value model limited to the next 7 or 10 years will not. The return-based valuation also has limitations. First, given a market price, returns can be calculated going forward, and informed buy decisions can be made. Sell decisions must be made at prices chosen by other investors. Typically, in the Graham and Dodd tradition, this would be done by comparing intrinsic value to market price. But for franchise-based growth businesses, we do not have a usable estimate of intrinsic value. We could choose a level of calculated return, knowing that the expected return declines as the market price of the stock rises. Unfortunately, this approach provides a very inexact discipline. Our calculated benchmark returns, as in the CG case, are usually very insensitive to changes in market prices. If most of the return arises from growth, and predominantly organic growth, then doubling the market price might reduce the calculated benchmark returns by as little as 10%. The return approach improves buy decisions for franchise businesses. The sell decision for those stocks remains a thorny and intractable problem, given the fundamental difficulty of calculating intrinsic values for franchises businesses. It is not surprising, therefore, that value-oriented growth investors resort to rule-based and somewhat arbitrary sell protocols. Warren Buffett, for example, typically plans never to sell. Other value investors often use arbitrary limits on the multiple of sustainable earnings, e.g. 25 times, above which they will no longer hold franchises businesses. Second, the approach will not work for all growing franchises. Forecasting future returns, including capital gains, requires that the future be reasonably stable and predictable. Otherwise, estimates of growth rates cannot be made with any useful degree of accuracy. Franchise businesses growing at 15% or more per year cannot sustain those growth rates forever. Sooner or later, growth rates will decline to no more than a few percentage points above the long-term rate of the overall economy. Otherwise, as we have noted, one franchise business would take over the greater part of the whole economy. It is impossible to predict accurately when the inevitable transition to sustainable rates of growth will occur. It is also difficult to forecast the return impacts of shorter-term developments such as better management, economic fluctuations, potential major acquisitions, or innovative competitor behavior. In these fluid circumstances, at least some competitive advantages may shift in unpredictable ways. As a result, attempting to estimate returns for these companies will be, in the language of Graham and Dodd, a speculation rather than an investment judgment. These opportunities will usually land in the too tough to call pile. In franchise investing, as in value investing more generally, it is critical to identify what is accurately knowable, and in the Graham and Dodd tradition, focus on those factors in making investment decisions. Example 3. WD-40. One way of tracking the evolution of our approach to value investing between the first edition of this book, written largely in 1999 to 2000, and the current edition, is to re-examine some of the investment opportunities that we analyzed then. For Hudson General, a classic Case A opportunity with asset value well in excess of earnings power value, there has been little change. But for franchise businesses like WD-40, our understanding of the valuation process has evolved considerably. We will re-examine WD-40 at separate dates to highlight developments both in the company and in our analytical process. First, we will look at WD-40 at the end of September 1998, when the annual report for FY 1998, ending on August 31st, became available. This snapshot revisits the principal valuation analysis of the first edition. Second, we will look at WD-40 in September 2000, a second date we considered in the first edition. The differences in valuations at these two times provide a useful measure of the additional details in our current approach. Finally, we will look at WD-40 in September 2018, when financial reports for the most recent fiscal year became available, in order to demonstrate our new approach to contemporary valuations. WD-40 had been a one-product company for over 40 years until it purchased the 3-in-1 brand from Reckitt and Coleman in December 1995. The product WD-40 is a lubricant that unfreezes sticky screws, removes rust, dissolves adhesives, stops squeaks, and comes to the aid of the home handy person or the machine shop professional whenever anything small needs to be lubricated or protected from rust. The name WD-40 means water displacement, 40th attempt, suggesting the trials and effort that went into development. The familiar blue can is practically ubiquitous in homes, factories, and repair shops in the United States, United Kingdom, and many other parts of the world. According to the company, 4 out of 5 American households have a can, and more people use WD-40 each week than use dental floss. While this may be good news for dentists, it leaves WD-40 with few untapped targets for new business in its domestic market. Through 2000, WD-40 had been an extraordinarily profitable company, consistent and high operating margins, 25 to 30%, net income margins, 15 to 18%, and returns on equity, 35 to 42%, even without adjusting for excess cash. But growth in the mid-1990s had been more difficult, dropping from around 10% a year to slightly more than 5%. Net income, always a more variable figure, held up until after 1995, when it also tailed off. WD-40 took 3 steps starting in 1995 to invigorate its growth. It bought 3-in-1. It internally developed TAL5, a more powerful lubricant that it sought to market to commercial users without success, and it purchased the Lava brand of hand soap from Block Drug in April 1999. It was too early from our 2000 perspective to say whether the last new effort would pay off, by which we mean if it would spur growth in sales and income, as well as maintaining the high level of profitability. Instead, we will focus initially on the financial numbers for the fiscal year ending in August 1998, before Lava entered the picture, and right from that vantage point. WD-40 contracted out the manufacture, packaging, and shipment of all its lubricants. In fiscal year 1998, it needed only 167 employees to support $144 million in revenues. Primarily a sales and marketing organization, it spent around 10% of its revenue on advertising and promotion. It had no secret formula for any of the lubricants and other products, nothing that Dow, DuPont, Exxon, 3M, P&G, Unilever, or any other firm with a modicum of competence in the chemical business could not duplicate. No patents protected these products. Yet WD-40 had for many years earned an exceptionally high return, however measured, as return on sales, return on assets, or return on equity. The company referred to WD-40 as a fortress, and one of its goals was to extend the fortress beyond the U.S. and U.K. markets. When the company, in order to comply with environmental concerns, switched its aerosol propellant to CO2, yes, that CO2, better than the ozone-depleting chemical it was previously using, it was able to pass on the increased cost without blinking. WD-40 had all the characteristics of a powerful franchise business, including, it seems, significant unexploited pricing power. Unlike Hudson General and Magna, we have to look at WD-40 as an earnings-generating machine for which growth creates value, and assets play a lesser role in valuation. In other words, WD-40 is likely to be a KC company for which current earnings power value significantly exceeds asset value. We need, therefore, to focus primarily on earnings power, growth potential, and the sustainability of current levels of profitability. We have to understand its strategic position. Where were the competitors who should have been entering into markets and stealing away customers or forcing WD-40 to lower its prices? If there were nothing magic in its lubricants elixir, what kept the challengers at bay? WD-40 as the reward of a well-conceived search strategy. In looking at a franchise business, we have to concentrate on the core enterprise that is the key locus of value creation, meaning that we start with an enterprise valuation rather than valuing only the equity. This begins with the total market value of WD-40's equity. At the end of September 1998, WD-40's common stock was trading at $26.50. The fully diluted number of shares outstanding as of August 31, 1998, was 15.7 million, for a total market value of $416 million. From this figure, we must subtract the value represented by WD-40's net cash holdings of $13 million. That leaves the value of the ongoing enterprise, what we would have had to pay for the company at the current market price, minus the value of the net cash acquired, which is cash minus debt, at $403 million. To this, we should next add the cost of legacy liabilities, such as unfunded pension liabilities, that we would in principle have to pay off along with the debt in order to acquire an unencumbered claim on the underlying business. We should subtract the offsetting value of non-core assets, such as investments in unrelated enterprises like low-income housing that could, again in principle, be sold to pay off debt or legacy liabilities. For WD-40, the net total is near zero, so we will ignore these adjustments. At the end of September 1998, we would have had to pay $403 million to acquire the core enterprise of WD-40 at then prevailing market prices. For our $403 million, we would acquire a business that generated roughly $34 million of operating earnings before interest and taxes, or EBIT, in FY 1998, with an average tax rate of roughly 36%. This falls to around $22 million in potential after-tax earnings, a 5.5% return on our $403 million investment. Using a more traditional metric, the WD-40 enterprise was trading at 12 times EBIT, $403 million divided by $34 million, or 18 times after-tax earnings, $403 million divided by $22 million. By both measures, WD-40 was a relative bargain compared to other contemporary investments. In September 1998, the overall stock market, including non-franchise businesses, was trading at 22 to 23 times earnings. However, by longer-term historical standards, where the average P to E ratio was 17 to 18 to 1, WD-40 was less attractive. In the year prior to September 30th, 1998, WD-40's stock price was flat to slightly down in the midst of a generally rising stock market. Overall, therefore, WD-40 was slightly disappointing, slightly cheap for a growing franchise business, and with a small market cap of $416 million not closely followed by financial analysts. On the other hand, its product was widely known and admired. WD-40 might well have been worth looking at in an inflated market environment with few obvious bargains, but we should not be surprised if it turned out to be fairly valued. It was not an obvious bargain, unlike Magna International in March 2009. The WD-40 franchise. The first step in evaluating any franchise business is to assess the nature, magnitude, and sustainability of the business's competitive advantages divided by barriers to entry. Of the three fundamental sources of competitive advantage, we have already addressed the question of proprietary technology. WD-40 had no significant patents, learning curve advantages, or proprietary process technologies. What WD-40 did enjoy was a significant degree of customer captivity. Customer loyalty, built up over many years of advertising and customer satisfaction, ensured that a competitor would have a difficult time persuading users to try something new. Here, the absence of technological change benefited WD-40. Even WD-40's own new lubricant, TAL5, did not represent a sufficiently large improvement over the established product to attract customers. Relative to the price of the product, search costs were strikingly high. A can of WD-40 typically sold for under $5 and lasted for many years. Trying an alternative product at a potential savings of $1 per can would have minimal appeal since a single can lasted so long. The benefits of repeated purchases of a superior alternative were limited by the low replacement frequency. If an alternative proved unsatisfactory, then the consumer's loss would be the full $4 purchase price. Even with a success probability of 75%, this was a losing proposition. An expected gain of 75 cents, 75% times $1, compared to an expected loss of $1, 25% times $4. Beyond this marginal gain at best, the time and trouble of finding an alternative would have to be considered. The economics for retailers were likely to be even worse. The 20% discount minimally necessary to attract WD-40 customers inevitably meant a lower retail margin, or an even greater wholesale price reduction than 20% by the entrant brand. Given the unlikelihood that a competitive entrant would attract large numbers of WD-40 customers within a reasonable period of time, any resulting investment in promotion and shelf space at the retail level was almost certain to be unprofitable. The absence of retail support for alternative brands reinforced WD-40's customer captivity. Finally, WD-40's market saturation meant that only a relatively few potential customers were not already WD-40 users. Their number, even if they were freely available targets for new entrants, were likely to be too small to support the fixed costs the newcomer would have to cover. These hurdles for a potential competitor led naturally to the most important source of competitive advantage: economies of scale. In order to enter each separate geographic market for WD-40, an entrant would have had to establish a local sales and advertising presence sufficient to compete with WD-40. Advertising and promotion expenses for WD-40, with basically a 100% market share, were 10% of sales. These costs were fixed for each geographic market regardless of sales. Suppose the market in southern Florida was $30 million per year. Then the 10% fixed marketing and sales costs would be $3 million. If an entrant succeeded in capturing a 25% market share at a price 20% below WD-40's, its sales would be $6 million, 1/4 of a market, of $24 million in revenue at the 20% lower price. The $3 million fixed overhead would then consume 50% of sales revenue. WD-40's cost of goods sold, its variable unit production and distribution costs for local contractors, was at least 40% of sales. If the entrant had those same costs with a 20% lower price, then its cost of goods sold would be 50% of its revenue, 80% of WD-40's unit price divided by 40% of WD-40's unit price. Together, the fixed local sales overhead plus cost of goods sold would consume 100% of the entrant's revenue, with nothing left for product management, administrative overhead, or local management supervision. This opportunity was not an economically attractive proposition for any entrant with a calculator or a spreadsheet. Looked at another way, suppose an entrant could be economically viable at 30% market share, and that the entrant would capture 0.5% market share per year, an optimistic figure for a product like WD-40 with a low price, low purchase frequency, and high search cost. Reaching a 30% market share would take 60 years. A 60-year path to economic viability would likely deter any rational potential entrant and bankrupt any irrational one. The strength of WD-40's economic franchise depended paradoxically on the small size of its market. Remember, the best defended monopoly is a single store in a town too small to allow for a second one. WD-40's existing market looked in 1998 very much like a one-store town. The financial history provides strong support for this argument. By 1998, which is our vantage point for this analysis, WD-40 had enjoyed immunity from entrants for over 40 years while earning outsized returns on invested capital. On August 31, 1998, WD-40 had a book value of equity of $55 million, including $13 million in net cash and an additional $3 million invested in low-income housing, which at the time provided tax advantages. The book value of equity investment in the operating business was only about $40 million. Net operating income after taxes of $22 million represented a 55% return on equity. In theory, this higher return should have attracted swarms of competitors. The fact that no successful entry took place over 40 years indicates that powerful barriers to entry were in place. Valuing WD-40 in 1998. Earnings power for WD-40. For a business like WD-40 with a sustainable franchise, the reproduction costs of the assets play only a secondary role in determining intrinsic value. But it is also true that earnings power values by themselves do not determine the attractiveness of a franchise investment. In contrast to competitive businesses, growth in a franchise may add significant value. Nevertheless, estimating the earnings power is the proper starting point for evaluating franchise businesses. Table example 3.1 presents a history of that relevant financial data for WD-40 from 1990 through 2002. Throughout this period, revenues rarely declined. Even in the recession year of 1991, revenues fell by only about 1% and then quickly recovered in 1992. Given the absence of cyclical variation, current year revenues should be sustainable revenues. Margins were also highly stable and do not appear to vary with the business cycle. In 1991, operating margin actually rose. There were year-to-year margin fluctuations that should be averaged out to calculate sustainable margins. From 1990 to 1998, operating margins averaged 27%. There was a slight downward trend in margins during this period, with margins in 1998 particularly low. We should be careful not to use the fact that margins in 1999 and 2000 continued to drop since that information was not available in 1998. However, it is notable that the decline seems to have coincided with a rising concern regarding stagnant sales in the early 1990s that led management to develop TAL5 and acquire 3-in-1. Increased marketing expense to boost sales growth was reflected in rising levels of overhead expense relative to sales, a large part of the reason for the declining margins. If we believed that this increase in marketing spend was permanent, then sustainable margins from 1998 going forward would be well below the historical average of about 27%. If we thought the higher costs were temporary, then the historical average should apply. Since we were uncertain, we split the difference and used an estimated sustainable earnings margin of 25%, halfway between 27% and the more recent levels below 24%. Thus, our 1998 estimated sustainable operating earnings before accounting adjustments was $36 million, 25% of sustainable revenues of $144 million. Few accounting adjustments to this number were required. WD-40 took only a single exceptional charge of $12.6 million between 1990 and 1998, the result of a litigation loss in 1994. This averaged out to $1.4 million per year over the 9 years. Counterbalancing this loss, depreciation charges between 1990 and 1998 regularly equaled or exceeded total capital expense. Depreciation seems to have exceeded any reasonable estimate of replacement capital expense by at least $1 million per year. Since this second adjustment is largely protected from income tax by the depreciation tax shield, it almost exactly offsets the post-tax cost of the average write-down of $0.9 million, 100% less the 37% corporate tax rate times a pre-tax cost of $1.4 million. Our sustainable operating earnings of $36 million pre-accounting adjustments were slightly above post-adjusted figure. The average rate of corporate income tax incurred in the 5 years from 1994 to 1998 was roughly 37%. If we assume that this was a sustainable future tax rate, then the after-tax earnings power for WD-40's core franchise business in 1998 was $23 million, 63% of $36 million. This represented a 5.7% earnings return on the $403 million cost of buying the core business. Earnings Power Value 2. At this point, in the first edition of the book, we proceeded to calculate earnings power value, just as we have done in this edition for Magna International and Hudson General. We simply divided the $23 million earnings power by the cost of capital appropriate to an investment in the core WD-40 business. The cost of capital is the cost of voluntarily attracting the funds necessary to support the business, a weighted average of the cost of attracting both cheap debt financing and expensive equity financing. The weights in question should reflect the mix of actual financing for a firm's operations going forward, with the notable exception of companies that are overly reliant on debt. In these cases, the cost of the debt should properly include the potential cost of debt-related impairment of company operations, including the potential cost of bankruptcy. This cost is difficult to calculate and often overlooked. As a result, the calculated cost of capital for firms with a heavy reliance on low-cost debt will be inappropriately low. The standard solution to this problem is to reduce the amount of debt from actual historical levels to a level at which it would not be expected to significantly impair firm operations. In many finance contexts, this is assumed to be an optimal level of debt, e.g., 20%, as opposed to an actual debt level of 80%, with an associated optimal level of equity, e.g., 80%, as opposed to an actual level of 20%. Some finance practitioners recommend applying a similar ideal capital structure and calculating cost of capital for firms with too little debt. But in this case, the true cost of debt is not being ignored, and there is no such hidden cost to too much equity. WD-40 had generally been all equity financed, often with negative net debt, positive net cash. Moreover, there was little indication that this would change in the future, short of significant activist intervention. Thus, for WD-40, the weighted average cost of capital was the cost of equity financing. The cost of equity financing in 1998 lay between the contemporary cost of slightly risky, say, BAA debt, and the cost of venture capital funding, typically the most expensive source of equity. In the fall of 1998, this range ran from 7 to 15%. Given its highly stable economic position and all equity financial structure, WD-40's cost of equity should have fallen near the bottom of this range. Thus, our estimate of the cost of capital for WD-40 would have been roughly 8%, producing an earnings power value of $288 million for the underlying operation, $23 million divided by 8%. To this we must add the value of net cash and other extraneous investments of $16 million for a final earnings power value of $304 million for WD-40's equity. This figure corresponds to a value per share of $19.36, $304 million divided by 15.7 million shares, which was below the market price of $26.50. An orthodox Graham and Dodd investor would not have invested in WD-40, but for businesses such as WD-40, given the powerful nature of its franchise, growth does create incremental value. This added value might make an investment attractive for a value investor willing to include value-creating growth in the investment decision. The value of growth for WD-40. In the first edition of this book, we devoted 3 short paragraphs to the possibility of profitable growth, for which we used a highly abbreviated DCF model. First, we noted that WD-40 paid $1.28 per share out of its earnings of $1.40. We assumed this amount captured the likely future sustainable cash distributions out of sustainable earnings, roughly also $1.40 per share, since net share buybacks were negligible. Next, we estimated without detailed analysis that recent earnings growth rates of about 3% would be sustainable in the future, and that with a constant payout ratio, dividends would grow with earnings. Finally, with our 8% cost of capital and 3% growth rate, we capitalized the $1.40 per share payout at 20 times, 1 divided by open parenthesis 8% minus 3%, close parenthesis. This yielded a per-share value of $25.60, still slightly below the market price of $26.50. The shortcomings of this calculation then and now are its painful uncertainty. If the growth rate in earnings were 4.5%, a mere 1.5% off our 3% estimate, a figure closer to the long-term earnings growth rate, then the capitalization factor would have been 28.5, 1 divided by 3.5%, for a per-share value of $36.48, a nearly 30% margin of safety given the contemporary price of $26.50 per share. On the other hand, an earnings growth rate of 1.5%, equal to the most recent few years, would lead to a multiple of 15, 1 divided by 6.5%, for a price of under $20 per share, leaving WD-40 a truly unattractive investment. As we pointed out at the beginning of Chapter 8, this indeterminacy is fundamental to growth stock evaluation. In order to make useful growth stock investment decisions, we should look at returns, not values. WD-40 returns. Analysis of sustainable future returns begins with the future cash return. This is the quantity of earnings actually distributed to stockholders out of the 5.7% sustainable earnings return that we calculated before. This figure itself depends on the distribution policy of WD-40's management. In 6 years, through the end of August 1998, WD-40 distributed a net $18 million per year on average to shareholders in dividends minus, in this case, net equity sales. Net income averaged $21 million per year after making appropriate adjustments for overdepreciation and the one-time charge in 1994. Net cash remained roughly constant. The resulting 86% payout ratio was financed from earnings and therefore likely sustainable. A payout of 86% of the 5.7% sustainable earnings return represented a roughly 5% cash return going forward to investors in WD-40 stock purchased on September 30th, 1998 at $26.50 per share. To this, we must add the returns from growth, which would have arisen from two basic sources. One, organic growth in sales and earnings of WD-40's existing product lines, distribution arrangements, and productivity improvements. And two, returns to active and reinvestment initiatives such as the purchase of $15 million of 3-in-1 products in December 1995. We will consider each of these sources of the value of growth in turn. Organic growth returns. Table example 3.2 shows historical nominal growth rates in WD-40 revenues and earnings relative to overall U.S. inflation rates. For the period prior to the acquisition of 3-in-1, 1980 to 1995, nominal revenues grew by 8.4% per year. Real sales grew by 4.5% per year, and net income grew by 7.4% per year. Growth in sales was entirely internally generated by a combination of rising organic demand, expansions to new geographic markets financed out of current income, and for profits, from daily improvements in operating efficiency. Capital investment was minimal, and the one active investment initiative, the development of TAL5, was a flop. We considered this growth organic in the sense that it arose naturally in the ordinary course of doing business. Profit growth was slightly below revenue growth, but that was largely attributable to developments prior to 1985. If the extraordinary spending on TAL5 were to be eliminated, the historical growth of net income in tandem with revenue should resume. The question then is, what would revenue growth going forward look like? And to answer that, we needed to focus on the underlying determinants of WD-40's revenue growth. Throughout the late 1990s, WD-40 exports from the U.S., UK, and Australia to emerging economies rose sharply. And demand from those areas was in no sense saturated, meaning that WD-40's growth would not be limited by increases in the developed economies of Europe and North America. WD-40 appealed to households across the income spectrum and would not be greatly affected by secular changes toward greater income inequality. On the other hand, WD-40 was a product rather than a service and would suffer from the global trend in consumption away from goods and towards services. Taken together, these forces suggested that demand for WD-40 going forward would grow slightly more slowly than global GDP, perhaps 4% in real terms, compared to an expected real GDP growth of 5% from 1998 going forward. This GDP figure would correspond to the population growth of 1.5% per year and global productivity growth of 3.5%. On top of this real growth, global inflation was likely to run at about 1.5%, continuing a deceleration that began in the early 1980s. Nominal GDP growth of 6 to 6.5% per year should translate into growth in demand for WD-40 of at most 4.5%. That would closely resemble the pre-1995 historical growth rate of 4.5%. If we allow for the further possibility that a fraction of the recent decline in margins prior to 1998 would be permanent, an organic growth rate of WD-40 net income of 4% a year would be a reasonable estimate. The investment required to support this organic growth would consist almost entirely of working capital. WD-40 outsourced all its manufacturing and distribution. Historical accounts receivable and inventory had amounted to roughly 20% of sales, partially offset by accounts payable and accrued liabilities equal to 6% of sales. Using these ratios, net working capital of 14 cents would be required for each extra dollar of sales. The 1998 base level of $144 million in sales growing at 4.5% would mean an extra $6.5 million in sales. The additional net working capital required would be about $1 million, 14% of $6.5 million, or about 4.5% of sustainable 1998 earnings of $21 million. If 86% of earnings continued to be distributed to shareholders and 4.5% was needed to support organic growth, that would leave roughly 10% of earnings for active reinvestment. To sum up, on top of the cash return of 5%, organic growth should contribute a further 4% annual increase in value, a total of 9%, while leaving 10% of earnings to generate further value through active reinvestment. Active reinvestment. After distributing $19 million to shareholders, 86% of $22 million, and using $1 million to support organic growth, management would be left with $2 million sustainable earnings per year for active reinvestment. In the case of WD-40, this money had recently gone to the acquisition of new product lines. Prior to 1998, the sole acquisition had been 3-in-1 in December 1995. Including acquired debt, WD-40 paid $16 million for brand value and other intangibles, plus a small amount of inventory. Assuming that WD-40 could employ these assets with the same effectiveness as had Reckitt and Coleman, the prior owner, incremental 3-in-1 revenues and earnings for WD-40 should be the same as they were before the sale. For 1994 and 1995, Reckitt and Coleman reported average 3-in-1 sales of roughly $12.5 million and average operating income after amortization of roughly $6 million. The reported $6.5 million in cost included cost of goods sold and direct marketing cost equal to 15% of sales with no provision for other overhead. For a product very similar to WD-40, the implied operating margins of 48% seems improbably high compared to WD-40's pre-1995 operating margins of 27%. With 3-in-1 operating margins adjusted to that level, the average operating income acquired by WD-40 would have been $3.4 million, 27% of $12.5 million. At a tax rate of 37%, after-tax incremental profit would have been $2.1 million, a roughly 13% annual return on WD-40's $16 million investment before attributing any value to growth in 3-in-1 revenues and profits. If 3-in-1 were indeed similar to WD-40, then organic growth should add considerably to the returns from the acquisition. However, the limited history published before the deal revealed flat to slightly declining sales and margins. It seems realistic to ignore growth in evaluating the 3-in-1 acquisition. The 13% return on investment, even with no growth, was well above a likely cost of capital of 8 to 9%, similar to WD-40's. This return represents a value creation factor of 1.5, 13% divided by 8.5% on the acquisition. If this transaction reflected WD-40's skills in actively investing retained earnings, then each dollar reinvested should create $1.5 of value for WD-40. Thus, the $2 million in sustainable reinvested annual earnings would add $3 million in annual value, a further return of about 0.75% on the $403 million purchase cost of WD-40. For this reinvestment scenario, the total return on an equity investment in WD-40 at $26.50 per share would be almost 10%, a 5% cash return, 4% from organic growth, and 0.75% from active reinvestment. The low level of this active reinvestment return is due to the low level of actively reinvested earnings. Compared to WD-40's cost of capital of 8%, this leaves roughly 25% as the margin of safety on returns. In the late 1990s, average equity returns in the U.S. equity market were around 6%. The market multiple of sustainable earnings was roughly 25 times, a real earnings return of 4%. Inflation added another 1.5% to reach nominal estimated returns of 5.5%. Alternatively, we could have estimated the market return from cash payouts plus overall growth. Average payouts on U.S. equities were 2%, with nominal growth adding perhaps another 4.5%. The total prospective nominal U.S. returns were 6.5%. Averaging the two gives an estimated market return of 6%. In comparison, a return close to 10% on low-risk equities such as WD-40 would have seemed attractive. But value investors should be wary of these kinds of return comparisons in euphoric markets like that of the late 1990s. Short-term contemporary return comparisons are relative value comparisons. True value investors should compare the 10% return to the long-term cost of capital estimate embodied in our 8% figure. Even with that caveat, a careful accounting for growth in terms of returns reveals that WD-40 in late 1998 was a much more attractive opportunity than indicated by the abbreviated DCF analysis in our first edition. This return approach turns out to have been remarkably accurate. Table Example 3.3 presents realized returns to a WD-40 equity purchase on September 30th, 1998, over the following 5, 10, and 15-year periods. It also includes estimated returns for the period, which we computed before looking at the actuals, no peaking. The only substantial difference is in the 10-year period that terminated on September 30th, 2008, in the middle of the financial crisis. Over the entire 15 years, the S&P 500 index returned slightly less than but close to our 6% estimate, which by historical equity return averages is not what Graham and Dodd would have regarded as a satisfactory return. However, these figures overstate the true margin of safety of the WD-40 investment since the SP returns are unusually low. They highlight the danger of relative return decision-making, particularly when investing in richly valued markets. A second piece of these return comparisons also overstates the attractiveness of a WD-40 investment in 1998. Looking forward, there was a low, but not zero probability that changing economic conditions would undermine WD-40's franchise position. As we discussed before, barriers to entry into WD-40's markets appeared formidable. The retail infrastructure through which WD-40 sold its products looked highly stable. Internet-based retail, whose consequences we will discuss later, did not yet appear as a threat. Technology did not seem likely to undermine the utility of WD-40's products, which by 1998 had enjoyed an unchallenged market position for roughly 50 years. If we use as a rule of thumb that future franchise life should equal existing franchise life, we would have estimated a franchise fade rate for WD-40 of 1.4%, 72 divided by 50 years to get a franchise half-life. Our 2% margin of safety slightly exceeded this potential rate of loss, but taking this fade rate into account would have made WD-40 a significantly less attractive investment. As the future unfolded between 1998 and 2013, the WD-40 franchise remained intact. The temptation, therefore, is to treat the fade probability as zero and to accept the realized returns in Table Example 3.3 as an accurate measure of the likely return on the original WD-40 investment. The ex-ante odds certainly favored this outcome. With a half-life of 50 years, WD-40's franchise was unlikely to be undermined by events within 15 years. There was, however, an undeniable element of luck in this outcome. Today, as retail through the Internet threatens to become the dominant marketing channel for WD-40, the future of WD-40's franchise looks far more uncertain than it did in 1998. This evolution might easily have arrived 5 or 10 years earlier. The fact that it did not may represent good fortune for WD-40, but it was hardly inevitable. Thus, the returns in Table Example 3.3 do not fully reflect the cost of franchise fade, and to that extent, overstate the return to the 1998 WD-40 investment. WD-40 on September 30th, 2000. From $26.50 on September 30th, 1998, the price of a WD-40 share fell from $21.88 on September 30th, 2000. At a time when the U.S. stock market as a whole was doing extremely well, the annual return to a WD-40 investment over these 2 years was negative 9%. A stock price decline of 9% per year was partially offset by dividends. In the near term, the 1998 investment in WD-40 would have been a disappointment. One of the key assumptions underlying our 1998 valuation turned out not to be accurate in the short run. We assumed that management would not persist in the value-destroying pursuit of growth, whether through acquisitions like 3-in-1 or internal developments like TAL5. We were wrong. In April 1999, WD-40 acquired Lava brand soap, a heavy-duty hand cleaner. A year later, it bought Solvol hand cleaner. In April 2001, management paid $72.9 million for 3 household products: 2,000 flushes, X14, a toilet bowl and hard surface cleaner, and Carpet Fresh. These acquisitions, the results of a policy of unfocused growth that became apparent between 1998 and 2000, were both more expensive and less closely related to WD-40's existing products than the 3-in-1 acquisition. The consequences are evident in the operating performance data in Table Example 3.1. From FY 1998 to FY 2000, both gross and operating margins declined noticeably, while revenues increased only slightly. The decline in tax rates moderated the drop in net income, which still fell from $22 million to $21 million. Payout ratios continued to be high, at least until the April 2000 acquisition. But net cash fell by $24 million from $16 million of net cash to $8 million of net debt, so that high payouts were sure to be subject to balance sheet pressures in the future. Management continued to stress the pursuit of growth. There were indications, even prior to September 1998, that this might happen. As we noted before, operating margins had declined from roughly 28% in FY 1994 and FY 1995 to 24% in 1998 as marketing and overhead expenses increased relative to sales in pursuit of more rapid revenue growth. These efforts had been disappointing. After an earlier unsuccessful growth policy from 1980 to 1985, WD-40's management had refocused on operational efficiency, and margins had recovered. In our valuation, we assumed something similar would happen going forward from September 1998. Our error in making this judgment naturally raises the question of whether, at the reduced price of $21.88 in September 2000, WD-40 remained a sound investment. If management persisted in pursuing ill-focused growth, earnings power was likely to fall from $22 million to $20 million. The cost of acquiring WD-40 for its operations was now $340 million. 15.6 million shares times $21.88 per share, plus $8 million of net debt. The decline in the capital necessary to buy WD-40 made the sustainable earnings return, 5.75%, very close to the 5.7% earnings return in September 1998. The payout ratio in 2000 was actually more than 100% of earnings, which did not appear sustainable. Let us assume that payouts decline from 86% of earnings power to 76% of earnings power. This yields a 4.5% cash return. Organic growth should continue to be 4% per year, with an investment cost equal to roughly 4% of earnings. This would leave 20% of earnings for active reinvestment, 100% minus 76% payout, minus 4% organic growth investment. The quality of the active investment had undoubtedly dropped by between 1995 and 2000. It seems unlikely that acquisitions in the areas of toilet, hand, and rug cleaner would be as accretive in value as the 3-in-1 acquisition. Exactly how much value would be destroyed per dollar invested would have required a detailed acquisition-by-acquisition analysis similar to what we did for 3-in-1. But let us simply assume that each dollar invested produces only about 50 cents of value. Then, the $4 million of actively invested earnings, 20% of $20 million, produces $2 million of additional value, 50% of $4 million. That in turn represents a further 0.6% return on the $340 million market purchase price, $2 million divided by $340 million. A rough estimate of the total return from an investment in WD-40 in 2000 is thus 9% per year, 4.5% cash return, 4% organic growth, and 0.6% active investment return. The decline in management performance was largely balanced by the decline in WD-40's market price. Meanwhile, the overall level of U.S. stock prices had risen, lowering a reasonable estimate of the S&P 500 return from 6% to about 5%. In relative terms, WD-40 had by September 2000 become slightly more attractive, But in critical absolute return terms, with its likely fade rate taken into account, WD-40 now represented a return just equal to its cost of capital, leaving no margin of safety. As things worked out, WD-40 in the long run outperformed these reduced expectations. At the end of 5 and 10 years, actual returns were almost exactly 9%. The 15-year return was over 13%. In the long run, WD-40 regained its touch by returning to what it did best and abandoning its unfocused growth efforts. From 2012 to 2015, even as WD-40's revenues grew by only 3.3% per year, close to the organic growth rate which had slowed slightly with the decline in global GDP growth, its operating margins rose from 15.1% to 17.3%. By 2018, the operating margins were 19.2%, and payouts were averaging over 100%. These were financed from a rising level of net debt. This change illustrates an essential point about franchise investing. The long run matters, and in the long run, unless there is strong evidence to the contrary, stability is more likely than change. WD-40 in 2018. On September 28, 2018, the last trading day in September, WD-40 closed at a price of $172.10 per share. Operating margins appear to have stabilized at 19%, and revenues were $409 million. As a result of a dramatic recent reduction in corporate tax rates, corporate taxes in 2018 were only slightly above 12% of net income. In the long run, corporate tax rates appear unlikely to continue at such a low level, if only because U.S. federal tax rates reductions will be partially offset by rising state corporate income tax rates. Because the trend toward lower corporate income tax rates has been long-lived and global in nature, we will assume a sustainable corporate tax rate of 20%. These figures produce an earnings power estimate for WD-40 in 2018 of $62 million, $409 million times 19% times 80% after tax. Given management's return to its long-standing policy of distributing a large fraction of earnings and to focusing retained earnings on improving core business operations, we will assume that all earnings, aside from those required to support organic growth, are either distributed to stockholders or, if actively reinvested, earn a return equal to WD-40's cost of capital. In terms of value delivered to shareholders, these alternatives amount to the same thing. Organic growth, which given the low level of active reinvestment should have tracked overall growth in the past few years, appears to have declined from 4% to roughly 3% per year, mirroring slowing global economic growth in both developed and developing countries. At 3% organic growth, WD-40's 2018 sales growth should be $12.3 million per year, 3% of $409 million. Since each dollar of extra revenue continues to require about 15 cents of net investment, $2 million of retained earnings must be devoted to supporting organic growth. That leaves $60 million of sustainable earnings for distribution to investors. The cost of buying WD-40's core business at the end of September 2018 consists of $2,392 million in equity, $172.10 times 13.9 million shares outstanding, plus $37 million in net debt, for a total enterprise value of $2,429 million. The $60 million sustainable annual distribution to shareholders then represents roughly a cash return of about 2.5%, $60 million divided by $2,429 million. Adding 3% for organic growth yields a total return of 5.5%, since we are assuming that active reinvestment will be negligible. This figure is clearly below our long-run cost of capital of 8%, meaning that intrinsic value is below market value, and the 3% organic growth return exaggerates the true organic growth return, further reducing our true return. In addition, the shift of retail to the internet has almost certainly narrowed WD-40's moat. Rival products no longer need to pursue the difficult and costly process of in-store placements and distribution. They can now appeal directly to masses of consumers. At the same time, online user reviews should provide some measure of assurance about the quality of each new rival product. Finally, internet retailing greatly facilitates price comparisons and increases price competition. As these changes become embedded in markets and consumer behavior, the potential for WD-40 franchise erosion should rise markedly. In our terminology, fade rates could well increase from 1 to 1.5% per year to as much as 2.5 to 3%, from a franchise half-life of 50 years to one of 25 to 30 years. With no margin of safety left in the current WD-40 stock price, there is no protection against franchise fade of this magnitude. At the end of 2018, WD-40 is clearly overvalued. The technological innovations that can threaten even a well-entrenched franchise like WD-40 may emerge not from changes in product improvement or process technology, but from the infrastructure of sales and distribution. Example 4. Intel. By any measure, Intel is one of the great success stories in business history. We first wrote that sentence in the first edition of this book in January 2000, when Intel, which had been founded in 1969, had a market capitalization of $275 billion. It stood at the pinnacle of the semiconductor industry, which was to the world economy in the last quarter of the 20th century what the railroads had been to the 19th century, and electricity and automobiles to the early 20th century, the great engine of growth and productivity. In 1999, Intel sales were $29 billion, having grown from $1.4 billion in 1985, a compound annual rate of roughly 24%. Profit margins on sales had averaged more than 20%, and returns on equity, properly measured, more than 40% during those 15 years. Buying Intel stock at the IPO in 1971 would have been a stroke of genius. So would an investment 10 years later in 1981, and 10 years after that in 1991. 27 years later, at the end of 2018, Intel remained an outstanding, if not the outstanding company in the semiconductor industry. Sales in 2018 exceeded $70 billion. Margins on sales and on equity, again properly measured, were both over 30%. Yet Intel's market capitalization on December 2018 was only $218 billion, well below its January 2000 level. An investment in Intel stock over those 19 years would have produced an average annual return of just 2%. Notwithstanding the company's extraordinarily strong long-term performance, there were many times during these years when an investment in Intel would have been a disappointment. The critical question is whether the value investing process and the valuation tools we have developed in this book can enable a value investor to navigate successfully the turbulent waters of a stock such as Intel. This chapter attempts to provide an answer by applying the full range of those tools to a decision to invest in Intel at several critical points in its history. For every decision point except the most recent, we have the advantage of being able to compare our estimated returns with those actually realized by an investor, a potentially chastening experience for everyone who makes predictions. Intel history, the very short version. The series of events that gave birth to Intel read like a chapter from Genesis. In the beginning was Bell Labs. There, in the late 1940s, John Bardeen, Walter Brattain, and William Shockley invented the transistor, a solid-state replacement for the vacuum tube that had been a key component of the ENIAC generation of computers. The three earned the Nobel Prize for their efforts in 1956. In that year, Bell Labs begat Shockley Laboratories, as Shockley left to set up his own firm. 1 year later, 8 of Shockley's best engineers departed to start a new firm with the financial backing of Sherman Fairchild. And so Shockley Laboratories begat Fairchild Semiconductor. At Fairchild, Robert Noyce managed to combine multiple transistors on a single piece of silicon, inventing what became known as the integrated circuit. Fairchild, by contrast, began to disintegrate as talented employees left to strike out on their own. In 1967, Fairchild begat National Semiconductor when Charles Spork founded this new firm. 1 year later, Noyce and Gordon Moore, head of research and development, decided it was time for them to leave, frustrated that their most promising innovations seldom came to fruition. They made a telephone call to Arthur Rock, a venture capitalist before the term was invented, who raised enough money in 2 days for them to start on their own. Thus, Fairchild Semiconductor begat Intel. Intel's initial business was designing and manufacturing computer memory chips. Although it developed its first microprocessor, the 4004, in 1971, the company's bread and butter was integrated circuits that replaced magnetic cores as the memory components of mainframe computers. The chips were smaller, faster, and cheaper than magnetic cores. These three virtues, which became the dynamic behind continual innovation and growth in the computer and related industries, made the memory business very profitable for Intel. The founders had not discovered the particular technology that made that early generation of memory chips successful, nor was Intel the only company in the neighborhood, soon to be known as Silicon Valley, able to produce them. But it successfully combined product design, process engineering, and customer service so that it quickly emerged as the largest player in the memory chip game. Fairchild Semiconductor, from which both the engineers and the inventions had sprung, became less significant. In 1971, Intel raised $7 million by selling 300,000 shares in an IPO. It lost money on its operations in its first year, but then began a succession of profitable years that lasted until 1985. The company flourished by turning silicon, an inexpensive raw material, into valuable and essential finished products, memory chips, and later microprocessors. It accomplished this alchemy through the organized application of human capital in the form of scientific and engineering knowledge. We will telescope the first 3 decades of Intel's history into a few sentences. It made a lot of money in the 1970s on memory chips, even though it was often not the market leader or the most efficient producer. Around 1980, one of its microprocessors, the 8088, was chosen by IBM to be the central processing unit of the soon-to-be-launched IBM personal computer. At the same time that the PC revolution took off, Intel started to lose money on its memory chip business. Large Japanese conglomerates like Hitachi and Fujitsu beat Intel in every aspect of the dynamic random access memory game. They produced better chips, fewer duds, more cheaply, and then sold them for less money to manufacturers with whom they had worked more closely. After considerable soul-searching, Intel's history was interwoven from birth with that of the memory chip. Gordon Moore and Robert Noyce decided in 1985 to abandon the memory business. Since then, Intel has concentrated on microprocessors, both the original PC chip and its much more powerful successors, and on a range of other processors for network, industrial, and computer uses. The company has been continually profitable since it left the memory chip period in the mid-1980s. It has continued to grow, although not at the rate as in its early years when the silicon world was young. Throughout its history, Intel has invested heavily in developing its intellectual capital. Its R&D expenses averaged over 11% of sales for the period 1971 through 1998, and Intel defended its intellectual capital. It went to court repeatedly to contain rivals and former employees when it thought they were infringing on its patent-protected domains. Intel's giddy success in growing its business and keeping it profitable, with minor exceptions, is apparent from a few numbers and charts. Table Example 4.1 and Figure Example 4.1 display these results. In the figure, the scale is logarithmic. Each horizontal bar represents a tenfold increase from the line below. Several aspects of this history are common to many rapidly growing franchise businesses like Intel. They make Intel a particularly useful example for illustrating how to value such opportunities. First, new industries, especially those in high technology, are far from stable. Intel has never been WD-40. It began life as a maker of memory chips, but this episode was cut short by the entry of powerful global competitors with equivalent technology. At inception, the memory chip market was small and required highly specialized expertise. Under these circumstances, early entrants, such as Intel, enjoyed temporary advantages. They had a head start in moving down the learning curve to produce cheaper and more reliable chips. In the confines of the small initial market, they possessed significant scale advantages in R&D, marketing, and distribution. Finally, they were well positioned with customers who depended critically on a reliable supply of high-quality memory chips. For these customers, turning to untried alternative suppliers was highly risky. As a result, early entrants were protected from competition by strong customer captivity. However, as the market grew, the technology became more widely available and customers more sophisticated. Early competitive advantages dissipated. A larger market created more room for entrants to achieve viable scale at relatively low market share. Technology diffusion eliminated any proprietary, learning-based supply advantages. Increasing customer sophistication reduced customer captivity. The consequence, as Intel experienced, was intense global competition from a number of highly efficient firms. The easy profitability of Intel's early years could not be sustained. By 1985 and 1986, Intel was suffering serious operating losses. Intel survived this change, unlike many memory chip makers, due to a number of fortunate circumstances. At the time that memory chip profitability disappeared, Intel had a significant side business making microprocessors for the IBM PC and clone machines. By the mid-1980s, it had become, along with Microsoft's MS-DOS operating system, the personal computer industry standard. Second, Intel had sufficient resources to support a transition from memory to microprocessor chips. Third, Intel had a brave and visionary management that abandoned not only its now non-viable memory chip business, but also a promising initiative in parallel computing microprocessors in order to focus intensely on PC microprocessor chips. Investments in less favored memory chip firms would have not earned Intel-like returns. As a first step, investing successfully in nascent, rapidly growing businesses such as Intel requires both highly specialized knowledge of the relevant industry economics and management capabilities, or extremely good luck. Even after making the transition to PC microprocessors, Intel's success, although it looks inevitable in retrospect, was hardly guaranteed. Achieving a sustainably dominant position in the microprocessor market depended both on the nature of that business and the skill with which Intel's management addressed opportunities. If the microprocessor market were not to follow the path of memory chips, it would have to possess several distinct characteristics. First, as semiconductor technology advanced, the complexity of memory chips did not increase proportionately. Manufacturing leading-edge memory chips did not require steadily increasing R&D expense. In contrast, the demand for microprocessor functionality, what microprocessors were asked to do, rose alongside of semiconductor advances. PCs required microprocessors able to perform more complex operations more rapidly, in small packages, and using less energy in order to keep up with user demands. As a result, the scale of required microprocessor R&D tended to increase over time relative to the size of the microprocessor market. This meant that the space available for viable competitors was decreasing rather than increasing, unlike the situation for memory chips. Second, effective memory chips could be designed without reference to particular software programs and operating system. Microprocessor efficiency depends, importantly, on the sequences in which, and the frequency with which, particular operations are performed. Component and subsystem placements within a microprocessor must be optimized to facilitate the most frequent operations and sequences of operations. These in turn depend on the software environment in which a microprocessor operates. Thus, Intel's experience interacting with Microsoft programs, which constituted the dominant PC software environment, gave Intel important advantages in microprocessor design that it had not enjoyed in memory chips. Third, to nurture these potential competitive advantages to establish dominant scale-protected positions in the PC and server microprocessor markets would require a management focused almost exclusively on these products and able to cooperate effectively with the major software providers. Given the often messianic ambitions of tech managements, Intel's ability to maintain the necessary narrow focus and cooperative attitude was by no means certain, although by the mid-1980s, Intel did have a good track record in this regard. Again, as with the memory chip companies, successful investors in microprocessor companies such as Intel would have needed a detailed understanding of both the industry economics and the capabilities of managements. Finally, as it gradually became apparent in the late 1980s and early 1990s that Intel would achieve a dominant market position in PC and later server microprocessors, its stock price inevitably rose. A successful investor in Intel stock would have had to be able to determine whether, at such prices and in the face of divergent future possibilities, Intel was an attractive investment. This is a much more complicated undertaking than analyzing WD-40. At each stage in Intel's history, alternative future trajectories based on different industry evolutions and management behaviors would have to be considered. At any given time, Intel might be a Case A investment, asset value above EPV due to poor management and a varnished franchise, as was the case of several other memory chip competitors. Case B, capable management in a competitive industry, or Case C, growing franchise company. In evaluating Intel, we must apply all three valuation techniques: asset value, earnings power value, and estimated returns that we have developed. Only a liquidation analysis seems unnecessary. Valuation 1. Reproducing Intel's assets. Once Intel's competitive advantages in memory chip production had evaporated, its value would have been rooted in the value of its assets. Without barriers to entry, earnings levels above those necessary to provide an adequate return on these assets would be rapidly eliminated by the entry of efficient competitors. Since these competitors would themselves need to earn an adequate return on their own investments in memory chip production, they would not enter the market if industry earnings were insufficient to provide this return. Thus, if the investments required by efficient entrants were comparable to those of Intel, meaning that Intel itself was an efficient operator, then the value of earnings would have to cover the cost of reproducing Intel's own assets. The value of Intel's future earnings would therefore be largely determined by that cost, which is the natural starting point for valuing Intel. One simple way of estimating that reproduction value is to take Intel's accountants at their word and use Intel's accounting book value. A decision on whether to purchase Intel stock could then be made by comparing the book value of Intel's equity to its market value, whether for the company as a whole or on a book value per share compared to price per share basis. The shortcoming of this approach is that without careful analysis and adjustment, book values may be a very poor measure of the reproduction value of a company's assets. Still, as we noted earlier, buying stocks at substantial discounts to book value has been a successful investment strategy. It is also easy to do. It is therefore an appropriate strategy for investors who don't want to do a lot of work. Unfortunately, few successful businesses are available for sale at book value, and even fewer at a discount sufficient to provide an adequate margin of safety. Just to be certain, Table Example 4.3 presents the book value and market value figures for Intel over 5-year intervals starting in 1975. A graph of the market-to-book ratio over the entire period makes the relationship more apparent. For the years between 1980 and 1995, Intel traded at between 2 and 4 times the book value of its equity. These are all end-of-year numbers. During each year, Intel stock price hit highs and lows that differed, sometimes significantly, from the price at the year-end, but only in the general market run-up in the first half of 1987 did the company's market value exceed more than 4 times the value of its equity. This relationship lasted until the end of 1995, when the investors decided that they could pay more than 4 times the book value for a company as successful as Intel and still make money. The market-to-book analysis is quick and sometimes a bit muddy, if not downright dirty. To get a more precise take on what a competitor would need to spend in order to get into the business, we have to look at the assets line by line and calculate, sometimes estimate, what their replacement costs would be. We went through this exercise in chapters 4 and 6, and the guidelines for adjustment remain the same. Table Example 4.4 presents Intel's assets as listed in its financial statements for 1975. We have made virtually no adjustments to the assets as reported on the balance sheet. Intel did not use last in, first out, LIFO accounting to value its inventory, and it had not purchased another company in a transaction that would have landed goodwill on its books. That leaves property, plant, and equipment, PPE, as the account that needs scrutiny. Intel owned chip factories, fabs in industry parlance, in the Santa Clara region, and it had stocked them with the sophisticated equipment and clean rooms essential to turn out integrated circuits. It was a young company in 1975, so none of the plants or equipment would have been very old, although it had bought its first building, used, from Union Carbide. On the other hand, the industry was changing rapidly, and the rate of obsolescence in semiconductor capital equipment may have been faster than the depreciation Intel was charging itself. A competitor might have been able to duplicate its facilities for less than the book value of its assets. We can test how realistic is the stated value of PPE by comparing it with the actual capital expenditures Intel made. For almost every year in the entire public history of the firm, Intel's net PPE had been more than the sum of its last 4 years of capital outlays and less than the sum of the last 5 years. Only if one thinks that a competitor could replicate Intel's entire production and research facilities with substantially less than 4 years' worth of its expenditures is the net PPE figure overstated. Conversely, if Intel's net PPE number understated the real market value of its fixed assets, it would not have needed to spend the equivalent sum every 5 years. The net PPE figure stands up as a reasonable figure when measured against capital outlays. If there are other assets that a competitor would have needed to produce to compete with Intel, they are not found on the balance sheet for 1975. That does not mean they didn't exist. Intel, we should not forget, was a new economy stock long before the new economy had a name, at least in its post-1920s incarnation. As an early and major manufacturer of memory chips and then microprocessors, Intel invested in knowledge-based resources, the science and engineering skills needed to design and fabricate semiconductors, and supplied knowledge-enhancing products, which were the memory and brains of computers and industrial equipment, to its customers. But Intel's investments don't appear on the balance sheet because, under accounting rules, R&D is generally treated as an annual expense rather than a capital expenditure. Unlike utility bills, computer paper, or real estate taxes, money spent wisely on R&D should continue to earn profits for the company long after the checks have been cut. The expertise essential to design and produce these chips, everything from Andrew Groves' 1967 book, The Physics and Technology of Semiconductor Devices, to the months of trial and error involved in increasing the yield on some stubborn manufacturing process, does not come cheaply. Once purchased, it has lasting value. And not all of that knowledge is reflected in the R&D expense account. Some of it no doubt disappears into the cost of goods sold as a manufacturing expense. The investment in knowledge that shows up in Intel's income statement has been considerable. We wrote earlier that R&D averaged 11% of sales for the period 1975 to 1998. Any company trying to compete with Intel would need to spend considerably to build up an equivalent expertise. How much would be enough? Some analysts have suggested treating R&D as a capital investment and depreciating it on a straight-line basis over 5 years. If we simplify and say that this past year's outlays should be fully valued as an asset, last year's at 80%, and so on, we can calculate the value of an off-balance sheet intangible asset that estimates what a competitor would need to spend just to get into the business. For Intel in 1975, that amount would have been $27 million. This would have increased the reproduction costs of the assets by 40%, and the book value of equity from $74 million to $101 million, a gain of 37%. There are other ways to gauge the costs of reproducing the knowledge base. If we use the sum of the last 3 years spent on R&D, the figure would be somewhat higher than our depreciated total. Using the sum of the last 2 years would give us a slightly lower number. All of them might be understating the reproduction cost. Perhaps a competitor would need to spend 5 years' worth of R&D to become viable, or hire away some key Intel employees at a premium and then pay the court costs when Intel sued. We will use the 5-year depreciated figure as a conservative estimate of the reproduction costs of Intel's storehouse of knowledge. There is another non-tangible, off-the-balance sheet asset a competitor would have to create in order to compete with Intel. Almost every company needs to spend money marketing its wares. In Intel's case, though, it took several decades before they started to spend serious money telling consumers about the advantages of having Intel inside their computers. From the start, they sold highly technical products to a large number of sophisticated purchasers. This sales effort involved more than posting a list of specifications and prices for the semiconductors they offered. Sales executives had to work with customers to understand their needs and to win contracts. Any new competitor would have had to develop the rapport with customers and their specific requirements to go head-to-head against Intel. All this effort costs money. It takes time to build the relationships with the engineers and the customer firms. It is not possible to produce a hard figure for the magnitude of Intel's spending on marketing, which would include primarily the salaries and commissions of the sales staff and money spent on advertising and other forms of promotions. The amount for advertising is broken out, but until 1990, it never amounts to even 8% of the marketing, general, and administrative MGA expenses. To arrive at a reasonable number for what a competitor would have to spend to draw even with Intel requires making some estimates. 1. To even out the annual variations, we take the average of MGA as a percent of sales for the most recent 5 years and apply that to the current sales figure. 2. We assume that it would take 3 years of marketing expenses to get up to speed with Intel. 3. We set the share of MGA spent on running the business at half the total, leaving the other half for marketing. Each of these assumptions can be challenged and refined. Our aim is to arrive at a reasonable number to add to Intel's assets as an indication of the reproduction costs a new entrant would face. The amount is significant, slightly larger in most years than the R&D adjustment. When we include an adjustment for both R&D and marketing, we lower the market-to-book ratio for Intel by a considerable amount. There were several years in the period after 1975 when Intel could have been purchased at adjusted book value or slightly less. Again, we are looking at year-end equity values and year-end prices. In some years, the interim prices were below the previous year-end. Starting at 1982, Intel began to invest in other companies, generally with the aim of advancing Intel's overall strategy, which was to encourage broad demand for microprocessors. Intel marked to the market the stock of publicly traded companies in this strategic portfolio. For privately owned companies, it valued the shares at its cost. We see no reason to challenge the company's practices here. Only if the privately owned shares had declined substantially since Intel's investments would it be necessary to adjust shareholder equity downward. We have made no modifications to the liabilities on Intel's books. Over the years, the company did build up a sizable deferred taxes account. If that figure were discounted to the present, the liabilities would decline and the equity would therefore rise. But the adjustment is minor and only becomes visible in the years after 1995, when the market value of Intel greatly outstripped the book value. Measured against book or adjusted book value, the 3 best times in the history of this period to have purchased Intel shares would have been 1. In January 1982, when the market value of the whole company fell briefly to around $925 million, compared with an adjusted book at year-end 1981 of just over $1 billion. 2. In August 1986, when the market value was about $2 billion versus an adjusted book value of $2.5 billion. 3. At the end of 1988, when the adjusted book value of $3.9 billion was about even with the market value. Had an investor been disciplined or fortunate enough to load up on Intel every time its market value came within hailing distance of its adjusted book, the results would have been excellent. At no time subsequent to the purchase would the value of the shares been lower by any meaningful amount, and the gain over the next 5 years would have been substantial. Now, all of these dates occur within the extended bull market that began in August 1982 and persisted into the year 2000. The investor in Intel would have been sailing with the wind. Still, purchasing shares at the start of 1982 and holding them into the one very rough period in Intel's history would have provided a decent return, though slightly below the returns on the S&P 500 index. Nevertheless, it is important not to be lulled by the comfort of hindsight into thinking that these decisions were easy to make. In early 1982, the coming of competition to the memory chips began to seem inescapable, and the progress toward dominance of Intel's microprocessor position was hardly certain. The IBM PC had only entered the personal computer market in late 1981, and there was always a very real possibility that IBM might produce its own microprocessors. If Intel could not acquire sustainable competitive advantages either in memory chips or in microprocessors, then as a competitive player, asset reproduction value would capture the full value of future earnings that Intel could expect to enjoy. In 1986, Intel was incurring large losses, and in late 1988, Intel's earnings began to decline once again. Having the confidence to invest in Intel under these circumstances would have required, as we pointed out before, a highly developed understanding of Intel's market position and management. On the other hand, the fact that Intel was trading at or below net asset reproduction value in a viable industry provided significant downside protection. Assuming that Intel's management was capable of making efficient use of these assets, taking a flyer on Intel's future would not have entailed serious losses, even if that future did not pan out. The key here would be Intel management's ability to make efficient use of its assets, which would be reflected in the long-run earnings power that Intel was able to generate. Thus, the next important step is to look at Intel's earnings power value. Valuation 2. Earnings power value. Here we will follow the approach we took in valuing WD-40 based on earnings power. The underlying assumptions are that the company will not grow, that its current earnings are sustainable for a long period of time, and that a shareholder, as an owner of the company, will receive as his or her return a proportionate share of the company's distributable earnings. The no-growth assumption works easily with WD-40, but it certainly does not fit Intel, a dynamic company in a rapidly changing and expanding industry. Therefore, it requires a considerable dose of strategic analysis to produce a reasonable estimate of Intel's constant earnings power in any particular year. Since the question we want to answer is whether and when Intel shares presented an opportunity to investors adhering to the valuation criteria we have established, we can look only at information that would have been available at the time. As we have heard, an estimate of the company's current intrinsic value on the basis of its earnings power requires two steps. First, adjustments to the reported earnings to arrive at a figure that represents the cash the investors can extract from the firm and still leave it functioning as before. Second, selection of a discount rate that reflects both interest rates and the riskiness of the firm relative to other investment alternatives. Dividing the discount rate into the adjusted earnings gives us our earnings power value, EPV. Adjusted earnings, special charges, business cycles, R&D, and D&A. We will concentrate on the years from 1987 on, after Intel abandoned the memory chip business, and just as the personal computer revolution began to hit its stride. As with WD-40, we begin with operating earnings and make our adjustments from there. The first adjustment concerns special charges. These are the write-offs companies make when they revalue assets, such as inventory, equipment, or other investments they have made, or make provisions for layoffs, plant closings, and the like. The justification for keeping these charges separate from operating earnings is that they are singular events that do not affect the company's permanent earnings capacity. But in fact, each of them represents the accumulation of real expenses the company has incurred in the course of its business. If these charges persist from year to year, it means that the company is understating its true operating costs. To smooth out the erratic nature of these special charges, we take an average of the charges for the current and 4 prior years and deduct that from operating income. Second, unlike WD-40, Intel's sales and earnings were not immune from cyclical swings. When Intel was involved in the memory chip business in the 1970s, its operating earnings margins were as high as 30% and as low as 20%. But in the microprocessor business, where there was less competition and the market was growing, it seems unlikely that the margins vary as much. In the years 1987 through 1991, as sales grew rapidly, operating margins stabilized at somewhat more than 20% and even increased during the recession of 1990. So we think it is conservative to use 20% reported EBIT as a base for this period. Third, for Intel, R&D was a major expense each year, averaging more than 12% of sales from 1987 through 1991 and hardly falling off after that. These were growth years for Intel, and we have to assume that some of that R&D was spent to support that growth. But in the fast-changing world of integrated circuits, a company will need a large R&D budget just to run in place. So to get a more accurate picture of the earnings power with zero growth, we ought to add some of the R&D expense back to operating earnings. But how much? We can take the approach we used in calculating the replacement cost of the assets, which was to treat R&D as a capital investment and depreciate that over 5 years. Each year's expense would be the depreciation charge, which is somewhat less than the actual R&D cost. A second method is to estimate a maintenance R&D on the same basis we estimated maintenance CapEx by capitalizing R&D into an asset, finding a sales to asset ratio, and using that ratio times the dollars of additional sales to arrive at the growth portion of R&D. Maintenance R&D is simply the other portion. A third way is to look at the R&D spent by the closest competitor, in this case, Advanced Micro Devices, and use that number as the necessary Intel expense. Finally, we can take a guess and say that at least a certain percent, we will use 25% of Intel's R&D, can be attributed to growth and therefore should be added back to EBIT. Having done all of these calculations, we are going to use the last one here. It is the most conservative in that it produces a smaller increase in current earnings than any of the alternative methods, and it is the simplest to implement. Fourth, the adjustment for R&D can also be applied to selling, general, and administration, SG&A, a substantial part of which is spent on winning new business. We will add back 25% of the total, a rough estimate, but again, a justifiable and conservative one. Fifth, we can't escape taxes. For all these years, we will assume a tax rate of 38%. This is higher than the accounting tax rate reported in Intel's audited financial statements, and it gives Intel no credit for whatever clever management of its tax liabilities it achieved. It is a valid and conservative estimate of taxes on operating income. Sixth, we need to adjust for depreciation, amortization, and maintenance capital expenditures. Here some knowledge of the industry helps. The cost of semiconductor capital equipment, the big and expensive machines that Intel used to make its microprocessors, had declined over the years when improved capacity is taken into account. As a result, Intel's depreciation expense, which is based on the historic cost of its machinery, overstates the amount Intel would have to pay to keep its production capacity level. Rather than adding back all of depreciation and amortization D&A to EBIT after tax, and then subtracting the maintenance portion of capital expenditure, we will simplify the calculations and add back 25% of D&A, assuming that the other 75% will be more than enough to cover maintenance CapEx. There is nothing magic about the 25% figure in all these calculations. We use it because it seems both reasonable and conservative. Making all these adjustments gives us the following adjusted and distributable operating earnings for Intel in the years 1987 to 1991, as shown in Table Example 4.7. After all that hard work, the differences between reported net income and adjusted and taxed operating income is not enormous, but that is only a rough check on the legitimacy of the estimations.